Yes. All right, we are good. Market opens soon. We are gonna be live trading. Carvana is ripping. Had better than expected earnings. The stock is about 40%. Look at this, almost at 60. Almost at 60. Some insane move. Some insane moves. Couple stocks I'm watching here. We've got, I am watching Avago, so Broadcom. I'm watching SPX, of course. Carvana, absolutely, I'm watching that. Microsoft, Meta, Now, NOW, and Snow, and Tesla, of course, absolutely, Tesla. So these you have Tesla and Netflix earnings later today after the bell. So we are going to look at the quotes really quick. Okay, we're gonna change some stuff here. 21st. No, it's good. Okay, let's go back to here. AMD just had news here, and they're popping. Okay, the stock is popping here. Pre-market, AMD. So 121.89 was the pre-market high. So SPX setting up for a big move towards. Let me put up the chart towards 4,600. Probably by the end of next week. I'll say by the end of Friday, even 4,600. Watching SPX here above 45.52 for a move towards 45.69, 45.75. Calls can work here above 45.52 for sure. Watching NVIDIA. Let me put that up on the screen. NVIDIA. Watching NVIDIA here for a break of 480 towards the 500 level by Friday. You can see we had the high here at 480. So if we can break 480, we can squeeze to 500. AMD just had good news pre-market here. AMD making a big move. Watching AMD here to test 122 and then run towards 126, 125, 126 by Friday. And then, of course, can't forget Netflix. Earnings later today. It's all about how many subscribers did they acquire this quarter. Okay. So we all know about Netflix password crackdown. Password sharing crackdown, and then them adding ads. Okay. So most importantly here, we're gonna need to know how many subscribers did Netflix get. All right. If you're here for the first time, guys, welcome. If you're not here for the first time, welcome back. So about 4 minutes till the open. Four minutes till the open. Let's put up Tesla. This stock has been moving up huge. SMCI This has been making a big. Look at this. Look at this. Absolutely ridiculous. It's ridiculous. Look at this. And it can go. It can go. Ooh. So I believe Roku's setting up here to get to 90, okay, by next week. If Netflix earnings are good, okay, and if the ad revenue or if the ad tier for Netflix subscribers is working, it is very possible that we see a move towards 90 and 100 here on Roku. I believe they also have earnings next week. One minute till the open, guys. One minute to the open. Tesla ripping. Tesla rip. Actually, I need to add something here. Window capture. Boom. Here we go, guys. Here we go. Actually, I don't need to add that. Discard. All right. Let's check the chart here. Roku rips. Roku ripping. Tesla ripping. Carvana rips. That's a 30. No problem. Okay. All right, guys, let's look for some trade here. Avago under 900, very bad. Where can we go? Coin ripping also. LRCX. Boy. NOW popping. Rip. Nvidia pull back a little bit. But this is what it does. This is what it does every day now for the past week. Up pre-market, open up, down, all right, looks like Roku is popping with volume here. It can make a move. So at the 85, see, double. All right. Roku can move towards 90 to 100 by Friday if Netflix earnings are good. So I'm watching that. SMCI pop, SPX pop. Okay, let's change this to 19. 45.50. We're gonna do 45.85. 45.85 with 270. Okay, on the put side, we're gonna do 45.50, 45.60. Put. Those are 4, so we're gonna do 45.50 here. And those are 2. Okay, I'm looking at Tesla. $28. Tesla 330 for next week. If we can get those at 4, would be nice. Expensive premium, but if we could get those, it'd be nice. Roku is ripping here. Carvana rips. AMD selling off a little bit here. Wow, Roku is taking off. Roku is taking off. Again, on Roku we can see a move towards 90 to 100 if Netflix earnings are good. SPX also popping here. 45.85 calls or 330. They opened at 220. Wow, look at Roku. look at Roku. Straight up green. Straight up green. Let's take a little Tesla here for next week. 330. Now at 470. Yikes. Netflix selling off a little bit. Netflix, a break of 467 here is 459. $459 would be nice. If it would get a pullback to 459, I'd get in for earnings probably. But I really want to stay away from Netflix for earnings, really. What I'm really looking at is this Tesla, because I really think they're gonna have good margin. Because Elon told you deflation, right? Elon said deflation, so that means lower costs. See, Netflix back positive. 6-point move in 2 minutes. Insane. I'm watching this Avago Broadcom over 900. See if it can break 900. Actually, I want it to be above pre-market highs. So at 907. Probably can run to 930 and 940. Carvana pulling back a little bit. Let's put that up on the screen. CVNA. See here the highs of 59. It is now trading at 49, so that's 10 points off. Still up about 20% though. Huge. If you are here for the first time, welcome. If not, welcome back. Please like the video. Well, the stream. SCI short report. Service Corp. SPX ripping, guys. Look at that. That move is beautiful. That move is beautiful. I'm still waiting for this, for Tesla to move down a little bit. Still want to get in for those 330s. Actually, I'll just go ahead and get it. All right, I am in Tesla 330s for next week at about 450. Very expensive, but I think we can see a very nice move here towards 315. Let's put up the daily. 295, 315. Tesla can rip huge, man. And I mean huge. If we can break 298 today, and we got 300, 301, 310, and then 316. Coinbase. Coinbase also ripping here. Coinbase can get to 118. Let's check that. Coin 118. I'm gonna look for 115. Oh, expensive. Those are too expensive. Tesla here. We need to break 298 for a run to 301 here, and then 310 if possible. Very possible. Again, I am in those 330 for next week. Not financial advice, by the way. Again, guys, if you're here for the first time, welcome. Happy to have you. SPX, where can we go? I think 4,600 by Friday is very doable here. Let's look at the big dog, Microsoft. Huge pop yesterday. Huge pop yesterday. After they announced their plan to hold on, let me pull it up. Here, the stock hit new all-time high yesterday on AI software pricing. So essentially, they announced that they will offer 365 Copilot software to business customers at $30 per user per month. That is huge. That is huge. This is gonna add so much more revenue for Microsoft, and therefore, maybe trillions more to the market cap. It's already at 2 trillion, so this potentially can add about $30 billion, okay, per year. So about $3 billion per month. Insane. Anyway, let's get back to the charts. A Vago here. Ooh. 881, 862. Ike. Okay, let's see something here. Vago. $910 is 320, 920, 180. I don't want to be on a it's bad. Amazon rip. Carvana still up massive. Still up massive. Let's put up to 5 minutes. LRCX earnings next week. Let's see. LRCX. Let's put the 1 hour. It's 43. So with LRCX, okay, we all know about Nvidia already, right? But with LRCX, Nvidia chips gonna need 8 times the memory. 8 times the memory. What does that mean? So LRCX is the provider. So does that mean LRCX earnings go up? Possibly. So where can it go? Can it get 700 next week after earning? Tesla pop in here. If we can get 300, we need to break that 292 for a move towards 300. And then 330 is very possible for next week. I like this LRCX here for earnings. Let's pull it up here. LRCX. Boom. Next week. Earnings. What do we have here? 690, 700. 700 looks nice. 519, 514. This week. $660, $670. $700. 490, that's 20 points. Carvana, man, still ripping. Carvana has a lot of short interest, so a squeeze can happen and fast. If we can break, let's see. Put it up. CVNA. If we can break 59 today, 77 is very possible. Man, Carvana, can we get a squeeze? Can we get a squeeze? Imagine getting a GME type move, a GameStop type move on Carvana here. Very nice, eh? Microsoft to offer some cybersecurity tools free after suspected China attack. Microsoft now getting positive here. Meta also positive. Let's look at Meta. We're gonna look at Meta 320. 325 1, 322. Okay, where can Meta go? Through 21, 26. Now with Meta, it's a little bit risky because news came out today that they have already lost half of their Threads users. Microsoft 365. Let's see that here. MSFT. 365. Where are we at? 221. Very expensive. Very expensive premium. Which means we can rip. That's what that means. Same thing on Carvana. Very, very, very expensive premium. Let's check CNBC a little bit here.
Perhaps on the economy, even his own economist, Jan Hatzius, has been more positive, on the chance of a recession.
Which he talked about in the last interview a few weeks ago with me, Solomon, and he said, well, Hatzius has been right, so maybe we can get away with a soft landing here. But so far, the comments coming in from the CFO on the call are that specific to investment banking, and we're hearing this now as a theme, they're starting to see some action that, I don't know, bottom is a strong word, but that there's some light at the end of the tunnel.
I'm hearing that too, just from the practitioners that I speak to. Again, you never know, certainly when it comes to M&A, given especially the regulatory environment. We're going to get a lot more on that when we speak to FTC Chair Lena Khan shortly. But yeah, Sarah, I think there's hope at least right now. And by the way, that's helped by the stock market.
100%.
You got an S&P up almost 20%. You know, we've said it for many years. Number one on the list of things that gets people to do stuff, gets CEOs to think about doing things, is confidence. And your confidence goes up when the market goes up.
Speaking of confidence, it's so true. And the retail investor is really piling in here. We got the latest results from the AAII, American Investor Survey, which basically gives a snapshot weekly of how retail traders are feeling. I made a chart of the bull-bear spread, right? The difference between those that are expecting the market to go up and those that are expecting a rout. And it's been up for the last 6 weeks, and that's the longest winning streak since 2021, I would say. So that's also a cautionary sign, right? As soon as retail begins to pile up and people get more enthusiastic and bullish on the markets, you know, that tends to be when there's a pullback, but you can see the participation is there. And we talked to Walt Bettinger, the CEO of Schwab, about this yesterday when he joined off earnings. Here's how he described sentiment.
What's interesting about June is that even as this cash realigning fell to the lowest level it's been in many, many months, part of that was because clients are now moving back into the equity markets. So that's a good thing. It's not simply clients moving money into something in cash that pays higher yields. They're back in the markets. And we saw in the aggregate for the second quarter, buys were about 20% higher than sells. So our clients are showing some optimism.
20% higher than sells on buys, money moving into the market. It jibes with the sentiment surveys we're showing and with the action we talk about every single day here.
Yeah, as for the stock itself, first peak above the 200-day since March.
Schwab.
For Schwab.
Yeah.
JP Morgan today adds to the focus list. They go to 95 implies 44% upside. But more broadly, to your point, the Roundhill Meme ETF, 52-week high today. And small caps outperforming the S&P year to date, almost double the rate.
Hey, the bulls wanted it to broaden out.
Yeah.
I don't know. Meme gets dragged in there as well. I think the regional banks offering some reassurance across the board is certainly helpful because, you know, there's always that question mark about the shape that the regional banks are in, the deposit outflows, the fact that the Fed's still raising rates. We're going to talk to Citizens Bank and later in the hour, the CEO, but also just a quote on the economy from here's Synchrony Financial, and you can take your pick here. But overall, it's been okay. Here's one I picked out. I think, look, the consumer is still strong. I think they're obviously still spending. Excess savings are coming down a bit, but they're still trending above 2020 levels. That's good. So everything we're seeing on the consumer is still pretty positive. With that said, we're still operating cautiously.
At the same time, you do have some relief in the UK today as they finally got year-on-year inflation down under 8, first time in a year, 7.9, prior 8.7. That's a dramatic improvement, although Jim made the point earlier, nowhere near what the US and Canada have been putting together on some of our CPI prints.
But a huge sigh of relief. You see that across, even our treasuries got bid on that number. The expectation was more like 8.2, David. So there's some celebration of lower inflation there. But clearly, Bank of England still got work to do.
I want to get to some news we've been following closely this morning, and that involves the Federal Trade Commission and the Department of Justice's Antitrust Division. They released long-awaited draft guidelines, essentially, on how they view enforcing merger law. And joining us from the White House is FTC Chair Lina Khan. Chair Khan, good to have you this morning. We were joined on CNBC earlier by Jonathan Cantor at the DOJ. But let's just start off with what are essentially 13 guidelines. Your agencies have been delivering these so-called guidelines, I believe, since 1968. What distinguishes this latest version from the others that we've seen?
Well, first of all, it's so great to be here with you. So as you noted, the agencies have issued guidelines since 1968. Of course, our markets and our economy has changed significantly since then. And so it's been longstanding practice for both the Antitrust Division and the Federal Trade Commission to periodically issue updates and revisions to these guidelines to make sure that they're fully up to date and reflecting the reality of how businesses are pursuing mergers and competing in today's economy, as well as the most up-to-date state of the law.
And what is the process from here? Specific to how does this actually impact the law and the way it is going to be viewed by the judges who ultimately decide whether, when you bring a case, the FTC is correct, or perhaps when they say, as was recently the case, for example, in Microsoft, when they say, no, we don't believe you.
So these guidelines reflect the law. If you look through the document, you'll see a lot of footnotes to appellate court decisions, to Supreme Court decisions. We read through every litigated merger decision that resulted in a decision from the Federal Court of Appeals or the Supreme Court. And so this document is designed to make sure that everybody is on notice about what the state of the law is. And we'll be right now, we put out this draft guidelines. We'll be collecting public comment for 60 days. We're very eager for public input. We got 5,000 comments when we initially were setting off on this. And so we look very closely at that input, and we'll be eager for additional public comments as we look to move forward.
How long is that period of public comment? When do we expect these to be put into actual effect?
So the public comment period is 60 days. So at that point, we will take stock of the input that we've received and remain very open-minded about what things would look like after then. But there is a clear need to be revising the guidelines to make sure that they're fully addressing, the realities of digital markets, the realities of how firms are pursuing M&A in the current environment. And so we'll be keen to get that input.
Yeah, obviously important for our regulators to, as you say, reflect the current reality. But something that is very difficult to do is predict what's coming, particularly in an economy as dynamic as our own. What gives you confidence that these very guidelines you're putting out won't be outdated as a result of changes in the market that seem to occur so quickly?
So I think it's absolutely true that enforcers need to be reviewing the guidelines with an eye to the way in which businesses are pursuing an M&A and the ways in which our economy is actually functioning. We're confident that we've gotten a lot of input, and as part of this process, these guidelines are really addressing some of the key issues that we're seeing across markets. Congress asked us to enforce the merger laws, and that is necessarily a predictive exercise. As a result, the inquiry that we undertake is a risk assessment. We're assessing the risk that a merger may substantially lessen competition or tend to create a monopoly, and that's what Congress has instructed us to do.
My colleague Jim Cramer earlier on our show was talking about, in having read the DOJ guidelines along with your own, that it seemed to him that vertical mergers, for example, under this administration or under these guidelines, are something that is verboten, so to speak. How do you respond to that? What is the view overall of vertical mergers, which typically have not received the same level of scrutiny as have horizontal deals?
So look, we will look at every case on a fact-by-fact basis and look at the specific circumstances and make judgments based on the specific facts and law at hand. There is precedent on the books talking about non-horizontal mergers, and so we looked very closely at that. When putting together these guidelines, we noted that historically the courts have recognized a few ways in which vertical mergers can be lessening competition, including by giving a company key control over critical inputs that its rivals depend upon. But that's just one way. There are a whole set of other ways that these types of mergers can risk lessening competition, and the 13 guidelines are intended to really lay all that out very clearly.
Yeah, in the EU, for example, there's a willingness to accept behavioral remedies for a vertical deal. There's a sense here that the FTC will not accept that. Is that the case, or are there situations where you would accept a behavioral remedy, and if not, why not?
Look, we consider every matter on a case-by-case basis. Our obligation is to preserve competition and make sure that mergers are not unlawfully lessening competition. If parties are putting before us remedies or potential packages that they claim would do that, we look at that very closely. But at the end of the day, our job is to protect the public, and we need to make sure that the public is not bearing the risk of a failed remedy. And so, we look at history, we try to make sure we're understanding how previous remedies have worked out to make sure that our approach is fully rigorous and fully protecting the public.
Chair Khan, do you have the resources for increased merger reviews at the same time that litigation is rising?
So another change that we recently proposed would update the information that merging parties have to provide us when they're proposing a merger. And the goal there is to make sure that our agency is able to conduct these investigations much more efficiently and much more effectively, so we don't have to waste time kind of going back and forth, getting information that the parties already have on day one and that we need in order to be able to make our assessment about whether a deal does or does not raise those concerns. So I'm hopeful that that proposed change, if finalized, will also ensure that we're able to pursue investigations efficiently and effectively, even given limited resources.
Because there are threats of budget cuts, so I am wondering what the resource allocation looks like and what internally the FTC looks like right now after you've had some significant losses, including the Microsoft Activision one.
We obviously are bringing cases when we think there's a law violation. We've been thrilled that we've had a whole set of success, including with deterrence, which we hear a lot from market participants about the deterrent effect. And as a law enforcer, you always want to be making sure that firms are on clear notice about what could constitute a law violation and are staying far away from that line. We were very grateful to receive a budgetary increase last year. That has enabled us to be growing our ranks. We're still hiring, and we're grateful for those additional resources and the additional work we'll be able to do with them.
Deterrence is obviously very important, but when you do lose, there's questions here specific to Microsoft. You lost in the U.S. court. Why not drop the action from there? Why seeking appeal? Why are you continuing to follow, for example, along with the ALJ proceeding? Chair Khan, earlier Mr. Cantor sort of said he believes in our judicial system and will abide by judicial decisions. So why would you continue, given the court has already been heard from, with this action?
we fully believe in our robust system of judicial review. I won't be able to comment on any specific matters, but generally, if we get an adverse decision from a district court, we look very closely at it to determine whether we think there were any errors of law or misapplication of law that we think warrant appeal. And so those are the types of assessments that we undertake as we make these decisions. There are a whole set of instances in which the FTC has not moved forward with an appeal, but in instances where it has, sometimes quite successfully, it's always because we believe that there was a misapplication of the law or further clarification of the law that needs to be done. And that's usually what drives those decisions.
Yeah. You know, how much is any of your decision making driven, or at least in part figures into your decision making, what goes on at the EU, for example, or even the CMA? And I ask that question in part because there was a lot of back and forth, that would appear, based on a Freedom of Information request between the FTC and the CMA involving Microsoft and Activision. Seems somewhat unusual. How much does what they do figure into how you think about what you do?
Look, I was very fortunate to inherit an agency that is seen as a leader globally. During the Bush administration, the FTC launched an Office of International Affairs, and so for over a decade now, the FTC has been entering into cooperation agreements with enforcers around the world. There's been strong support historically from the business community and encouragement for the FTC to be working closely with other enforcers to ensure what some folks call harmonization. So that's the state of affairs. The FTC works closely with other enforcers, but at the end of the day, we make all of our determinations based on the facts and based on U.S. law. We always use our independent judgment when we're making these enforcement decisions.
Why was there a need at all to talk to the CMA about Activision and Microsoft?
So there are various cooperation agreements in place. Again, some of them going back to the Bush administration that lay out appropriate processes. Sometimes it's businesses that want to encourage the FTC to be talking to other enforcers to ensure more streamlined review and more efficient information sharing. So this has been a long-standing practice. I'm grateful that the FTC is viewed as a leader internationally, and all credit goes to our terrific staff of the Office of International Affairs that for many years now has been ensuring that we are sharing our experience and expertise around the world.
You mentioned your staff, and Sarah asked about it as well. You know, I want to reference a letter from what was then the outgoing Commissioner Christine Wilson. She was very critical of you and of what she said was the dissatisfaction amongst the staff. How do you respond to when she says your leadership has led to the departures of many experienced personnel, causing a notable brain drain, and goes on to say, pains her to observe the tarnishing of the FTC's reputation and the diminution of its efficacy?
So look, we are fortunate to have consummate professionals, extremely talented staff at the FTC who day after day are fighting to protect Americans from unfair methods of competition or unfair or deceptive practices. Of course, we work hard to make sure that the FTC remains a great place to work. I've been really thrilled that we've been able to recruit a whole set of new folks. We just launched a new Office of Technology. Within a matter of days, we got 600 applications from cutting-edge technologists, data scientists, data engineers who are eager to bring their skills and talents to the FTC. And so we'll look forward to continuing to do that type of outreach and engagement and make sure that we're fully equipped in-house with the skills and talents that we need.
All right, back to the principles that were announced today. One is mergers should not entrench or extend a dominant position. Wondering if you can expand a bit on what exactly that means. There's some people who want to take me back apparently to a decision in 1967 at the Supreme Court involving Procter & Gamble, where this theory was outlined. Give us some more sense here as to what that means when you say should not entrench or extend a dominant position.
So there's long-standing case law that seeks to ensure that mergers are not being used to entrench dominance in ways that are basically maintaining a monopoly or creating a market where other firms also have to significantly grow in order to be able to compete. You'll see in the document there is significant citations to case law that really lay out what some of those legal tests and that legal analysis looks like. And so we're going to be faithful to the case law on the books.
Another one that I noted here, a merger is when it's a part of a series of multiple acquisitions, the agencies may examine the whole series. That seems to apply to private equity, for example, which can roll up companies and then combine them. What is your view on that, and how aggressive will you be perhaps in reviewing transactions that in the past did not get perhaps a second request, let alone an objection from the FTC?
So these guidelines are agnostic as to particular business model, but we wanted to make sure we're being clear-eyed about business trends and trends that we've seen in the markets. One trend that we have seen is roll-up strategies. So instances in which a firm will undertake a series of acquisitions, no single one of which may raise legal concerns, but in the aggregate, there can be significant consolidation of a market. And so we wanted to make sure that we were putting folks on notice that those types of instances can warrant legal scrutiny and legal concern. And again, there's precedent, including from the FTC recently, where we have applied scrutiny to those types of roll-up strategies.
You mentioned a few minutes ago that the new guidelines require deals to provide more background information and may
AMD just went
times.
negative.
And so I'm wondering how you factor in consumer benefit in that scenario, because any delay or cost could influence the consumer, could harm the consumer, could hurt the economy. Do you think about that?
So absolutely.
AMD went negative. LRCX negative. Broadcom negative. Looks like they're selling chips. Nvidia negative. AMAT negative. Yeah, they're ASML negative. I mean, dumping, really. ASML had earnings this morning, and I don't think it was that great. So, no wonder, but yep, they're selling chips for sure. Now, what are they buying is the question. Banks? Yep. Goldman Sachs. Ripping. 350s in play here for Goldman Sachs. They also had earnings this morning. Snow, nice bounce. Nice bounce. If we can get two highs here, it would be nice. So I entered a snow position here for next week, because next week we have Amazon earnings, we have NOW earnings, and if those are good, we can get a huge pop on snow. 220 possible. Let's see if we can get 200 by the end of this week. Would be very nice. I also am in a Tesla position for next week. 330 call. Let's see if we can break the 298 here, and then we can move to 300. Do y'all think Tesla will pop after earnings? Can't forget Netflix. Just been flat today. Oh, it's popping now. $284 highs. Netflix, it's all about subscribers. It's all about the subscriber growth. How many subscribers did they acquire in the last few months? Remember, they started the password crackdown or password sharing crackdown. Analysts think they added an estimated of around 2 to 3 million subscribers. Which would be a nice bonus. Would be nice for Netflix. I'm also watching Roku. Roku can pop if Netflix is good. We would need to break the 79 and then we can move towards 85. They also have earnings, I believe, next week. Next week will be a huge week in the market because we have a lot of earnings. I think Amazon, Roku, NOW, Meta, Microsoft, Google, Amazon, just a lot of earnings. And I believe also next week we have, let me check. Is it FOMC meeting we have next week? July 27th. Yep. So next week on Wednesday, the 26th, FOMC decision on interest rates policy. So big week. Big week next week. I don't know why I keep saying week. It's because I'm looking at the charts. All right, let's put up SPX. SPX has just been straight up ripping. Look at this. Straight up. So we got a $5,700 price target on SPX for the end of the year, and we're only at 4,500. So that means we can rip another 1,200 points here in the second half. Just insane. Which is just insane. Let's take a look at CNBC here a little bit.
Both for the month and year over year. This after a massive jump in May that was revised lower. Builders said in the sentiment report yesterday that they were still getting strong demand due to low resale supply, but they're up against higher mortgage rates and high costs for materials as well as material shortages. Now, lumber is getting some chatter this morning after the starts report. Lumber prices are up nearly 15.5% since May. That is in part due to the Canadian wildfires and slower deliveries of lumber. That's a big hit to builders already paying more for other materials. Single-family building permits were slightly higher from May, but down 3% year over year. Builders are just being careful, especially as mortgage rates were over 7% at the end of June and have not come down much off of that. Builders reported lower expectations for sales over the next 6 months in that sentiment report, and that, of course, is due to the higher mortgage rates hitting affordability. Higher rates, though, are still keeping current homeowners who are paying much lower rates in place. That should continue to benefit the builders, but only if they can keep their homes affordable. Fewer builders now saying they're lowering prices, but more are trying to add supply on the lower end of the market. So we'll see if that helps. Sarah?
Yeah, see how that impacts the overall inflation. Thank you, Diana. Diana Olek. After the break, Activision Blizzard CEO Bobby Kotick here at the New York Stock Exchange. Don't go anywhere.
Tesla here, free man. Break that 298, please. Break that 298, please. Break that 298, please. We're almost there. We are almost there. You see that? You see the rejection there? Touched it. Touched it and it immediately dropped. There we go. Retest. Retest. Let's go. This is giving me NVIDIA vibe.
Asset.com.
Microsoft and Activision extending their merger deadline, or the termination of their agreement, to October 18th. Activision.
Break, please. Here we go. Here we go. Here we go. 300, please. 300, please. Give me 300, por favor. Wow. A Vago. Very nice. Very nice bounce. Very nice bounce. That's a 15-point bounce. That's very nice. Above pre-market high, it can rocket here. Yeah, here we go, Tesla. Get 300, please. See if I can put it on 1 minute. Yo, why does this stay in my ears? I'm already up about $40 on those snow calls for next week. $200. Here comes Microsoft. Here comes Microsoft. Carvana popped again. Can we break 59? A break of 59 is 77. This is getting annoying. A firm ripping too. Up 9%. Meta popping. Avago, man, almost a 20%. I mean, 20-point rebound here. That's very strong. This is the market we're in right now. Any dip, you have to buy. That's the market we're in. You see a dip, you buy. Look at that. Very strong, man. Very strong. Very strong. 15, 20, 15, 30, 45. Yeah, an hour. Very, very strong here. Now above, if you can get above pre-market high, I'll probably get in. Pre-market high, which is like 908. Very strong. Carvana also very strong. Wow, Meta just popped. Meta just popped huge. Huge pop. Oh, huge drop. Oh, SPX. Wait. Whoa, huge drop. Wait, do we have any news? Hold on. There's no news. There's no news. Why did we drop like this? So a drop like this means this goes back to what I was saying just now. When you see a dip, you buy. See July 19th. Still above 52. What we got? 75. Yep, we're gonna get 75. Mid 310. Let's try 310. Failed. So I am in SPX 475 at the 310. Because that was a huge drop, and we didn't even have no news. The market we're in right now is you see a drop, you buy it. That's the market we are in. When you see a drop, you buy. That is the market we are in. Now, it may not always work, but it's been working. And look at that. Look at that. I could take profit here if I wanted to. I'm already up huge. But let's see if we can get back to the highs. Can we get back to the highs here? Again, I am in 3 positions here. I've got SPX calls expiring today. 45.75 calls. And then I am in Tesla 330 calls for next week. And then I am in snow calls also for next week. The reasoning behind snow calls is because next week we have Amazon earnings, we have Google, we have NOW. Okay, so if cloud numbers are good for Google and Amazon and NOW, snow is gonna rip. Snow is going to rip. Looking to get to to today's highs on SPX here would be very nice. Again, I am in those 4:45.75 calls expiring today at 3:10. Stop loss is gonna be below this candle right here. Where is it? Right here, below this candle here. Which is today's lows, I think. Here we go. We are moving. Tesla broke the 298 level and now holding it pretty strong. Again, we need to see here if we can break 300. Snow pulled back a little bit, but that's how he trades. This is why you buy time, because things like that happen. SPS, come on, push up. You know what? I'm closing here. This SPX trade, I'm closing it. All right, I took a small win here. Probably should have stayed in, but it's okay. I took a small win. Ha! Look at that. I definitely should have stayed in. I absolutely should have stayed in. It's all good though. Can't go broke taking profit. Tesla, I love this move here, man. We broke 298 and we're holding it strong. I like that. Now we just need to break 300 for a bigger move. Here we go. Avago went positive. Very strong here. Wow. Wow. Very, very strong. This looks like the same move. The same move from yesterday. Market open, SPX pops, banks pop, and tech lag. And then, you know, midday, you see SPX pull back. And then tech rip. Look at this SPX. I definitely should have stayed in. I absolutely should have stayed in. Look at that. I absolutely should have stayed in. $45.80 possible. Very possible. Tesla looks very strong. Snow looks okay. Nvidia just went positive. See, this is the same trade yesterday. Same trade. Now tech is popping. Now they're buying chips again. Earlier they were selling chips. Now they're buying chips again. Which is why you see AMD went positive. Nvidia went positive. Avago went positive. Adobe went positive. They're ANET. They're just massive. Meta, nice spot. Nvidia, if we can break 480, we can run towards 500. Look at those SPX, man. Look at those SPX. Wow. I definitely should still been in. Absolutely should have stayed in. Tesla, nice move. Avago, man, this thing can rip. This thing can rip. $422 is very doable today. Look at those SPX. Oh my God. Wow. Almost at highs. Man. I had those 45.75. I definitely what I sold at what 370? 370. Had I still been in, those would have been 45.75 here, 540. So that's another $170 that I left on the table per contract. Okay. But it's all good. It's all good because that trade, that SPX trade, made my Tesla calls free. What that means is that the profit I made from SPX calls, right, pays for the Tesla trade, which is for earnings tonight. So what that essentially means that if I lose on the Tesla trade, okay, which is what 50% probability, if I lose on the Tesla trade, then it's all good. It's all good because I made that from those SPX calls, so it's all good. NOW moving nicely, man. Moving nicely. Meta, huge pop here. Meta, huge pop. Let's put it up on the screen real quick. Huge pop. Huge pop. Tesla earnings on deck. Let's listen to CNBC really quick. See what they talking about.
News about are they going to come out with a fresh in Model 3? Where's the next generation model? The Mexico plant? And then finally, what are the plans for shipping the new Cybertruck that they just started producing?
Although some, Mark, who say, maybe brace for disappointments on any of those buckets, always say they could always rely on comments about AI and what full self-driving is going to get you in the longer term, and that remains the bull narrative.
Yeah, I think, Carl, these days, if you have a company, all you have to do is put .ai at the end of it, and your stock gets a bump. In Tesla's case, when you look at the stock run up, and it's up, almost 60% in the last quarter, they posted strong production and delivery numbers. They did the charging deals with the OEMs, the established OEMs, to use their supercharger stations. As you said, the overall run up in AI stocks, and for Tesla in particular, it's around this AI-based kind of self-driving software that they've been touting. And I think that's a big piece of what's driving the valuation of Tesla right now. Now they have to start delivering on it.
What do you think of the Cybertruck? I had a debate with friends over dinner last night about whether people would buy it and how important that is to Tesla's future.
Well, they're going to have limited volume of this, but Sarah, in the auto industry, there's truck buyers that fall into two buckets. One is the folks that really want the capabilities of the vehicle, payload, towing, that kind of thing, the functionals. Then there's the other kind of buyer, which we call the lifestyle buyer, which they're buying the truck because, it portrays them in the way they want to be portrayed. I think this is going to be very attractive to those buyers and those that can afford it. And when you look at the volume, which they really haven't talked about it, but it's probably going to be fairly limited, that will, I think, give them the opportunity to price it. And listen, at the end of the day, it's an incremental product for their brand, and it helps build their brand even more. And they're the leader in EVs from a brand recognition standpoint, and the Cybertruck will help in all those elements.
I feel like the lifestyle buyers will be into it. I mean, it's cool. Mark, thank you. I appreciate it. We'll see what happens tonight. Mark Field.
Coming up later this hour, the housing data continues to show a mixed picture. Starts did retreat in June, permits down more than expected, but refis jumping. And
honestly, Tesla is giving me NVIDIA vibe. It's moving just like NVIDIA moved before earnings. Before NVIDIA went up almost 40%. Madness. Again, guys, we have Tesla in Netflix earnings tonight, so we're gonna be covering those live here, including the earnings calls. So stay tuned for that.
European markets closing in just a moment. We're seeing green across the screen, mostly, with the FTSE seeing the biggest gains in the UK. Financial services and British property names are up the most over there. And those moves coming following the big story abroad today, which is all about that inflation read that we got out of the UK. 7.9%, so falling below the 8% level and hitting its lowest level in more than a year. The prior number was 8.7% in May, so it did show a big drop. And the first time in 5 months that the headline reading came in lower than expected. All psychologically important here. The pound and British gilt yields all fell on that number, a 2% rally in the FTSE, Carl. It reminds me of the days when we first started to see some real moderation in our inflation numbers several months ago. So they're several months behind us, but good to see it not still going up, coming in below expectations, and reviving hopes that the Bank of England won't have to do quite as much.
Right.
There's still work to do, and they're still way above target, obviously, and way above the U.S. and Europe, but it's coming down.
Yeah, but it hasn't done anything to knock off the expectation of further hikes.
No, there's
no.
Of course. The market still bets on further hikes from BOE, but maybe they don't have to do doubles like 50s, and they can do 25s.
Right, which has been the call last couple of weeks, at least from a couple of different banks. Let's stay overseas. More Americans are shifting their luxury spending to Europe. Robert Frank's watching some of that trend. Hey, Frank, Robert, good to see you.
Good morning, Carl. Luxury stocks taking a hit this week on fears of a slowdown in U.S. spending. It all started Monday, as we talked about, when Richemont reported that 4% decline in U.S. sales. Yet America's luxury losses may actually be Europe's gains. Analysts say wealthy Americans who are vacationing in Europe this summer may be buying their luxury goods in Paris, Rome, and London rather than the U.S. Sales tax data showing that spending by Americans nearly tripled in June. Bernstein analyst Lucas Sokos saying, quote, Americans remain the highest spending nationality and the fastest growing spenders in Europe. U.S. consumers again led the rally and continue to show a strong appetite for both travel and luxury. We actually saw a similar shift last summer when LVMH, Richemont, and Burberry all reported big gains in Europe, mainly from American tourists. LVMH reported at that time a 36% jump in Europe in its third quarter. That compared to only 11% growth in the U.S. Last year, remember, the dollar was at parity with the euro. As Sarah remembers, that made for some really good discounts. This year, of course, the dollar is a bit weaker, so we're not going to see as many bargains on those Louis Vuitton bags, or there's Hermes sandals with the H on them that everyone seems to love this summer. Guys?
Speaking of, Robert, I wanted to throw out Kering, which is a big mover today, the luxury maker in Europe, after they ousted the Gucci CEO, the guy who was responsible for the whole brand refresh and the resurgence of the Gucci brand, which has fallen stale. I was curious about your reaction, because now there's some excitement that he's out.
Yeah, there's some excitement and some hope that maybe they can turn that brand around. Remember, Tom Ford famously turned that brand around a long time ago, and in the past few years, it's been a tough slog for them, and that's been weighing on Kering's results and their growth. Now I think shareholders are hoping that with the new executive leadership team, they can put something together, but that has been a brand that hasn't lived up to its past potential in the past few years, and it's a very well-known brand with strength both in Europe and the U.S.
Yeah, huge part of that. I mean, and that has been really left behind in the rally with LVMH and Hermes. It's the cheapest PE in European luxury.
Yeah. Still waiting on Asia Pacific, too. Robert, thank you. Robert Frank. Let's get a news update with our Pippa Stevens. Hey, Pippa.
Hey, Carl. North Korea has not commented on the status of the U.S. soldier who bolted across the border yesterday. But we're learning new details of how it all went down. A woman in the tour group says Private Travis King made a break for the border as the tour was ending.
Suddenly I noticed a guy dressed in black, running what looked like full gas towards the North Korean side. And my first thought was, what an absolute idiot.
Donald Trump lost his bid for a new civil trial against writer E. Jean Carroll. A federal judge rejected his request, saying the jury that found Trump liable for sexually abusing and defaming Carroll did not commit a serious miscarriage of justice, as Trump claimed. The jury awarded Carroll $5 million in damages. And Las Vegas police officials say officers executed a search warrant yesterday at a home in a Vegas suburb in connection with the investigation into Tupac Shakur's unsolved murder. But the department would not provide any details about who owned the house or what led to the search. Tupac was gunned down in a drive-by shooting near the Vegas Strip in 1996. Sarah, back to you.
All right, Pippa, thank you. Pippa Stevens. Up next, Benchmark standing by its sell call on Netflix ahead of earnings. We're going to talk to the analyst after the break.
Plus another day, another downgrade of AT&T. That's the third in a week. This time from Argus, going from buy to hold. The stock is rebounding today, though, as the company responds to the journal's reporting on that lead sheath cable. You can read more about that on CNBC.com. We're back in 2.
See, talking about AT&T, okay? This is exactly why ATT. This is exactly why, okay? If you're building a dividend portfolio, okay, you need to have good stocks in that portfolio, okay? Because if you have stocks like AT&T, okay, who have a boatload of debt, and the stock has been just going down for the past decade, okay, and they have been decreasing their dividend, what are you doing owning that stock, even if it's for the dividend? It doesn't make any sense, right? Because you're losing on the back end anyway. AT&T just hit what their lowest stock price in 2 decades or something like that. That's insane. Netflix gets rid of cheapest basic ad-free options in US, UK. Okay, what does that mean? Well, the stock had a positive reaction to that, I guess. So I guess it's good news. I don't know. We'll see. Man, those SPX 4575. Definitely sold too early, that's for sure. Tesla, nice move, man. We're really holding that 298 level strong. We broke here. We broke it here. And we've been holding strong. We've been holding strong. Meta, nice move. Nice move for Meta. Nice move. Carvana, still up massive. Can we break 59? Tesla, can we break 300, baby? Break 300, baby. Break 300, baby. Would be nice. Would be nice. NOW, man, nice move. NOW, I had those, see, 45.75 on SPX, or 6 now. That's almost 100%. Anyway, NOW, I had those 585s for this week. Those are now 30. Wow. Those are now 30. Wow. That's insane. Man, I've been living so much on the table. So much money on the table. I was in this 585 NOW calls for this week. Okay, I was in them last week. I think I sold at like 8 or 9 or something like that. Those are now 30, bro. Those are now 30, bro. So I left about $2,100 on the table. Okay, we have CMG. I was in those 2179 calls. I think on Monday. On Monday, I entered those 2179 calls. Okay, at like 410. And then I sold. At the end of the day, I sold at like 740 or something like that. Or 770 or something like that. But around there. And then the next morning, CMG had good news. Next morning, CMG had news that they're expanding into the Middle East. At open, bro, those 2175s were 22. Okay, and at the highs of the day, they were like what, 28 or something like that. Last I checked, 28, bro. I left so much money on the table. Yesterday, bro, at the end of the day, well, not at the end, but around what, 12? Okay, I entered SPX calls 45.55. Okay, I sold for like, I don't know. Anyway, I didn't sell for that much. But at the end of the day, not at the end of the day, but towards the end of the day, okay, around like 2:30 or like 3 o'clock or something like that. Those were like $1,200, bro. $1,200. $1,200, bro. I've been leaving so much money on the table because I'm like, I want to take profit fast, you know. But I leave so much on the table. Netflix, bro. I was in Netflix, a week ago, or even 2 weeks ago. I've been playing Netflix like the whole month, really. But 2 weeks ago, bro, or like a week ago, I was in Netflix 500 for this week for earnings. 500. I sold at like 6, and those yesterday? Those were at like 12, bro. Like, I leave so much money on the table, man. It's crazy. But I'm cool with it. I'm cool with it because, you know, profit is good. Right now, I am in 2 positions. I am in Tesla calls, 330 for next week. And then I am in Snow for next week also. Tesla, baby, can we break 300, please?
Saying they look forward to helping unlock the full growth potential of the brand shares. And it just brings to mind, as Kramer mentioned this morning, how many moving pieces there are, especially in the beer category right now.
Yeah, with Modelo still second month in a row taking the top spot from Bud Light as the fallout there continues. Let's turn to the housing market. June housing starts and building permits out this morning. Both missed expectations, actually showed a decline following strong May numbers. This comes as the average 30-year fixed mortgage rate near 7% again. But our next guest notes that competition is still fierce. Data from Redfin showing just 1% of homes changed hands this year. That's the lowest share in nearly a decade. Joining us now, Redfin CEO Glenn Kelman. Always good to talk to you, Glenn. Welcome.
Hi, good to be here.
It's very confusing what's happening in the market because it feels like things were warming up, but starts and permits were a miss.
Well, demand is low, but inventory is even lower. So if you look at the home builder index of confidence, it's up a couple of points. It's the 7th straight month of gains. So the builders are sitting pretty because no one else wants to sell their home. No one else wants to give up a 3% mortgage.
How long do you see that problem persisting? As long as rates stay high?
Yes, although there's some relief in sight just because about a third of the market, 37.5%, have adjustable rate mortgages. So those are going to reset in the next couple of years. You're going to start to see people move. There's also just a demographic bump that many millennials still want to buy a home. I think they're frustrated by the Supreme Court decision on student loan repayments, but they still got to find a place to live.
I mean, Diana Olick emailed me, and she noted that you guys recently reported that bidding wars are back, which does seem a little crazy, because how can people afford to do bidding wars and pay over ask when mortgage rates are so high?
Well, again, it comes back to really low inventory. So this is the second straight month that the list price has been lower than the actual selling price. So I think it's 100.1%, the final price higher than the list price, which is just really unusual when you're in a market with rates near 7%. We've noticed that buyers are really rate sensitive. Even when rates come down 10 basis points, we get more demand on our website and more people touring homes, making offers on a Sunday night.
But are they using all cash when it comes to these prices over ask?
There's a higher proportion of people using cash than before, but many people are still borrowing. I think we're just at this bottom level of the housing market. You're usually between 4 and 6 million units selling, and now we're at 4.2 million units. There's just very little demand, but even less inventory. And so that's created a real crunch. The problem for us, obviously, is sales volume. But for buyers, they're still trying to find a place to live, and it's hard to do because there's so few homes for sale.
Meantime, Glenn, you know, the wave of migration that we saw during the pandemic and the effect on cities like Austin and in the Southeast, I just wonder if you're seeing some reversion to the mean on that front, whether that's in rental prices, for example, or even just migration numbers outright?
Rental prices are taking a step back, but very slowly. We have seen just incredibly strong demand for Arizona and Florida. I know it's been over 110 degrees there for a month. Florida's got all sorts of climate-related concerns, especially since insurers are leaving the market. But that's where people want to live. Much of this is just fleeing to lower tax places. That is a long-term trend that isn't going to stop.
So what's going to happen with pricing overall, rentals and sales, which we know the Fed is paying very close attention to and makes up such a big part of CPI?
Well, it's a tale of two markets. So on the purchase side, I don't think prices are going to come down much. Sales volume will. On the rental side, we do expect rents to come down. Vacancies are up. The builders have been very busy creating new apartment buildings that property management companies have to fill. It's been a real challenge for them because household formation, isn't happening the way it used to. More people are living in mom's basement.
So is it changing? But you mentioned that the demographics are changing such that there's going to be demand from younger buyers.
Yeah, well, eventually these baby boomers are going to give up the ghost, sell their homes.
Elon Musk just tweeted about Doge, and Dogecoin is popping right now.
Versus where it was for the baby boomers. Millennials are just not getting into the game because of student loan debt, because the ladder just came up on the housing market at the worst possible time where inventory was low and rates got really high as they came of home buying age.
It's really interesting, all the cross currents happening right now. Fed can't control everything in this market, I think is the bottom line. They try. Glenn, thank you. Glenn Kelman.
Thanks for having me.
Yeah. Thank you.
We want you to control egg prices and the birth rate in this country. Yeah.
Right. Good luck.
That's a big job for a committee. After the break, Carvana surging this morning on the back of that debt restructuring deal. We'll look at that move and the other so-called left for dead stocks that investors are piling back into. Don't go anywhere.
Man, this Carvana is like 28% short. Okay? If they decide to squeeze this thing, it can double. Like it's at 50, so it can go to 100 here. It can double, literally. It's not out of the question. It can get there. It can absolutely get there. We just need a squeeze to happen. Where is Reddit? Where is Wall Street Bet when you need them? Yeah? Anyways, the apes. Dogecoin popping because of Elon's tweet. Meta holding strong. The volatility in coin, it's insane. It's been crazy. Meta's up really nice, man. 330 by the end of the week is very possible here. If we get good earnings, man. Remember, next week is a very important week, okay, for the market, because we have earnings for big tech, and then we have FOMC meeting, decision on the rate hike, which we already know is what, 25 basis point. Now the most important thing is gonna be, are they gonna are they gonna stop after that, or are they gonna keep going? That is the important factor. Do they pause after raising rates in July, or are they gonna keep raising rates? That's gonna be what's gonna move the market. Tesla sharp pullback here. Same for Snow. Let's look at CNBC.
Way as it did a few years ago.
I mean, it does jibe with some of the latest surveys on retail investors and their enthusiasm and how they've been jumping back into the market and they're getting more bullish than they have been. I'm just wondering, you know, the difference between now and then, the private market that you follow so closely, Deirdre, was on fire at that time, and since then has had a bit of a correction. Is there? It does jibe with some of the latest surveys on retail investors.
I mean, the private market usually lags the public market. So
and they're
what we're
getting
seeing
more
right
bullish
now
than
is
they
what many
have
are calling a VC
I'm just wondering,
winter.
you know, the
You're seeing
difference
fundraising really just kind of frees up a lot of startups are having more trouble finding that money, whereas a few years ago, right, there was so much of it. You just had to kind of hold out your hand. It's really the founders that held the power, and the VCs were all vying with each other. Absolutely. I mean, the private market usually lags the public market. So the exception, which I know I talk about a lot, is the generative AI space. You're seeing money fundraising flowing really just kind of frees up a lot of startups. Series A having more trouble finding that money, whereas a few years ago, right, there was so much of it. You just had to kind of hold out your hand. It's really the founders that held the power, and the VCs were all vying with each other in this competition to get into the deals. But it's amazing what you're seeing in public markets. You have to wonder if you're going to see the private markets flowing very freely. You're seeing $100 million Series A rounds, which is very sort of bubblyish territory back in 2021.
But also
the rest
IPOs,
of the
and I wonder if the discussion about exiting is getting a little more traction, at least in the Valley where you are.
Significantly.
A little bit.
But
I mean,
it's amazing what you're seeing in public markets.
Unicorn dinosaurs, because they've just been
the private markets
for so long. I'm talking about
also curious
Stripe,
is, we keep talking about green shoots, we keep hearing about it from
maybe
certain
missed the IPO window a few years
regarding
ago.
M&A, but also IPOs, and I wonder if the discussion about exiting
there's this thinking
is
that
getting
it's
a
going to
little
have to
more
go in the
traction,
next
at least
year
in the
or
Valley
so,
where
and
you
certainly
are.
the public markets
A little bit. I mean, I talk about these companies, I call them
business
unicorn
dinosaurs
because they've just been
really
private for so long.
sexy generative AI business model. This is gig economy, which still is unprofitable in many cases. We don't know what that looks
years
like
ago
with Instacart. And you hear that it's profitable.
Instacart, remember, filed confidentially, and then it pulled.
So there's this thinking that it's going to have to go in the next year or so, and certainly the public markets
will be an interesting
argument
because we know
that
SoftBank and
business model, right?
It's not the, and it does play more
really
into that
splashy, sexy generative AI business model.
All right, Deirdre, thank you. Deirdre Bosa.
Still is
Wall Street is buzzing
in many
about
cases. We don't know what that looks like.
and the FTC.
With Instacart, you hear that
a lot of deal news to get to this morning, including some new regulations that the government has put out.
There's any rush to get these companies out. ARM will be an interesting cast because we know that SoftBank and Masasan wants to get that one out, and it does play more into that generative AI hype cycle.
All right, Deirdre, thank you. Deirdre Bosa. Wall Street is buzzing about Lina Khan and the FTC. A lot of deal news to get to this morning, including some new regulations that the government has put out. We'll tackle that when we come back.
We need to reclaim that 298 level on Tesla here. the market just holding steady here. Not too much crazy moves here. Again, we have big movers tonight. Tesla earnings and Netflix earnings. Next week we have Microsoft, Meta, Amazon, Roku. Just a lot of earnings next week. CMG, which is Chipotle. Google as well. Oh, LRCX. Just massive week next week. It's gonna be a massive week because we also have FOMC meeting. NOW also reports next week. Tesla, man, if we can get 21% margin, okay, we will be golden. This stock will fly. Let's listen to CNBC a little bit here.
I am. But look, let's respect where the market is, right? I mean, I can say that with a chuckle. We can all kind of chuckle and say this market's gone straight up. Did you give the number of days it's gone straight up? I mean, usually you do.
It's like 7 days in a row.
You know, we're up 20% on the S&P 500 year to date. This will give something back. This does not change my overall bullishness on the economy. I am. It doesn't change the fact that the labor market's strong. We've got supply chain onshoring, infrastructure spending, all that sort of stuff. But this market's gone straight up. Did you give the number of days it's gone straight up? It may take as long as September, which is normally a very tricky month. You know, we're up 20% on the S&P 500 year to date. This will give something back. This does not change my overall bullishness on the economy. You say, oh, I'm selling this to buy that. It doesn't change the fact that the labor a little bit of cash here. Supply chain onshoring, I do think it's time to do that. All that sort of stuff. But
we'll talk in
we
a minute
are likely to have a 5 to 7%
one place that you're raising that cash.
You know, it may take as long as September, which is normally a very tricky month, or it may happen before then. But you have to have some dry powder ready when that happens. I hate the thing where you write it down and then you say, oh, I'm selling this to buy that. No, I'm going to raise a little bit of cash here. I do think it's time to do that.
All right, we'll talk in a minute in one place that you're raising that cash. I don't want to do that quite yet.
Much of what has happened,
I mean, your bull case,
right, in terms of the stock market kind of catching up.
5,050.
And I think investors are kind of chasing things here a little bit that have not been invested. I think there's other areas of the market to be invested in as the market begins to broaden out here. Not just financials, not just other cyclicals, not just small cap. We would agree on a short-term and I think the summer months could be bumpy. Remember last August was pretty bad and is already and then heading into the fall. So I think we could get choppy, but
last August was different than this August in terms of sort of where we are in the Fed cycle and what we're potentially thinking the economy could be relative to what we thought it might do almost a year ago.
Yep, exactly.
And
the summer months could be bumpy. Remember last August was an opportunity. I don't think 5 to 7% heading into the fall. So I think we could get choppy, but there's
last August was different than this August in terms of sort of where we are in the Fed cycle and
kind of number one. Number two, I think people are still way too focused on the market
relative
overall
to what we thought it might do.
missing the fact
almost
that
a year ago.
we're in the midst of
exactly.
I think
so
one of
I
the
think that
greatest
we're going to get an opportunity. I don't think 5 to 7%, maybe well over 10 years, because dispersion
an opportunity
in terms
for
of where
stocks are trading on a performance basis, on an earnings basis. Number two, I think people are still way too focused on the market overall. Fundamental bottoms-up stock pickers.
Here we go. Apple races to develop own generative AI tools to catch up with OpenAI, and boom, Apple and there you go. There you go. Apple's just taking off. Apple's just taking off here, and there you go. Right on cue, eh? Wow. If anyone can do it, it's Apple, eh? If anyone can do it, it's Apple. Can we get a Microsoft like surge here? Possibly. But look at that. Look at that rip. Look at that. 200 possible here. 200 on top. Microsoft down on this news. Nvidia also moving up. Nvidia popping on that news. Who else is popping here? Google also dropping on that news. Opportunities. Those are opportunities. Google dumping. Google dumping. Google big dump, man. Let's see. G-O-O-G-O. Google big dump here. If we break 122.49, 118 is possible. I would love to see Google at 118, 120 for earnings next week. I would absolutely get in. But for now, it's dumping. It's dumping. So is Meta. So is Meta. Wow. Apple is just taking off. Apple just taking off here. 200 is possible here. Wow. Look at that rip, man. Look at that rip. Just massive. 200 here. This is the same move we seen yesterday with Microsoft. Literally. We already know if someone can do it, it's probably Apple. If someone can do it, it's probably Apple. Nvidia popping on that news. AMD popping on that news. Google, Meta, Microsoft dumping. Apple GPT. Wow. Apple is developing generative AI tools and an internal chatbot app called Apple GPT that could take on OpenAI and Google. Wow. No wonder Microsoft and Google dump. And if someone can do it, it's Apple for sure. If someone can do it, it's Apple for sure. Man, CNBC is not even talking about this.
Let me be clear about something. And also, look, we have this lingering question about the leadership at the top. I just don't want to be discussing Goldman Sachs personally anymore. Okay? And others can. That's fine. There's plenty of other stocks, Scott, you'll admit. Plenty of other stocks for you and I to discuss that we have a lot of fun with. Let me be clear about one thing. I am not underweighting cyclicals here and overweighting technology. I still believe, and this is to what Jenny said, that the cyclicals, which include financials, which I still have a healthy holding in JP Morgan.
Zero hedge traded. To summarize, Apple just gained $60 billion in market cap because of a report that it is working on something that everyone else is also working on. Insane.
That it's created an internal chat GPT style bot for employees as well.
Here we go. CNBC now talking about it.
Spike in the stock here. As anything related to AI developments is sending pretty much any stock that delivers that kind of news higher in what we're witnessing here. So you're almost $200 a share for Apple, which is up 2%. We'll continue to get more on that.
60 billion.
But I just don't wait any longer to bring you a headline that was moving. You can see the obvious move in the spike in the stock here. In the marketplace, as anything related to AI, it just brings us to pretty much any stock that delivers that kind of news. We're really going to get going. We're witnessing in the next few days. So you're almost $200 a share.
It also turns Nvidia
Apple, which is up 2%. We'll continue to get more on that as we have it. But I didn't want to wait any longer to bring you a headline that was moving the biggest stock by market cap in the marketplace, and it just brings us to what's happening with tech. How we're really going to get going in the next few days.
So I'm watching. It also turns Nvidia. We're going to learn a lot in earnings about what the contribution is in the near term. Listen, but I still think it's an unfolding story over coming quarters. There's optimism surrounding here in the financially strongest global companies in the world that are funding this innovation.
So you got a new high there, obviously, on Apple, which, by the way, gets its price target bumped to 210 today.
Yes, we're going to learn
from
a
Bank of
lot
America.
in
That was, of course, before this news, which has sent the stock up about 2%.
But I still think it's an unfolding story over coming quarters.
You can,
even if there's
let's not go back to Goldman quite yet, but let's continue this AI conversation. And we're going to get Netflix and Tesla. That's really the curtain going up on tech earnings, and they really need to deliver today from Bank of America. That was, of course, before this news, which has sent the stock gone about 2%. Just puts even more pressure on these names. Despite headlines that draw stocks up in a single session.
Goldman quite yet. So, and you got to remember too that I think
conversation
the key thing that
we're going to get
people are
Netflix
missing
and
is
Tesla.
that in the beginning of the year,
the curtain
technology
going up on tech earnings
for 2023
they really need to deliver.
Actually on pace to be below the market. And now all of a sudden they're above the market. So I think people are slow to
just puts even more pressure on these names.
Despite headlines that draw stocks up in a single session. I think so. And you got to remember too that Apple and Microsoft for a long time. The key thing that people are missing is that in the beginning of the year, Scott, technology sector earnings when you have 2023, 2024 are actually 10-15% below the market, and now all of a sudden they're above the market. So I think it's okay to trim back to your core holding. Just fashion. I think number two where you want to be. You want to be in 7 or 8% Apple, 7 or 8% Microsoft. We called Apple and Microsoft for a long time. 10% of your portfolio you want to trim a little bit.
Sure, but here's the problem. I know that, and of course it makes perfect sense as somebody who manages risk and manages portfolios.
A few weeks, it's okay to trim back to your core holding.
In the basket of
just figure out where you want to be.
If they've gone up a lot, maybe it's time to trim, right? You could name 10 names out of tech alone that have gone up a lot.
To trim a little bit.
The risk is if you're in a FOMO market now, where the momentum somebody who actually has some gusto behind it, you trim some of those names, but you have so many earnings, you risk getting left behind as the train goes to the next stop.
But if you're trimming, and you're talking about a 27 to 28% of your portfolios in tech, and you own 4 or 5 of the right names, you are going to outperform because you own the right names,
where the momentum
not because you
actually has some gusto behind it. You trim some of those names ahead of their earnings.
So you can
risk getting left behind as the train goes to the next stop.
But if you're trimming and you're talking about a 27 to 28% of your portfolios in tech, and you own 4 or 5 of the right names, you are going to outperform because you own the right names, not because you own 30 names, and because you own 4 or 5 names in a more concentrated sense. So you can trim on those bigger positions and still win out. But the other thing too is you should be barbelling. You can barbell an NVIDIA with a Cisco, or barbell a higher growth with a more value tech as well.
Strategy for investment.
So I think the market's actually telling you that, Joe, over the last 6 weeks, right? Because especially since in June 1, we've seen participation broadening out, and we've been on record saying I think March, April was a generational opportunity by small cap. I think what's happening is that we're starting to, equity investors are starting to re-engage again. Maverick is re-engaged, so I think through that, they're going to be owning more names. Well, I think the market's actually telling you that, Joe, over the last 6 weeks, right? Because especially since in June 1, we've seen participation broadening out, and we've been on record saying I think March, April was a generational opportunity to buy small cap. No, you don't. That's why I think calling for a blowoff is that we're starting to, equity investors are starting to re-engage again. Maverick is re-engaged, so I think through that, they're going to be owning more names. I still think we're in this big giant secular bull market for the rest of the year. Part of the bull market could be an area that could really outperform. We were very blessed and fortunate to say in November of last year we said October's the low. That's why I think calling for everybody all of a sudden the market's up 20%. We're in a bull market. You call bull markets before they start, not when they've already. This is all about momentum.
It's in the near term. I mean,
it's in the near term, but I still think we're in this big giant secular bull market, and the next part of the bull market actually started in October. And we were very blessed and fortunate to say in November of last year we said October's the low. That's it. Now everybody all of a sudden the market's up 20%. We're in a bull market. You call bull markets before they start, not when they've already happened.
Relatively soon.
But you're only going to get there, Jenny, if areas that have underperformed, like the financials, since we'll go back to the Goldman kind of conversation now,
it almost feels as though at this point it's inevitable.
Some of
these price targets that are sitting
below the 4,500
to 4,600,
if you look at the performance of almost every of the large banks that have reported,
relatively soon.
But you're only going to get every single one of them. If the stocks at least were up on the backside of earnings, whether the earnings were tremendous or not.
We'll go back to the Goldman kind of conversation now.
Hitting the nail on the head, which is like we need that other 492.
We need the other 493
maybe the stocks have
to carry us through this.
If you look at the performance of almost every of the large banks that have reported,
it would be wonderful.
I think almost every single one of them, the stocks at least were up on the backside of earnings, whether the earnings were tremendous or not.
The top 7 or 8 stocks hitting the nail on the head, which is like if the other 492, we need the other 493 to carry us through this earnings season. I think your point, analysts do start to increase their estimates, what I hope for and dream for from this earnings season, and it would be wonderful down 3 to 5% because it comes in
better than feared is still good enough in your view.
If no one has any major blow-ups, I don't think there's any wonderful scenario of earnings that can suddenly raise. I mean, expectations for this year are still at $220 a share.
Like 245 next year.
Your point, analysts, exactly. And you put a 19 times multiple on 245, and you know where you are. You're basically where we are down 3 to 5%. So you need one of two things to prop us higher.
Better than feared is still good enough in your view.
I think so. I think which seems unlikely to get past 245. Scenario or you need a recalibration of valuations. And so expectations for this year's season, $220 a share. Hopefully just puts a floor under where we go. Because exactly. And you put a 19 times multiple on 245, and you know where you are. You're basically where we are here.
But based on, Jim, where we are now, there are those who argue that at 19 times, basically what the S&P 500 is trading at far above its historical average, that it's too rich. That valuations have gotten too stretched based on where earnings are now. Forget about where you think they might. No one really knows where earnings are going to be next year.
You know, our friend
based on, Jim, where we are now, there are those who argue that at 19 times, basically what the S&P 500 is trading at far above its historical average, that it's too rich. That valuations have gotten too stretched based on where earnings are now. Forget about where you think they might. No one really knows where earnings are going to be next year.
But not adding to Microsoft. Our friend Ed Yardeni wrote about this morning, frankly, and this is an unpopular opinion. Strip out the price action today in Apple to what you just reported. And yesterday by Microsoft at 11:30 a.m.
Underweight those top 5%, right?
So let me there's no way.
On that AI headline. Go ahead.
I'm telling you, I don't think that's healthy.
Already own it, but not adding to Microsoft.
And this is based on decades of experience. That is an unpopular opinion.
Looks like.
But
somebody
the price action today in Apple to what you just reported, and yesterday by Microsoft at 11:30 a.m.
Microsoft was up 5%, right?
So today
on that AI headline. Go ahead.
Which is emotional. I'm telling you, it is people just throwing money at the market.
I don't think the market cares at all.
Ultimately, at the end of the day, that is what fundamentals to support. Which is frankly where Jenny and I see 5%.
I don't think the market cares at all about what you're saying right now.
You don't look, Brian, at what's going on, like what Jimmy says, and say
it is FOMO,
it's looking a
which
little
is emotional. It is people just throwing money at the market.
No, it's a little bit too much too fast. But if you sit across
ultimately, at the end of the day, you want fundamentals to support, which is frankly where Jenny and I see a lot of fundamental support,
especially given all the fear in the headlines that are still
you don't look, Brian, at what's going on, like what Jimmy says, and say
the upside from here, at least on a near-term basis, is probably limited.
You don't sound like you do.
But our 50-50 bull case too fast. But with respect to the S&P 500 is looking from a retail and more high net worth client.
So Joe, you own Netflix, right? So we get Netflix tonight.
Especially given all the fear in the headlines that are still massively
really are
predominant.
the starters
we would
of
say
tech,
is
of
that
part of the Magnificent Seven.
Here, at least on a near-term
stocks
basis,
that have really had a
limited,
run
but
here.
our 50-50 bull case,
how good does it have to be?
To the S&P 500
obviously I'm more focused on Netflix. I think,
so Joe, you own Netflix, right? So we get Netflix tonight, we get Tesla tonight. Those really are the starters of tech, part of the Magnificent Seven.
Subscribers for Netflix.
Stocks that have really had a great run here. What are your expectations? How good does it have to be?
Yeah, I mean, obviously I'm more focused on Netflix. I think, certainly relative to the other streaming services, subscriber growth is strong. And I think this is a stock that has reestablished strong momentum. And guess what? It actually is a quality stock because the free cash flow, I think they're going to be satisfied with the content that they're being greeted with. The free cash flow guidance for 2023 tonight, that's going to be incredibly important. Are we talking about $4.5 billion for Netflix? This is a stock that has reestablished strong momentum, and guess what?
Let's not forget it was a $700 stock, right?
It actually is a quality stock.
So,
because the
free
cash flow
so it still has, it's had a great run here, but it's got a long way to go
to
get back to where it was.
That's going to be incredibly important. Are we talking
on these reports
about
tonight
$4.5 billion
for just the sort of general
Netflix?
market perspective?
That was unimaginable.
Even though you don't
3 or
own
4
them.
years ago.
But let's not forget it was a $700 stock, right? Just given where we've gone. So,
and that's where I go to. I really
$475. So it still has, it's had a great run here, but it's got a long way to go
pressure on these stocks.
To get back to,
and we always think
where
about
it
the idea of valuations
is
overshooting the fundamentals.
Let's
just think about
just
Meta,
the sort of general market
which isn't reporting now, but
even though you don't own them,
was 200.
They matter to everything.
It's a
200% just given where we've gone.
Last November. And that's where I go to. I really hope 250%. You said something before. You said where valuations have gotten to puts a lot more pressure on these stocks. And when we always think about the idea of quickly to the upside, valuations overshooting the fundamentals. So let's just think about Meta, as we hear, which isn't reporting now, but Netflix. That Meta, the share prices are in line. It's a 250% increase that's developed, and that they just don't tank. Isn't 250% better. Really ugly. And when you're talking about FOMO, perception cuts both ways. Better. It can drive something up really fast, moves and it can quickly to the upside. I get nervous. And I think that we're I'm on a knife's edge right now. As we hear, valuations on some of these are pretty rich. The share prices are in line, right, with the perception that's developed.
I'm looking at a tweet from our Dom Chu who says
because I think it could get really ugly. And when you're talking about FOMO,
implied stock price moves post earnings
it can drive something up really fast,
pricing for
and it can
Netflix
tank something really
plus
fast
or minus 8.5%.
And I think that we're kind of on a knife's edge right now.
It's a plus or minus 6.8.
Valuations on some of these are pretty rich.
It's going to be exciting to see the results and see moves. One way or the other. I'm looking at a tweet from our Dom Chu who says
let's take a quick break. When we come back, what one of our committee members calls
stock price moves
sleeping giant. We're going to run through a few catalysts that could wake one legacy
plus
tech
or minus
stock
8.5%.
Jenny owns it. We're back
for Tesla,
on the half
it's
in just
plus
2.
or minus 6.8.
So Apple employees say the company's tool, which is Apple GPT, essentially replicates Bard, which is Google's chatbot, and ChatGPT and Bing AI. Bing AI is Microsoft chatbot, and doesn't include any novel features or technology. So Apple employees say the company's tool essentially replicates Bard, ChatGPT, and Bing AI, and doesn't include any novel features or technology. But yet, $60 billion just added in the market cap. Well, not anymore because it's selling off, but Apple's selling off hard. And that's because they do not have those they don't have the what you call it. They don't have the service yet. They don't have the chatbot yet. They're building it, but they don't have it yet.
Work with GPT-4 that power incredible capabilities, and then companies will take those foundational models and they'll do their own training. They'll do their own special capabilities for their applications. We'll enable those in Bing Chat for everybody through our plugin system. Think of it as like having skills in the AI. So that's kind of how it'll work.
Less than a minute left. I've got to ask you, what do you think about the news that Apple's in on the game of generative AI with Ajax?
Well, you know, look, it's just such a hot area. People have to get after it. It doesn't surprise me that companies like Apple want to get in there. You know, we've been at it for multiple years. We have a very unique lead with GPT-4, with our role in the enterprise, and you know, the excitement of people wanting to go do that work on Windows. And yesterday's announcements with support for Meta's Llama on Azure really speak to the unique leadership role that we're playing right now.
Love to have you back to talk source models versus. Bloomberg Technology.
Well, the software segment's 28% of their business. So that's great, but it's not like a total game changer. AI and Watson, the data and AI segment is 25% of their business. So if that grows a little bit more, that's great. To me, this is a sustainable company with sustainable earnings. And the only thing I worry about here is that if management tries to get on the like, holy smokes, all you need to do is say and goose AI, and then the share price goes up like 30 or 50 or 60%, I hope that that doesn't happen, because I would much rather own a company with a reasonable valuation, with a 5% and change dividend yield that can provide me reasonable, sustainable growth where I don't then need to ride an emotional roller coaster and make short-term decisions. I don't think they will, but just everything we see here is incrementally positive. We've seen that for the past couple years, frankly, and I expect it to continue.
You got to believe, Christina, that they're going to talk about Watson X, right, as it relates to AI and what this company's ambitions are when everybody else is making leaps ahead.
The interesting thing is that IBM is not going after competing Microsoft with ChatGPT or Bard with Google. Instead, it's going to cater to the B2B business. So this is a strong point for them. They're going to go after a smaller market. To Jenny's point, though, the way that you're arguing your call for this, it seems like you're pretty defensive. You're talking about growth, but you're pretty much laying out, a strong dividend yield, a strong free cash flow, and the money that is there and reoccurring revenue. But overall, what is the growth potential for this company if both of these streams, whether it be Watson, whether it be Apptio, whether it be Red Hat, if none of those three come through, where's the growth for IBM?
I don't know. I mean, historically, they've grown collectively, right? If you look at the different segments, you've got software that grew in the 8% range. You have infrastructure that was 10. Other parts lag, but collectively, it's like a high single-digit growth rate. So I don't know, and you might know it better than I do, Christina, on where the growth, what drives the growth. But I think they just incrementally, like one works, one doesn't. The AI doesn't need to be the winner-take-all kind of perception that NVIDIA had. It can just be, hey, this is good for B2B. That's going to incrementally grow revenues. I don't think it needs to be home run hitting. I think they can hit singles and doubles. There's no expectations in the share price.
Exactly. So then we won't see much movement then.
Okay, but in this market, if I can get on average a 5% yield and, I don't know, 5% growth on the share price over the next year because they're incrementally adding, that works for me as an investor. It's not greedy, it's sustainable. I don't need a plus 80 or 100% move in the shares.
That's Christina? True. A defensive play. No, you're describing a defensive play right there. And if we think that there's going to be some more turbulence in the market, why not own IBM with that dividend yield of 4.91%?
Yeah, well, let's see what happens with the earnings. We'll be paying attention to those as well. Thank you so much, Christina Partsinevelos, for that. We appreciate it. Other legacy, quote-unquote, legacy tech names. Cisco upgraded today. JP Morgan. Jimmy, you used to own IBM, right? Until you couldn't take it anymore.
Well, we have different objectives, right?
I couldn't take it anymore.
You do own Cisco and you do own Qualcomm, which was added to JP Morgan's analyst focus list today. The price target raised to 159 from 145. That's on QCOM, the bottom there.
Yeah, different companies, of course, but you're right to call them legacy tech. I would also call them value tech, which is just to say that they have very forgiving valuations.
Apple just dumped the market
in part
here
because of a lot of doubts over the last year or so about their businesses. Qualcomm, its smartphone sales that have underwhelmed for the last year and a half. That is likely to come out of its trough. It's overdue to come out of its trough. The analyst talks about China perhaps picking up smartphone sales, but globally there's reason to think that you can only go so long without upgrading your phone and that the cycle's about to turn up. Even if it doesn't, they've got a very good automotive business, a good Internet of Technology business, and the valuation, again, very forgiving, both from an earnings basis, a PEG ratio basis, good dividend yield. So this is very similar to your IBM in that regard. I think this is just a very easy stock to own at this point.
Joe T, you got Cisco in the Joe T.
Yeah, and that has of the legacy, the value tech, I think that has the highest probability of building momentum and moving forward. Fundamentally, orders increased in the prior quarter, but it seems to be all kind of tracking the opportunity that occurred from Oracle. Think about Oracle and what we used to talk about Oracle as, which was more a legacy tech, a value tech, and now we've seen a significant rise in Oracle. So can it follow that trajectory? Cisco, to me, has the highest probability of doing that. What's interesting is when we talk about IBM and think about Warren Buffett stepping away from it, where did he step towards? He stepped towards HPQ. They have 12% ownership, which is the largest ownership in that stock, and that stock's been moving higher.
Belsky? You own Cisco, right?
I own Cisco in 3 portfolios. I'm gonna
and
trademark
Qualcomm?
And Qualcomm in 3 portfolios. I'm gonna trademark a phrase. They're Jenny Tech. That's what they. They're Jenny Tech.
I like it. I like it.
Cisco's a dividend growth monster. Cash flow yields above the dividend yield, positive earnings growth. Who would have ever thought 20 years ago would be talking about John Chambers and go Cisco? Now all of a sudden it's a cash flow and dividend machine.
It's just a flat out anti-recession play. It really is that simple.
Cisco?
Cisco, it's enterprise spending. Everybody sold this stock in the last year because enterprise spending is going to go down in a recession. Guess what? If you don't have a recession, what happens to enterprise spending? It's really that simple.
Okay. Pippa Stevens has the headlines for us. Hi, Pippa.
Hey, Scott. Russia launched its second consecutive air attack on the Ukrainian port of Odessa. A Ukrainian official described the attack as hellish, but said the port will continue exporting grain. The attack supports Russia's retaliation pledge for the Crimea bridge explosion, an offense Russia says was led by Ukraine. U.S. climate envoy John Kerry met with Chinese officials to restart climate talks. The U.S. and China are both experiencing scorching summers, with China hitting record temperatures. Kerry's trip focused on issues like deforestation and reducing methane emissions. He emphasized the importance of climate cooperation between the two countries, something that was once a bright spot in U.S.-China diplomacy. And Israeli President Isaac Herzog addressing Congress in the last hour amid tension with some progressive Democrats who did not back a resolution declaring strong support for Israel. Herzog called the U.S. Israel's greatest partner and friend. Herzog and Vice President Kamala Harris are
experience. What I think Linda Yaccarino said that she's trying to do, and indeed what Elon Musk has said that he's trying to do, is go for this policy of freedom of speech, not reach, and not a new idea, but implemented at Twitter in such a way that the posts themselves may remain on the platform, but they're focused on reducing the reach of those posts and reducing how many people see them. And one big initiative from Yaccarino's camp is to try to improve the adjacency of those bad tweets to advertiser content and give advertisers the option to say, I don't want to show my company's tweets next to this kind of content. So, you know, we've heard from them that there's been some uptake on that offer, that some advertisers are signing up for it. From our sources internally, we've heard that, and I think that shows some progress. But it's like, as our story demonstrates, it's going to be a very long road ahead. Twitter is still down 50% in advertising since Musk took over, and they're still cash flow negative. So there's a lot of work to be done.
We'll keep an eye. We understand that in the next 2 weeks, they're going to be further expanding their ad placement controls to better support the growth of video consumption on the platform. Sarah Fryer, just great reporting across the board. Thank you for articulating all of the shifts going on when it comes to Twitter. And let's talk about the rest of the world of social media, because, well, TikTok, we understand, isn't fully compliant with upcoming European Union rules governing content, surprisingly, according, of course, to the results of a test conducted by the Block's governing body. Pleased to talk us through it is Alex Barinka. And boy, we were just hearing about the trials and tribulations of your Twitter, and of course, well, TikTok has long been unfocused of the EU in particular, because it's got itself got to get ready for some new digital act coming into place.
Over 230 million.
Absolutely, and to be clear, this is a voluntary stress test that happened on Monday. TikTok invited in the regulator who will be overseeing these new rules that go into play on September 1st, and said, hey, take a look at what we're doing now, take a look at our content moderation policies, our data privacy and sharing practices, how much illegal content we have or hopefully don't have. And the commissioner came out after that and said, TikTok, you're still not doing enough. More needs to be done to get you up to snuff, but the rules aren't in play yet. I will say, Caroline, this is a really interesting change in tone. The commissioner, Thierry Breton, actually had some words about TikTok in January, saying that the illegal, dangerous content on the platform
platform was unacceptable. And this week, you see him actually applauding the social media platform for going through this voluntary test, for spending on improving the platform. So it's not quite a full thumbs up for the rules that will come into play in September. But, you know, it is an interesting kind of reveal of what to expect from TikTok, that they're perhaps inching closer, though they still have some more room to run.
That's such a good point, given, you know, the tough space that TikTok has been in the EU and the US, of many considering not only some of the content and the impacts on mental health and the like, but also ultimately its ownership, right? And I'm interested as to whether you think that's the pendulum that's shifting in any way.
I think so, because the absolutely, and you know, with the ownership, TikTok is owned by ByteDance. It's a Chinese company that has proliferated these concerns across, as you mentioned, the EU and the US, with questions of whether or not the Chinese government could unduly influence what you see on TikTok, the algorithm, because it has that Chinese ownership. Now, this DSA really has to do with content moderation, so absolutely, kind of the EU regulator looking under the hood and looking for any concerns around anything that's untoward definitely plays into that. TikTok is also doing something very similar called Project Clover in the EU that is doing here in the States under Project Texas. They're saying they're actually going to bring all of the data for users in the block to servers that exist in the EU to kind of cordon off or wall off any potential sensitive information from both their Chinese owner and any influence the Chinese government might have on ByteDance. So certainly this is an added pressure on TikTok that a lot of the other tech firms that do have to comply with these new EU regulations are not necessarily having to deal with.
Great analysis from Alex Brinker. Thank you so much for bringing that story across the world when it comes to social media. Meanwhile, coming up, we're going around the world in terms of tech and art. The auction house, Christie's, is kicking off its Art and Tech Summit right here in New York. We'll discuss with the head of its venture arm about all things art, technology, and investing. That's next. This is
the trade we put on was the 45-48. It's in the money on that. So when you play for movement like that, so Tom, I think that this is a massive tone-changing potential for the overall market in general. So what I want to do, this is going to be a big testing point for these other stocks that are coming out. It's in the money. What I did on that long iron condor, Tom, I went out play for movement all the way till July 28th. So I went out a little further. I think that this is a massive 520 changing vertical potential for the overall market in general. So what I want to do, this is going to be a big testing point for these other stocks that are coming out. So what I did, long iron condor, Tom, I went out, though it's not cheap, all the way till July 28th. So I went out a little further. If you get a move in either direction, like you did in Carvana, I think movement here until this market tells you different. 510, you got to play 520, call vertical if you want. But the 450, if you don't want to, 440, put in. This is not the play for you. Wide, but spending this gives you a chance to basically almost double your money. But the risk is 550. Remember, but if you get a move in either direction, like you did in Carvana, you can make 450. I think movement here gives you a chance. This market tells you different. To pick which way it goes, Tom. You got to play flat if you want. In terms of delta, it's about one delta, and this is not the play for you. It's a little skewed, but this gives you a chance to basically almost double your money. I want to play for both sides. If I'm going to play, I want to play for, like I said, a week and a half.
Yeah, and this one definitely takes advantage of that. Let's break it down. July 28th weekly series. I have to pick which way it goes, Tom. It's a 9-day sell expiration, so you get that extra week. It's not a pure earnings play here. Buying the 510 call, selling the 520 call, buying the 450 put, selling the 440 put, 550 debit. There's your risk, $550. This one definitely takes advantage of that. Let's break it down. July 28th weekly series. 450 on the downside expiration. So you get that extra week. It's not a pure earnings play here. For your break buying the 510, anything in between there, selling the 520 over the next 9 days. Buying the 450 put, selling the 440 your potential win on this one is outside of those $50 per spread, or the 440 where you want to move outside of $450 per spread. 50 on the downside, priced in over $40 move on the either way for the shares margin of break evens, anything in between 1 or 2 standard deviation moves in the stock post-earnings.
I still have emotional scars from the NVIDIA
Your potential
double
win on
calendar
this one
that
is
we put
outside
on
of
last
those
quarter,
520 strike or the 440 where you can profit $450 per spread. Option market kept pricing in over a $40 move either way in the shares, and we've seen bigger than 1 or 2 standard deviation moves in the stock post-earnings.
I still have emotional scars from the NVIDIA double calendar that we put on
Expectations
last
pretty
quarter
high so
that
far in
just
Netflix, but a good look at a long iron condor playing for a move over the next week and a half. All right, let's take a quick break. When we come back, we're going to talk another earnings stock, and that's IBM, Big Blue, underperforming the overall market. They report earnings after the close. Need that move. This one, Kevin, expectations pretty high so far in Netflix, but a good look at a long iron condor playing for a move over the next week and a half. All right, let's take a quick break. When we come back, we're going to talk another earnings stock, and that's IBM, Big Blue, underperforming the overall market.
Back for its 7th edition now, highlighting the latest impact of AI, fintech, Web3, blockchain on the art world, as well as that intersection of luxury, fashion, and tech, and much more to be discussed. Christie's, in fact, was the first auction house, if you remember, to register a sale on a blockchain platform. It wants to stay abreast of innovation in the art world, and one way of doing that is through its VC arm, Christie's Ventures. So today, Venture Spotlight is all about Christie's Venture Global Head, Devang Thakur, who's joining us. And Devang, first and foremost, what is Christie's Ventures?
I don't think thank you for having me. I think Christie's Ventures is our effort at trying to put our investments where our intent is. Right? We've been in the art world for 257 years. We've seen technology pass through these doors and doors across our 46 different offices for centuries. And we've had founders, creators, influencers tell us about everything they were building. That's deal flow. That's what venture capital is all about. And especially after the Beeple auction in 2021, we had everyone who was building anything sending us pitch decks, sending us information about how cool their product was versus all the other products. And I just thought that was the right moment for the first time in our history where Christie's was recognized as someone who was adopting technology at its very earliest stage. And so the venture capital arm allows us to capitalize on some of those deals and really invest in companies that come across our desk.
Well, I'm pretty sure post-Beeple, Web3 became a really focal point, but we were just looking at some of your portfolio companies there, and there's also holographic technology. What are the other intersections that you feel really benefit Christie's?
Yeah, we have 4 pillars that we look at from Christie's Ventures' vantage point. One, as you mentioned, holograms. We look at hardware that helps people consume art better wherever they are in the globe. So holograms is a way we've replicated masterpiece objects like Degas and Giacometti's in photorealistic fashions and holograms.
Before we take a look at IBM ahead of earnings, let's bring in Ben Lichtenstein, Senior Futures Contributor here on the network.
Mostly focused on fundamental picks and shovels sort of investments. So you've looked at a company that we work with called Manifold Technologies that helped us. Christie's built our own on-chain auction platform that we use today. We're looking at AI and data because, again, with 300 years of being in business, we have tremendous amounts of data and knowledge that we can encapsulate. And finally, fintech. People think buy now, pay later is a huge innovation, which it is, but we've been doing that since the dawn of Christie's. People do buy paintings and pay over time. So from the consumer point of view, we look at these 4 pillars and others as technology evolves around us.
What's so interesting, we go back to those heady days of 2021 when Beeple's NFT reached 69 million, and we all just sat up and sort of gasped. And now the world is very different. NFT prices have plummeted. You are all about creating value, continuing value. And when you see companies, interestingly, what Gucci's going to be at your event later today, the summit, how are brands thinking about Web3 and NFTs as something that isn't losing value but can actually build loyalty?
No, I think that's a great question. I think when people came about, I think the interest levels just skyrocketed.
Yeah,
and I think over the last
higher, Ben,
6, 7, 9 months, they've sort of stabilized. When you look at the overall crypto ecosystem, things have stabilized at a level, whether this is the new level or not, I'm not the expert at it. But in terms of brands, I think brands have found this as a new way to engage communities, whether it's the communities that follow artists, whether the communities that follow certain tech trend. And I think brands have to keep themselves innovative as they have sort of evolve themselves. They can't maintain status quo. So I think this technology specifically allows them to evolve with the trends in the market. And that's how I see brands using them. And I think this Gucci auction is an example where they're working directly with artists to curate a very fashion-forward sale called Future Frequencies, where artists are exploring generative art and generative AI and as it would apply to fashion. So I think the intersection is quite interesting there.
Let's talk about that, the generative AI element, because well, there must also, as much as there's interest, there must be quite a bit of fear. We think of people worrying about copyright, we think about artists and authors and those that are creating, ultimately worried about the democratization of their workspace. How is this something Christie is thinking?
All right, thanks to Ben Lichtenstein.
I think that's also a great question. AI, or whether it's the ethics around using other people's sort of content.
AI, because there's a lot that's going on right now, but it does not mean that the person or the company that is leading the market right now is going to be leader in the next 5 to 10 years. We have IBM, we actually have an implied move for this stock at around 3.6%. The market is looking at revenue coming in at $15.58 billion. That's going to be a slight increase on a year-over-year basis. But when you're actually looking at the earnings per share estimate from FactSet right now, it's
the companies you invest in. Where are they being built? How international are you?
Yeah, no, we have companies from Vancouver, Canada to Australia, so we're covering the entire spectrum of the globe.
Great to have some time with you. I'll catch up with you later. Devang Thakur, of course, Christie's Venture Global Head, talking about that key art and tech summit right here in New York. From New York, this is Bloomberg Technology.
AI. So we're going to get an update here today to see if what the progress is for that particular initiative. We also want to get some updates when it comes to some of the product offerings, like they announced at their Think conference that they are launching Watson X, which is going to be another AI-powered platform here. It's going to offer several different areas so we're going to get an update here today. Data management, trying to be able to provide for that particular initiative. We also want to get some updates when it comes to some of the product offerings. The one that I'm actually looking forward to is the GPU as a service. Now, this is Watson X, which is going to be another AI cloud service provider here. Being able to provide the GPUs to be able to focus on necessary for companies data management, trying to be able to provide large language models or these AI models, which requires a lot of resources. So that platform, and the one that I'm actually really looking forward to is the GPU as a service. Now, this is something that is going to be a highlight for a lot of cloud service providers, being able to provide the GPUs or the infrastructure necessary for companies to be able to train these large language models or these AI models, which requires a lot of resources. So that could be something that could be a revenue generator for them here in the near term. So that's what we are looking at when it comes to the earnings announcement. Once again, you kind of talked about the stock performance has not been great, but it's also low beta. So that's also an area where somebody may find it to be appropriate for their portfolio if they're trying to have low beta stocks to have some exposure to technology.
Yeah, nearly a 5% dividend yield also on this one going into this report. They got to do something. AI, they're working on it. So maybe if they say it enough times in their conference call, that'll be a bonus. All right, thanks to Kevin Green, senior markets correspondent here, breaking down IBM for us. Kev, your thoughts real quick here on Big Blue.
I think they've made the decision not to compete with really Amazon and Microsoft in terms of public cloud.
Yeah.
They're going with Red Hat, and they're going a different direction and trying to carve out their little niche. I think that's the key to this company. Yeah, you can't argue with the dividend yield if they pay it. You can't argue that this company is higher over the last 20 years, but it also got up to $206, and now it's $135.
Yeah.
So I put out a 20-year chart. If you look at it, it's higher, but not great.
Yeah.
So All things considered, like I said, I think the key to the earnings is Red Hat and what they're doing with that private and public cloud, that kind of in the middle there.
Yeah, they did announce at the end of June they acquired software company Apptio for $4.6 billion to kind of expand their cloud-based offerings at this point. So we'll have to hybrid cloud offerings at this point, and their consulting. We'll have to look at clarity on that. But I looked at a strategy here, Kev, because the stock is down, 3.7% so far this year. Looked at a call diagonal in here to take advantage of the higher implied volatility in the near term. July 21st monthly cycle, about a 65% aggregate implied volatility. And then out in August, 30 days from expiration, it's down to about 26. So you've got the big divergence. So we looked at buying the August 18th 135 strike call, selling the July 21st monthlies, the 141 calls. You're paying roughly about a $2.90 debit, Kev. That's your risk on a $6 wide call diagonal. So anything above that break even, which is about or near 134, is profitability on this one, and it takes advantage of that divergence, Kevin, in implied vol.
And remember, the difference between August 18th and July 21st is about a month. It's 4 weeks, which will give you more opportunities to chip away at that net debit and therefore chip away at the break even on this spread. So you do have some time. You got nice data coming out the rest of this week, but this is a bullish play. It's about 31 deltas.
Yeah, and it's about that one standard deviation move to the upside, that where that 141 strike is at this point. Kevin, and you mentioned that as we get closer to July 21st expiration this Friday in just 2 days, you'll have that ability to roll or adjust that short call, creating credits, which would reduce your break even, increase potential profitability if the market's open and liquidity is provided. So you do have some opportunities for trade management on this one. Kev, final thoughts. We've got big earnings coming up today. This could be a pivotal afternoon after the close.
This afternoon's a tone changer, I think, for the market, potential tone changer. And here's my question. Do the 7 stocks that have led this market, or 8, whatever you want to call it, do they move as a sector? If one's weak or 2 weak, are all the rest weak? Right. And that's why you got to watch Netflix and Tesla. It's like a new chapter in this earnings season.
Yeah, and going back to that example trade that we did in IBM, that bullish call diagonal, 290 debit, that's your risk on that particular position. But good outlook for today's show on those earnings after the close. It's going to be highly watched. And that's going to do it for Kevin and I today here on Fast Market. But stick around. Next Gen Investing is coming up.
Many traders may be willing to take on additional risk in pursuit of aggressive growth in their portfolio. More power to them. But if you're looking for a less risky alternative, you might want to consider checking out our income investing course. In the income investing course, you'll explore investing strategies designed to generate regular income and preserve capital. First, we'll delve into risk and return preferences. You will learn about the different ways to allocate a portfolio and create a payment schedule. Then we'll take a deep dive into the assets commonly held in income.
By chatting directly with an education coach. It's interactive learning at its finest.
Tune in live or watch on demand.
TD Ameritrade Network has arrived on the floor of the New York Stock Exchange, bringing you real-time market coverage and access to the biggest newsmakers on Wall Street. Don't miss Trading 360 and the Watch List live from the New York Stock Exchange.
Thinkorswim by TD Ameritrade is more than a trading platform. It's an entire trading experience. With innovation that lets you customize interfaces, charts, and orders to your style of trading. Personalized education to expand your perspective, and a dedicated trade desk of expert-level support that will push you to be even better and just might change how you trade forever. Because once you experience Thinkorswim by TD Ameritrade, there's no going back.
Whether you're an experienced investor or just getting started, TD Ameritrade offers a webcast that's right for you. Are you an active trader? Our Active Trading webcast series is designed to help you develop a deeper understanding of technical analysis, options, futures, and more. Best of all, you can ask questions by chatting directly with an education coach. It's interactive learning at its finest. Tune in live or watch on demand. Head over to tdameritrade.com/webcasts and start learning today.
Welcome to Next Gen Investing. I'm Jenny Horn alongside Alex Coffey. And Alex, each day of this week, we've seen pretty strong markets really across the board here. NASDAQ starting to slip in real time, but we also have some pretty major catalysts today after the closing bell, those being Tesla as well as Netflix's earnings. So while I do think things are more muted compared to some of the upside activity we've seen in the last two sessions, still another green day here.
It really is, and you know, a lot of the score will be settled this afternoon in terms of how today ultimately shapes up. This is it. This is what kicks things off. Tesla, Netflix, they really set the tone for what the big part of earnings season is. I know we get like the appetizers in the big banks. They're interesting, they're first, but the real movers are the Teslas of the world, the Apples of the world, the Netflixes of the world. So I'm excited.
I'm excited as well, and at least we already have Tesla second quarter deliveries, but Netflix I feel like will be the interesting one given so many of these structural changes they've really made to their business. But as always on this show here, we'll kick things off with our upvote and downvote segment. Following that, we will chart and trade those upvotes. Our FOMO discussion is a name making a huge move to the upside. That's Carvana after they disclosed their second quarter results earlier than the street had been expecting. And then we will look at the ways that summer travel is keeping Airbnb strong with shares touching new 52-week highs earlier in today's session. And last but not least, we will look at one name that is moving to the downside and pretty significantly here, Toast tumbling after removing its order processing fee from its online channels and clearly not read as a positive among street analysts.
Yeah, looking forward to that conversation with Jeff Pierce. It's a company we've talked about fairly frequently in the last few weeks with George Tillis and on other parts of our show. So we'll see what the latest is and what's behind that move. Looking forward to the Carvana conversation. As always, one of our favorites here to discuss on the show, and what an incredible move once again for the car retailer. And then, of course, upvote, downvote, where we're going to kick things off. Not endorsements, not recommendations. This list is on here for a reason. They all have stories behind them. But one of the stories we're going to get to a few names in really threw a wrench in today's trading.
Yeah, I know which name you're talking about. Well, we'll start things off here with Microsoft, which did close at new all-time highs in Tuesday's session. Although we are seeing shares down 1.3%. And we have seen some pretty good news. They did add this Copilot offering, which does offer a $30 fee for its customers. In terms of its AI capabilities, the company did also share a significant update to its Bing AI chatbot that would be offering Meta Platform's new large language model to its Azure customers. Analysts, though, following this update we got yesterday, are turning more bullish on Microsoft, despite today's price activity, of course. Following this news, we did see a handful of these street price target adjustments to the upside from what I could see, as the company only continues to solidify its dominance in the AI space. We see how JP Morgan with an overweight raising its price target to $385 a share from $350, reaffirming their extremely bullish outlier viewpoint on generative AI. And they said they would walk away incrementally positive on Microsoft's category leadership in AI, which they believe has reached escape velocity in this market. Atlantic Equities raised its price target to $400 a share from $330. Bank of America $405 from $340, reflecting nearly 13% upside from where we closed on Tuesday. This name, though, I was actually shocked to see when taking the average among the analysts covering it. Price target is right now around $352 a share. It's slightly $2 below where we're currently trading, but also well below a lot of those price targets I just listed. I mean, $400 on average was the price target I could see that was updated today among several analysts. So these analysts are perhaps optimistic, but that doesn't mean that all analysts are as enthusiastic about Microsoft's 12-month story.
Or some of them are maybe just waiting on the sidelines till either after earnings or right before, as that's on the horizon. Maybe we'll get some updates. But really, really strong year so far for Microsoft. Stock was trading, let's call it, just under 360. There was breaking news that we're going to get to again in just a minute or two. That really impacted this stock about an hour ago. But all of these stories, all of this optimism was good for a little bit better than unchanged. The breaking news really changed the story as the stock's down now 1.3%. Next one on the list, though, is ServiceNow. Talk to me about this one here, Jenny, because this one's still holding on to a relatively okay session thus far.
It is. It actually did touch 52-week highs earlier in the session. And another name that has a ton of analyst news today, Barclays raising its price target to $646 from $559. Also keeping an overweight rating, saying that the second quarter results for a lot of these software names will not be major catalysts, given that second quarter is the last round of some of these bottoms in terms of comparisons in the past quarters. And they do see now, in terms of going ahead, they see their cloud optimizations visible at full force. However, they said third quarter guidance and implied fourth quarter guidance could be more interesting, as Barclays reseller survey does show a potential uptick for the second half of this year. B of A also raising its price target today to $700 a share, which is obviously significant to where we're currently trading, but kept a buy rating, continues to identify this name as a top pick, which I had to include. Alex, I know you love those buzzwords.
Oh, yeah.
And TD Cowen also with a $650 price target from $530, keeping an outperform rating on shares, saying that their survey checks do show the average 2023 growth outlook saw a nice uptick from 14 to 20%, which suggests that partners see a strong but more back-end loaded year. So a lot of this sentiment is something we've heard with some of these software and tech exposed names, that back half of this year is expected to pick up. Perhaps we've reached a bottom. We will, of course, have to wait and see, but this name does report its second quarter earnings July 26th after the closing bell.
And as the NASDAQ got a little bit wobbly about an hour and a half ago, we also saw this stock lose a lot of its intraday gains. As you mentioned, it did get up to $614 a share, about almost 2.5% higher than where it currently is. So certainly some market weakness in the tech space weighing on an intraday. Doesn't hold back the fact that a lot of positive news catalysts today that were influencing it earlier this morning. All right, let's get to the breaking news story. I know it's not that breaking at this point now. It's been about an hour since this news broke. To me, this doesn't seem like a surprise, but the market's treating it like a major surprise.
Right. I mean, to me, this was only a matter of time. I feel like I was just waiting for this headline to come out, but we are seeing shares of Apple now rising only about 0.5%. But we got this Bloomberg report that the tech giant is quietly working on an AI tool that could challenge OpenAI, while adding that the company has yet to devise a clear strategy for releasing this technology to its consumers. Apple has built its own framework to create large language models models, according to people that are familiar with the matter that did report this to Bloomberg. With that foundation, which is known as AJAX, I think it's being pronounced, it's AJAX. Apple has also created a chatbot service that some engineers are calling the Apple GPT. Now, the AI push has become this major effort for Apple in most recent months, with many collaborating on the project, but we haven't really gotten any updates until obviously today. So while this is not making a major splash for Apple shares, who it is impacting is Microsoft. Alex, I was talking this name less than an hour ago. It was unchanged on the session, and now, like we just discussed, now lower, so completely brushing off all of its positive analyst momentum, and it does seem like Microsoft's a little bit concerned because Apple is not a competitor you want to face.
Yeah, I'm going to call it AJAX just because that's how it's spelled, but huge move initially. Obviously, ripple effects across sort of the AI names that were understood to be where they were in the space. And as you said, this welcoming hasn't been so exciting, I think, to the AI world, but I don't think Microsoft's surprised that Apple's working on this, and quite frankly, that probably was the best kept secret. I mean, this again isn't a surprise to me. We have a little bit more details than we probably did before this. We got a name, we got confirmation that these projects are being worked on, but did anybody really think Apple wasn't working on something? To me, that would be kind of ludicrous. So we got a little bit more details. It's out there now. Initial reaction was a huge pop in Apple shares, because bear in mind, Jenny, every time Apple moves $1, it's almost $16 billion in market cap. So if it moves $5, $6, I mean, you're talking about sizable market cap creation. So huge move. It's been an awesome year for Apple. Seems like every year is an awesome year for Apple, at least over the last 10 or so years. That's been the case. But wasn't a lot of staying power intraday. And I think that goes to show that, you know, some of this AI hype still there, still real, but it's not at this fever pitch that it was in, let's call it, January, February, March of this year.
Yeah, and I think that feels like it's coming down a little bit, but I think it's a good thing because there was so much excitement, so much enthusiasm. Names were making monster moves. I think it's almost refreshing to see Apple just with a 0.5% gain, that we're not seeing some crazy upside, because this is still a company that is so massive. Its framework is so much beyond its AI push here, because this is just, Apple's a behemoth, and one of the only names that we really discussed that's at its all-time highs pretty much. Our last name today, though, is Cinemark, and it wouldn't be a show this week, Alex, if at some point we didn't discuss movie theaters and, of course, the long-awaited release of some of these major titles this weekend. But Cinemark, with some negative news today, although completely brushing off any pessimism here, as we did see JP Morgan downgrade shares to neutral from overweight due to concerns about these Hollywood strikes. They did also establish a December of 2024 price target of $18 a share. That's below its December of 2023 target at around $21. They said their prior upgrade of Cinemark really suggests that shares back in January were largely predicated on an increasing film supply driven by this higher domestic box office. While they do think the industry has demonstrated an ability to run at about $8.5 to $9 billion of gross revenue, they estimate that further improvement will require more wide releases, and did warn of the strike's impact, basically already shutting down several movies that are slated for the release in the second half of 2024. And absent a resolution, they expect this strike will remain an overhang on Cinemark shares. They also said, and I thought this was interesting, that to limit upside potential regardless of whether the box office does outperform near term, with, of course, Barbie and Oppenheimer releasing this weekend, or even the company posting better than expected results. So they see this strike as a more major catalyst than any near-term benefit to this name, which is pretty interesting. Now, Cinemark has had a pretty nice year. It's up 71%. It's up almost 80% off its 52-week low. Still well off of its high, and it's come down over the last month. It's down about 10% for the month now.
You know, looking back in time, before the pandemic seems like an eternity ago, but these names weren't doing that well. These movie theater names weren't doing that well prior to the pandemic. This wasn't as economical as it had been in years past. They weren't thriving companies. They got through into this world-changing kind of time where no one went to movies at all for what seems like years. And then we had to see movies, so they came out at home. We say this every time, Jenny, but once you change behavior, it's very difficult to kind of put, the toothpaste back in the tube, if you will. And so, we used to drive to drive-in movie theaters. I mean, it's kind of a novelty. I think there is some places, but it's seen as kind of old-fashioned. Like, you do that because it's kind of fun and interesting. Once you can watch them at home, you kind of don't really want to go to the movie theater. I know there's movie buffs who are going to feel differently. It's the same way, that you have, fans of things that are never going to change. But the masses aren't going back to movie theaters. We're just not seeing it in the box office numbers. So, they got to figure something out because they were struggling before, and now behavior's changed. So I think that these are companies that are quite interesting to kind of watch unfold, but there's a reason AMC was a meme stock. It's a company that a lot of people bet against. So Cinemark not that far different than a company like AMC. But let's do our best to narrow these down. I don't think it's that difficult today. There's one key story, and there's two companies that are related to the story, so I think it's quite simple.
And two that are part of the Elite 8 that Tom is calling it. I thought it was the Magnificent 7, which I think I like actually Elite 8 better. So that those upvotes today, those being Microsoft as well as Apple. Two stories that are connected and two names that have been quite solid performers on a year-to-date basis and really over the last decades. We'll be diving more into the technicals on both of these names as well as some example trades. Stick around. Next Gen Investing. We'll be right back.
Whether you're an experienced investor or just getting started, TD Ameritrade offers a webcast that's right for you. The Platform Demo webcast series is designed to help you broaden your knowledge of tools and resources available from TD Ameritrade. You'll learn tips and tricks to help navigate tdameritrade.com, Thinkorswim, and mobile-based platforms. Best of all, you can ask questions by chatting directly with an education coach. It's interactive learning at its finest. Tune in live or watch on demand. Head over to tdameritrade.com/webcasts and start learning today.
Thinkorswim by TD Ameritrade is more than a trading platform. It's an entire trading experience. With innovation that lets you customize interfaces, charts, and orders to your style of trading. Personalized education to expand your perspective, and a dedicated trade desk of expert-level support that will push you to be even better and just might change how you trade forever. Because once you experience Thinkorswim by TD Ameritrade, there's no going back.
TD Ameritrade Network has arrived on the floor of the New York Stock Exchange new location with access to the biggest newsmakers in Wall Street, bringing you in-depth market coverage and real-time trade ideas. Do not miss our exclusive interviews with CEOs, bell ringers, traders, and stock pickers, keeping you informed as you navigate your investments. Don't miss Trading 360 at 11 a.m. Eastern and the watch list at 2 p.m. Eastern, live from the New York Stock Exchange, only on the TD Ameritrade Network.
Welcome back to Next Gen Investing. Time to chart and trade. And Elite 8, Magnificent 7. I mean, these are the big two. These are the two biggest companies. They've been the two biggest companies for basically my entire career in following markets. There's a reason why. I mean, these companies are powerhouses. They seemingly can do everything. They have a little bit of exposure to seems like everything. And they just dominate their key markets. I mean, Microsoft is corporate software, it seems like. It is, operating systems. It is things that you encounter on a day-to-day basis at work. Apple's in your pocket all the time. It's in my hand right now. These companies are everywhere. But let's start with Apple. Big AI news today.
Big AI news today. And it's interesting that we are seeing Microsoft react to the downside because it's not the first competitor that's threatened, of course, ChatGPT and Microsoft's OpenAI investment. But Apple is a competitor that I wouldn't want to go against because they are very good at what they do and they are obviously very advanced in the technology space. So here to tell us now more on the technicals, I'd like to welcome in Rick Ducat, our chart master. So Rick, we'll start things off here with Apple. Apple right around its all-time highs really impressive move. We discussed some of this outperformance we've seen on the year from so many of these big tech names, but Apple and Nvidia are pretty much the only, and I guess now Microsoft, excuse me, because they were at all-time highs yesterday. These are pretty much the only names that are at their all-time highs.
Yeah, pretty inconsiderate of Apple to announce that news right as I was preparing this hit. Kind of messed up what I was going to talk about here. So, you know, aside from that, it's a very strong looking chart here. We've been trending upward ever since we hit those yearly lows near 124, and it's pretty much just been straight up with barely even a breather. We've touched our 21-day exponential moving average a few times, but it's served as a buying opportunity every time. We can see that it's been a almost straight upward trend line here going across these lows. And we can see that we also broke above an interesting point today, the 194 level. That was about the site of our best 3 closes here. They all kind of peaked out at the same point in terms of closing prices. But today we had a significant spike upward, took us all the way up above 198 here, and now we're backing off a little bit, but still maintaining above that 194 level here. So what I thought was interesting too is that the move in the past few weeks has taken us above our +1 standard deviation channel. And what this tells us is that we're more than 1 standard deviation away from our linear regression line, our blue line here. That's our line of best fit based on closing prices. So we're at a relatively extreme point compared to itself. Now the question you have to ask yourself as a trader is this going to continue? Is the trend going to keep going upward? Are we going to keep making these new highs? Or are we in for some mean reversion? That's kind of the two main schools of thought in technical trading, trend following or mean reversion trading. So that's up to you guys. I can't answer that for you, but I can look at our studies and try to assess this move, because it can be pretty tricky to try to gauge where you might find resistance when there's no previous price action to go off of here. And that's one thing our standard deviation channel study can help with here. So we can see as well RSI, our measure of momentum. We were in the overbought area. That would have been a sign of strength here, but we are backing off a little bit, as I said. Now we're below that 70 threshold that designates the overbought area. So ideally, the bulls would want to see price hang on above that resistance, but also cross into the overbought area at the same time there. The cross back out of the overbought area is usually regarded as a more bearish type of signal, so that would be something they'd want to avoid here. So looking at our chart a little more closely here, if we mention our +2 standard deviation, like I was talking about earlier, that can be a way to gauge where you might find some resistance when something is making new all-time highs. That comes in just above 205, this orange line here. So keep an eye on that level. It will change as price continues to move day by day here, so it's not going to be an exact target based on what I'm saying right at this moment. But you could keep an eye on that study. When we start getting close to there, maybe consider taking some profits. To the downside, if we don't hold our 194 level, we've got quite a bit of support coalescing right in the same level, around 189 to 190. We've got the start of this gap, that small gap right there that proved supportive a couple times there, even though we did break below it. That would still be an area that I might have in mind. We've also got our trend line, we've got our +1 standard deviation channel, and our 21-day exponential moving average, all coming in around the same level. So there's quite a bit of potential support in that area. I would be taking notice if we were to break below it there. Potentially then that could open the door to the 63-day exponential moving average, coming in around 180, but that's a good bit away at this point.
Right, 180, we are trading right now just below 195 a share. And Rick, this name has been phenomenal to watch, and I think their entry into AI was just a long time coming. I'm not really that surprised, but I guess anytime we get more concrete updates, it does make sense to see shares react, and Microsoft being the clear one that is reacting, at least to the downside. So now I'm trading this name, Alex. I mean, this name pretty much right around its all-time highs. This name's been on a tear, and I can second Rick's sentiment that great for Apple to come out with news right before our show, because all of my percentage changes now are all messed up. But I do know this name is still a clear outperformer, and in terms of its earnings, it is one of the most solid throughout the market coverage that we discussed. We don't have earnings until the first week of August. We do have some time there, but walk us through then a more bullish leading example trade.
Yeah, we're disregarding earnings being on the calendar for this one. There's excitement around AI, there's analyst news, and it's Apple. It's a name that many maybe have exposure to one way or another, just simply as a passive investment, be it through some sort of broad-based index product, or of course just a simple investment in Apple shares. It's one of the most widely held stocks on of all of them. And so looking at trading this one and maybe looking for a boost here, be it from earnings, be it from continued details coming out on AI, be it from for any reason. This is one that it did make a spike high up around 198.5 this morning. It did get back about $3 of those, but still up a little bit here today. Let's just say it gets to 200. It's a big round number. There'd be a new level that we had never been to before. Here's a strategy that would benefit from that if that happens over the next couple months. And I know a couple months seems like a lot of time for only about $5 in the stock shares, but it would be a new all-time high. And we talked about every dollar in Apple in market cap is almost $16 billion, which is just incredible. And it goes to show just how big the float is for this. And it typically, just doesn't quite move with the same velocity as other names. So looking at the call calendar, 200 August, SEP, $1.50 debit. You can see the risk profile, straightforward. The beauty of this also is how customizable it is. You want to give it more room to the upside. You want to shorten that duration. You want to bet against Apple. You want to look at something to the downside. On the bear side, you could look at put calendars as well. You're just limited by strike availability and, of course, the expirations, but very customizable, risk-defined trade with $150 in risk, and one that peaks out. Its best case scenario would be right at 200. So some people believe that those big round numbers can be influential. They can act like magnets one way or another. If you fall into that camp, maybe this one is interesting for that reason. But just one way to look at it, risk-defined trade, looking for a continued upside move here for whatever reason over the next month and a half. If it got to 200, that would be the best case scenario. All right, let's talk Microsoft, because the fallout isn't just in Apple. It is falling over to names like Microsoft that have been seen as sort of the tech leader from the research side through OpenAI and its investment there. It's feeling it today with a huge turnaround intraday.
You know, it will be interesting to see how their pricing, their competitors' pricing stacks up to Microsoft's now $30 per customer a month, which we were debating, is that expensive? Is that not expensive? I think it sounds reasonable, but I guess it depends how many customers that you're paying for, and obviously the inner workings of these subscriptions, that it just feels like they just keep coming. But as far as the technicals go, this name is pretty much at session lows here, Rick. But another name that's been relatively strong, and Microsoft is always sort of that strong and steady player in tech. It doesn't necessarily see such outsized moves to say like a Tesla, but I actually think that's usually what investors like about this name.
Yeah, and it's tough to decide which of these two charts that we're looking at today looks stronger. On one hand, Microsoft had a bigger move from the intraday lows. We're up about 66% from that point. On the other hand, Apple's trend line was just straight up and very consistent here. The trend line here kind of begins with our last earnings announcement back in April. Since then, we've been trending up nicely, just pretty steadily. We had a bit of a breakout to the downside there, but it didn't last. It was notable, though, that it took us below our 21-day EMA pretty convincingly for a moment before recovering with another gap up and closing above that trend line within a few days. So it's always good to beware of these types of false breakouts. Unfortunately, sometimes there's no way to tell until it's over and you realize that it was in fact false. But there's a couple ways you could maybe have helped filter this one out that I'll get to in a minute here. So we can see that the notable move upward happened yesterday. We broke above our old closing high, which was near 348.10, and we also broke above our +1 standard deviation channel. So as I said before, this is a measure of how extreme the recent price activity is relative to itself. So it compares if we're seeing an outsized move or not. And this move took us very far above our +1 channel. We were almost halfway to the +2 channel here, but we're giving back some of those gains today now. Backing off a bit from those highs as well. Now, I mentioned before about kind of filtering and trying to assess these when you do get a potential breakout to the downside here. Look at the RSI. We can see that RSI, we held above the 50 line during those two forays to the downside that took us below our 21-day EMA. We can see that we held pretty consistently at that line that separates bullish momentum from bearish momentum. We stayed mostly on the bullish side here. We also had a breakout yesterday when we kind of topped out here a few times. We broke above it and moved into the overbought area. So looking at the RSI can perhaps help filter some of these moves out. Maybe you weren't convinced that the move was genuine because momentum was hanging on still. But you know, it's a tough one. The false breakout can be very challenging for traders here. And we can see that now our RSI as well is telling us that we moved out of the overbought area. As I said before, that's a more bearish signal here. You know, it wouldn't be crazy to see a retest of these old highs and this +1 standard deviation channel considering how strong the gains have been lately. But to zoom in a little bit and look at some support and resistance here, as I said, +2 channel would come in right here near about 384 or so. That'd be quite a climb from this point here, but certainly not impossible. Anything could happen. But we've got our confluence of support right here at the two areas that I mentioned before, our old closing high and our +1 standard deviation channel just above the 348 level. Below that, we've got our trend line, and we've got our yellow 21-day EMA coming in near 340. And remember, the 21 EMA still pointing upward, still trending upward here. Be on the lookout for the shorter-term moving average that you follow to start to flatten or even turn down. That could be an early warning sign that the trend is indeed starting to fail.
Yeah, and Rick, like you highlighted, overall an uptrend, seeing a pretty nice month. That's up about 5% month to date, and it was up about 4% this week, but giving back some of those gains. But all in all, Name It has still been an outperformer on the year and really over the last decade of following Microsoft's stock. So we will leave it there. Appreciate the technicals. As always, Rick Ducat, our chart master. So now in trading this name, Alex, taking on maybe a bit of a different approach. They do report next week, so we do have that more near-term earnings catalyst, but also analysts, it just shocks me to see. I guess you made a really good point that we could just see analysts waiting for some more developments, so it doesn't necessarily mean that everyone's negative or perhaps less optimistic than some of the analysts' price targets today would indicate. But 352 is the average, slightly below where we're currently trading, although we're inching closer as we sort of fall here.
I think it's also a reflection of really just how impressive the rally in Microsoft has been. Those are at one point were probably above the stock price. The stock price just run a ton so far in 2023 and caught up to some of those price targets maybe ahead of schedule. But looking at this name and understanding the situation today, understanding that there's an earnings event on the horizon, I looked at a strategy, goes out, it would capture the earnings event in it. It goes out to the August monthly expiration. It's a neutral to bullish strategy, so it's sort of fading this sort of intraday reaction to the AI news out of Apple and its announcement of its project that's being referred to as AJAX and this downward moves that we're seeing in Microsoft. But also it's a strategy that benefits greatest from a move right to 345, which is a price lower than where we're currently at. So omnidirectional, but neutral to bullish because the risk is also to the downside. It's called a skewed put butterfly. We're going out to August buying 1,350, selling 345, and buying 1,335. So we're selling a $10 wide credit spread, buying a $5 wide debit spread. That's how you get this risk profile. Those two short strikes converge together at 345. And so it's done for $1 credit in this case. That would mean that the strategy performs if all of these options are out of the money, above 350 in other words. It's basically just going to perform like a short put vertical. The credit received is the max profit on that, and you'd expect these options and hope for them to expire worthless to keep that. Where things get interesting is if it does get in between 350 and 345. That's where the debit spread starts working while the credit spread is still out of the money. Perfectly pinned at 345. It can expand to a theoretical $600 profit. $400 in risk though if all the options are in the money to the downside, which is below 335, and the break even is 339. So I think of these as sort of high probability strategies that you would do where you'd maybe be interested in the stock if it went a little bit lower, but you want to be risk defined. You want that lower break even, maybe even anticipate a little bit more additional weakness, but you feel like it's getting close to a level where it's going to stabilize. So sort of that almost buy the dip strategy. This is the risk defined version of it, Jenny. So I'm not going to go that far because, you know, obviously if all these options were in the money, you'd anticipate they'd offset and you wouldn't have a share position. but a 1-by-2 put ratio, which is sort of in this family, is oftentimes seen as that buy the dip strategy. So sort of ancillary to that.
And I think that was really well put, and obviously a different way to play some of the biggest names in tech and some of the strongest performers in tech we've seen this year. Also important to keep in mind for both of our example trades today, they do contain multiple legs that can lead to higher transaction fees. Short options can be assigned at any time, and carrying option positions into expiration can add risk, like unanticipated exercise or assignment. Now, coming up next, it's time to talk one of the biggest moves to the upside of the day. Carvana shares up over 25% following its surprise second quarter earnings release. We'll discuss those numbers more coming up next.
Many option traders tend to focus on price and direction, but implied volatility can also be a big factor in options trades. In the Options for Volatility course, we explore what implied volatility is and how it can potentially affect the price of an option. For example, let's say an option trader wants to take a bearish position on a stock, but isn't sure whether to buy a put or sell a call. Both strategies are bearish, but looking beyond direction to consider the impact of implied volatility could help the trader choose between them. We also introduce strategies designed to harness changes in implied volatility. For instance, time spreads like counters and diagonals are designed to benefit from increases in implied volatility. Iron condors, on the other hand, are designed to benefit from falling implied volatility. After learning about the strategies, you can take the final assessment to test your knowledge. Head to the Education tab on Thinkorswim for the full Options for Volatility course and a whole lot more.
TD Ameritrade Network has arrived on the floor of the New York Stock Exchange new location with access to the biggest newsmakers in Wall Street, bringing you in-depth market coverage and real-time trade ideas. Do not miss our exclusive interviews with CEOs, bell ringers, traders, and stock pickers, keeping you informed as you navigate your investments. Don't miss Trading 360 at 11 a.m. Eastern and the watch list at 2 p.m. Eastern, live from the New York Stock Exchange, only on the TD Ameritrade Network.
When traders tell us how to make Thinkorswim even better, we listen. Like Jack. He wanted a streamlined version he could access anywhere, no download necessary. And Kim. She wanted to execute a preset trade strategy in seconds. So we gave him Thinkorswim Web. Because platforms this innovative aren't just made for traders, they're made by them. Thinkorswim by TD Ameritrade.
Welcome back to Next Gen Investing. It's time for our look at a developing story with Kevin Green, Senior Markets Correspondent for the network. So Kevin, we just discussed Apple, Microsoft. I think it seems fitting now to move to another big tech name. That is Meta Platforms, the best performer of those three by a sizable margin. Walk us through the news we're seeing today.
Yeah, we are actually seeing Mark Zuckerberg actually announcing yesterday that he is considering releasing the code for their for some of its AI technology to the public here, and they actually do believe that the decision is going to be made in order to be able to catch up to some of the other players in the space, as you talked about Google, Microsoft, and now hearing from Apple today. So this could be an area for them to be able to try to catch up into the space. And then also he does make a comment that says when software is open, more people can scrutinize it to identify and fix potential issues. Now, this is not a nuanced type of strategy, Jenny, when it comes to software. This is actually how Linux actually thrived early on. You get to have the ability for freelance programmers and hobby programmers to look at code, try to enhance the code, identify bugs, and that's also an area that could also help out Meta, where they're not actually having to pay developers to be able to really try to hold out or build out these systems. So it's very interesting, but this is not the first time Meta or Facebook has actually done this. They actually did release a library or a package in 2017 called Profit, which is actually utilized to forecast time series data, and that's actually available on Python and R programming platforms as well. So this is something that that's not really new when it comes to not only the software landscape, but also for when it comes to Meta. And this could be an area or an opportunity for them to try to accelerate their development in this AI sphere as they try to transition from less priorities like the AR headsets and things of that nature.
Yeah, and I think that's really well put, Kevin. I think the news regarding Meta is always interesting when it moves away from some of these headlines that are sort of ridiculous regarding Threads and Elon Musk versus Mark Zuckerberg. To me, none of that necessarily matters as much as some of these actual updates to the company and its overall business model here. But now we do have earnings next Wednesday after the closing bell on Meta platforms. And it's interesting because we just looked at Apple and Microsoft pretty much at their all-time highs. Meta has had a banner year. It's up over 160%, but nowhere close to its all-time highs. So does that make this name then perhaps maybe more attractive into earnings, or is it just still one of these names that is outperformed and could be priced to perfection?
Yeah, I think Meta at this point, I mean, it was a laggard, and that's why we are seeing this rotation going into Meta and maybe some of the other communication services type of names here. And that's why we were seeing the movement to the upside. Now, it could actually continue to move to the upside here. Now, we also have to just kind of keep in mind Meta had some significant headwinds going into last year because of expenses and their priorities. And this has been the year of efficiency, as people like to call it here. And now we are seeing some of the results. So if we continue to see results from just them being able to trim down their expenses, as well as like kind of refocusing their efforts on the core parts of their business, the market could celebrate that, and that could also create a little bit of a catalyst to the upside here. So we'll probably get a little bit closer before we start seeing what the market actually prices in from an option standpoint. Right now it's a little bit too early to tell right now, but I would anticipate that implied volatility will probably increase pretty significantly as we get a day or 2 days before the earnings announcement. So looking forward to seeing what the results are going to be.
All right, great breakdown on just another story, of course, regarding Meta and all things AI. Everything sort of ties together today, Kevin. We'll leave it there. Senior markets correspondent for the network, and I'd like to bring back in Alex. And it's time for FOMO. And I will say that this is one of those stories that I saw even prior to coming into the office today, and I was like, we are definitely going to talk Carvana on FOMO. I knew it because I saw that the surprise earnings release, I saw some of their debt restructuring, and I knew that this name would either move significantly to the upside or to the downside. So thankfully, it's on a positive note.
You know, shout out George Tillis. He kind of talked about expecting stuff like this to happen in sort of these troubled companies when they get the opportunity, massive equity upside throughout 2023. To take a chance to negotiate from strength, take a chance to increase equity to raise capital as this company tries to, as this headline I saw, I think puts it very, very succinctly and better than I can. It said, Carvana finally finds a gear other than reverse. As it's going forward here, Jenny, it's exciting. I mean, we joke about Carvana oftentimes just because it seems so kind of novelty, like you run out of ideas. Instead of just having a flat parking lot full of cars to come see, you then put them in the vending machine. But it did do some other stuff, e-commerce and deliver the car if you need to, try to service some areas that maybe don't have as many access to dealerships. But they're selling cars in the end, Jenny, and there's just not a lot of new here. So we've joked about it, but got to be, tip your cap to the leadership team. They're doing their best to make it through this tougher time the last couple years.
Right, and I will say that these earnings weren't necessarily as strong as this near 30% move to the upside would indicate. They did post sales that beat expectations. They did fall by about $1 billion on a year-over-year basis on losses that were better than last year and were also better than feared, but they are still losing money. Important to keep in mind, they also highlighted a lot of their gross profits per unit, which did come in better than expected, and they did see some of these higher than usual volumes of loans, which was obviously then an aid to their second quarter. However, what this means for their third quarter, they do expect their adjusted total gross profit per unit to exceed $5,000, and they expect to generate positive adjusted EBITDA for the second quarter in a row, which is obviously another step in the right direction here. Additionally, though, I think this was the much more important piece of news they released this morning. They disclosed they've reached an agreement with bondholders that will eliminate more than 83% of the company's 2025 and 2027 unsecured note maturities and reduce its required cash interest expense by more than $430 million annually over the next 2 years. They highlighted the fact that this transaction significantly increases their financial flexibility by reducing their total overall debt, extending their maturities, and lowering their near-term cash interest expense as they continue to execute on plans to drive profitability and further growth. And like you said, George Tillis has harped on this narrative for so long. This company was running out of cash. So this is a clear benefit to Carvana. Shares are up now 960, like 1,000% year to date, and I'm not even exaggerating, but they continue to move. So it continues to fluctuate, although this name was at all-time highs back in 2021 at $377 a share. So we're still down about 86% off of all-time highs.
Yeah, it certainly looks a little bit better with the 50 handle than like the $5 handle, though. So I think investors are, they're taking this as they can. But in a situation where a stock has got heavy short interest, as this one does, and maybe potentially could even be hard to borrow, oftentimes when looking at trade strategies, Jenny, avoiding something that may have a short call in it could be the benefit of the investor. Is that early assignment risk just really does increase if a stock is hard to borrow, especially if one is volatile like Carvana, and that volatility happens to the upside. So I looked at a strategy that just looks at everything on the put side. It's still neutral to bullish. The excitement is to the upside today in Carvana, so I wanted to make sure we reflected that with the trade strategy. Going out to just next Friday's expiration, selling the 48.45 put vertical. Volatility is so high in this that you can still get a third the width of the strikes for an out-of-the-money put spread that expires next week. And so very well could be entirely in the money. It's certainly possible for a name that moves this much in that short of a time. But break even is 47 and the stock's currently above 50. Collect $100 essentially on $200 in risk, so 2-to-1 risk to reward, neutral to bullish. If we look at the risk profile, straightforward, elongated Z formation here. It starts in the max profitability zone, which is that $100 again. 47 break even, below 45 is the risk. That's $200. We looked at these a bunch, Jenny, but it's rare, and it really takes a certain type of stock to have this short of a time frame, especially post earnings or post the release of big information. And still collect this much premium. It just shows how volatile this name is.
It does, and we talk a lot about the short selling in this name. It did see around 63.5% of its shares sold short, but that number actually came down. It's at around 55% now, which is still extremely high, but coming sort of back down to earth here. So nice day, obviously, for Carvana. A nice year, all things considered. We will leave it there for FOMO. Now coming up next, it's time to look at Airbnb, a name that has reversed some of its intraday gains, now lower on the session after touching 52-week highs.
Whether you're an experienced investor or just getting started, TD Ameritrade offers a webcast that's right for you. Looking to improve your portfolio management skills? Our Portfolio Management webcast series breaks down key concepts like retirement planning, income generation, ETFs, and more. Best of all, you can ask questions by chatting directly with an education coach. It's interactive learning at its finest. Tune in live or watch on demand. Head over to tdameritrade.com/webcasts and start learning today.
Thinkorswim by TD Ameritrade is more than a trading platform. It's an entire trading experience that pushes you to be even better and just might change how you trade forever. Because once you experience Thinkorswim by TD Ameritrade, there's no going back.
Oh, yeah, I gotta take off.
Now, you downloaded the TD Ameritrade mobile app?
Yeah, actually, I'm taking one last look at my dashboard before we board.
And you have Thinkorswim mobile?
So I can finish analyzing the risk on this position?
You two are all set.
Choose the app that fits your investing style.
I'm Nicole Petalides, live on the floor of the New York Stock Exchange, empowering investors every single market day. Tune in to the TD Ameritrade Network.
Welcome back to Next Gen Investing. It's time to discuss some Airbnb stocks selling off modestly here today, Jenny, but all things considered, the entire market seems to be a little bit wobbly intraday. Not massive moves, other than the ones that are tied to AI, though, one way or another.
And Airbnb is still a relatively strong performer. Has gotten a benefit from some of the hype around all things leisure travel, as Airbnb, I think, is seen almost as a pure play into leisure travel. So here to tell us now more on this name, I'd like to welcome in Renita Young, Senior Markets Correspondent for the network. So Renita, earlier we had 52-week highs. We're faltering a little bit here. Walk us through the news today.
Well, we had that initial stock pop when Argus raised its price target on this stock, but since then it's come down a little bit from that yearly intraday high, that new high, and it's because other travel stocks, that's just as you guys say, are lower. So is the NASDAQ right now. But if we isolate this one particular note, the analyst took this stock to $169 a share from $124, and that's around a 16% move to the upside from where it's been trading today. And he chose to keep the buy rating on the stock. He said that demand for Airbnb rentals should remain strong in the United States, and that'll be driven primarily by longer stays, and it'll be driven by some growth in the more metropolitan markets. Now, COVID-19's cease in China, the restrictions that are over now, that helps benefit the company as well. So will growth in Latin America, and then those earlier than expected summer vacation bookings that happened over in Europe. But just as you say, this stock is still pretty strong. It's up around 70% year to date. It's up more than 77% from its yearly intraday low. Doesn't really show a whole lot of signs of stopping at the moment.
Seems to be the world's favorite kind of side job as well. I feel like I know too many people who are Airbnb hosts now, as well as whatever they're doing for their career. So I hope for everyone's sake, in the housing market's sake, that the Airbnb demand does stay robust. Any final thoughts, Renita, before we say goodbye?
That's a good note. I wonder what the statistics are on that anyway, the amount of people who have started to host more Airbnbs now. And I wonder if that'll somehow correlate with what's happening in the real estate market too.
Yeah, and I do know it's a very saturated market, Renita, as I don't think you could pay me to want to be an Airbnb host. I know how awful my friends have been to some of the hosts, and I would not want to be on the receiving end of that. Yeah. But we will leave it there. Appreciate all of the insight on Airbnb today. Renita Young, Senior Markets Correspondent for the network. Now, coming up next, last but not least, it's time to look at our under 30 name today. That is Toast, tumbling on the session after announcing some fee restructuring. Jeff Pierce will have more on that news coming up next.
Watchlist can help you keep track of securities you're interested in. To add a watchlist to the left sidebar, select the plus sign, then Watchlist. When the default list appears, select the name box, then Create Watchlist. Enter a watchlist name. To begin adding securities, enter a ticker symbol in the symbol box, then select Enter. Continue adding all the symbols you want in your watchlist, then select Save. The existing list is replaced by the new one. You can also create watch lists from the Market Watch tab. After creating a watch list, you can add symbols to it from different locations across the platform. From the Charts tab, select the list icon and then Add to Watch List. From the Scan tab, right-click a security and then Add to Watch List. And that's how you make a watch list. For more demos on how to think or swim, head to the Education Center on tdameritrade.com.
Thinkorswim by TD Ameritrade is more than a trading platform. It's an entire trading experience. With innovation that lets you customize interfaces, charts, and orders to your style of trading. Personalized education to expand your perspective, and a dedicated trade desk of expert-level support that will push you to be even better and just might change how you trade forever. Because once you experience Thinkorswim by TD Ameritrade, there's no going back.
Trading has changed forever as a new generation of investors make their impact on markets.
It's more important than ever to navigate through the frenzy of meme stocks, IPOs, and the next wave of tech.
And that's where we come in, discussing strategies and example trades on trending names.
Take control of your financial future. Next Gen Investing, weekdays at 1 p.m. Eastern, only on the TD Ameritrade Network.
Welcome back to Next Gen Investing. It's time for Under 30. We're talking some toast, not the food, but rather the software company. Jenny, the hospitality-facing software company, making some news today, and the street does not love it.
I wish we were talking actual toast, because that would be, I think, a more positive spin on what is a pretty negative piece of news today that's weighing on Toast shares down almost 17%. So here to tell us now more on what's dragging down Toast, I'd like to welcome in Jeff Pierce, the Senior Manager of Derivatives Trading for TD Ameritrade. So Jeff, obviously some downside today. This name is no stranger to volatility. Walk us through what you're seeing.
Yeah, down around 17% after the company reported that they are going to remove their 99-cent ordering processing fee by the end of the week. Obviously, investors are selling off on this, but the company noted that the removal of the fee will not have any material impact on their previously announced guidance for fiscal 23, which had revenue expected between $3.71 and $3.8 billion. If you're just now hearing about this, in June, the company announced that they were going to add this 99-cent fee on all online orders over $10. The fee was really aimed at customers that use Toast and not the businesses who had no control over the charge. Toast also was going to be paid a percentage fee on every credit card sale. The fee potentially was worth hundreds of millions of dollars in annual revenue, and the gross margins would have been significant as well, because it doesn't take much to implement this type of thing. That, of course, is what we're seeing the big reaction today from investors.
So with this then, Jeff, had it actually gone into service and they started seeing a drop off in customers, or was this just backlash quickly that they just pulled this out, and obviously it impacts some of their guidance and stuff, as they say in sort of the release here. But I guess it's such a quick turnaround. Obviously, when I'm looking at this, it's like they did this because they needed the extra cash. They're trying to find a way to prop margins up. But, I mean, they say, explicitly, we made the wrong decision in a letter to customers. They got some backlash clearly on this.
Yeah, absolutely. They got backlash from customers on this. You've likely used this app before, sometimes maybe not even realized it if you've ordered something online. Customers are typically not the ones that we see getting hit with these fees. It's normally been the restaurants. Now the restaurants may raise their prices in order to try to, cover the fees themselves. That is the big question mark right now, though. Have customers, really left the application, left the app, or have restaurants left the app because of this negative impact that we saw from this fee, or have they got onto this quick enough in order to kind of stop any sort of big abandonment of the app altogether? You've got analysts out there that, are talking a little bit about what this would have done for the company. D.A. Davison analyst said it could have garnered between 20 to 30 million a year in revenue. We saw Bernstein analysts talk a little bit about the run rate on gross profit impacts, expecting about a 7 to 10% run rate there. So there's some big question marks on what they're leaving on the table, but I think what we're looking here is a company that they saw a potential for a big abandonment on their application. They wanted to make sure to get ahead of it.
Yeah, Jeff, I guess I'm wondering the growth story for Toast here, because I do know they're the back-end payment processing of all of these different restaurants, but they obviously aren't in all restaurants, or else they would not be a $22 stock. So as far as growing and building out their infrastructure, I mean, do they still have significant upside in terms of that aspect? Because this name is up only like a measly 24% year to date. I know we're making a monster move to the downside today, but you'd think that with some of the names that have seen such strength lately, like a Shake Shack or a Chipotle, this name would see some benefit, but it just hasn't been all that exciting on a year-to-date basis.
Yeah, it's been a relatively good growth story, especially if we look at 2022. It had about 79,000 restaurant locations using at least one of their products. That was about a 40% year-over-year increase. They ended the year with about $91.7 billion in gross payment volume. One of the issues for the company is their largest revenue stream is that fintech solution, which makes up about 83% of the revenue. That's them getting paid from those fees they charge per transaction. The subscription revenue segment, which is what gives the restaurants access to their software, that has a very high gross margin rate, coming in about 65%. But right now it only accounts for about 12% of their business. So they're certainly trying to push that subscription revenue to become a higher driver of revenue overall. And that's really probably where we're going to see most of the growth.
You know, Jeff, it just seems like maybe this 99-cent fee was just too over the top, too in the face of customers. Like, they're taking a little bit here, a little bit there. Obviously, the partners they have with the restaurants and the other hospitality companies they work with, they pay on the back end. It just seems like the negotiations more on that front would have been a better way to do this. So I'm sure there's been some hostile internal conversations at this company regarding this. It's controversial for customers. It's got to be controversial internally as well. But a company that really I had tipped my cap to for how well they had seemed to really come in and disrupt this space. A pretty big misstep, but hopefully, like you said, for investors, reversing course relatively quickly. But we'll appreciate it. Thanks, as always, for joining us. Jeff Pierce, Senior Manager of Derivatives Trading at TD Ameritrade, joining Jenny and I. That's going to do it for us as well. Thanks, as always, for tuning in. Coming up next, we got the watch list.
Let's walk through how to analyze a company's financials on thinkorswim. To get started, go to the Analyze tab and select Fundamentals. Enter a symbol, then select Enter. To download detailed analyst reports, select Download. By the Numbers provides balance sheet information and other fundamental data. Company Details provides summary takeaways on key metrics and what drives the stock. Takes a more numeric look at similar information. If you find any of the information particularly helpful, you can print it out or take a screenshot. For more demos on how to thinkorswim, head to the Education Center on tdameritrade.com.
When traders tell us how to make thinkorswim even better, we listen. Like Jack. He wanted a streamlined version he could access anywhere, no download necessary. And Kim. She wanted to execute a preset trade strategy in seconds. So we gave him thinkorswim Web. Because platforms this innovative aren't just made for traders, they're made by them. thinkorswim by TD Ameritrade.
Welcome to the Watch List. I'm Nicole Petalides. It's 2 p.m. Eastern Time, coming to you live from the New York Stock Exchange. We're on a hot run for stocks, with the Dow up 7 days in a row and gaining here today, up 120 points. We're in the thick of earnings season. We heard from Goldman Sachs. We're waiting on Netflix and Tesla after the bell. Taking a look right now at the Dow, it's up 121 points, 35,073. The S&P up 9 at 4564. The Nasdaq down 0.2%. And the Russell gaining 0.2%. As we look at oil and gold, you're seeing gold pretty much flat today, while oil pulls back a bit. The VIX right now today is at 1357. So a little bit of tepidness here, as we have seen the markets moving higher. In fact, the New York Composite Index at some new recent highs as well, and that's a really broad-based index. Bitcoin 30,050, gaining 0.9%. The U.S. dollar at 100 even. For some of the biggest stories in the markets, we welcome in Caroline Woods, Senior Markets Correspondent here on the TD Ameritrade Network. As I mentioned, Tesla is due. We're going to be hearing more. I mean, they did great with the deliveries. What are we expecting?
Well, should just note, Tesla share is basically flat today, but already up about 4%, more than 4% this week heading into the report. So definitely some optimism from investors. Obviously up 138% year to date. So there's a lot of question about just how high are expectations and what's priced in at these levels. But as you said, we already heard from Tesla in terms of those Q2 deliveries, delivered more than 466,000 vehicles. That was an 83% jump year over year. Tesla's been cutting prices to spur demand. So the big question is, what is the impact of those price cuts on the margins? So in terms of gross profit margins, Wall Street is expecting anywhere between 18 and 19% in Q1. The number came in at 19%, excluding the impact of credits. That was down from about 30% in Q1 of 2022. I will say Dan Ives over at Wedbush, who of course is a friend of the network, he was expecting the trough to be somewhere around 17.5% excluding credits. So expect kind of numbers maybe around 18% there. In terms of the other numbers, Tesla's expected to report EPS of 83 cents on revenue of $24.88 billion. Any sort of commentary about outlook is going to be key. Will there be additional price cuts? Any sort of commentary about that? And also, Wall Street wants to hear that profit margins are only going to improve from here. So I think that's really going to be key. I think it's also important just to note how much Tesla has run up, as I said, about 138% year to date. So
absolutely incredible run. It's interesting because Ford said they're cutting the F-150 Lightning price and sort of following in the footsteps of what we've seen from Tesla, because that's the most popular pickup truck when it comes to EVs, and Tesla was able to cut prices and somehow navigate. So it's interesting that they're doing that. Let's turn our attention to another name for earnings, and that's Netflix. There were a lot of people who wrote off Netflix a long time ago, and then it wowed everybody. The ad tier system is always something that's talked about. There's still some new updates, and we'll hear more from the company later.
The ad tier, but also just the password crackdown, password sharing crackdown. There was a lot of kind of speculation that it would cause churn right away and that people would cancel. People like me wouldn't sign up once they got kicked out. I haven't signed up, but the early numbers from analysts are really pointing to a lot of bullishness, and they're expecting that to actually translate into net ads in terms of subscribers. Wells Fargo was out with their net ads estimate, actually upped it from 1.5 million to 2.1 million for the quarter. So that's, of course, going to be the really key metric for Netflix. Just what impact has the password sharing crackdown had on the numbers. In terms of EPS, it's expected to come in at $2.83. That would be a decline from $3.20 in the year ago period. Revenue is expected to come in at $8.26 billion. There's a lot of uncertainty, of course, about the impact of the writers and actors strike, so we'll see if Netflix offers any insights into how long that could go, although they're expected to kind of weather that storm a little bit better because they have so much content, including international content, so that could actually work in Netflix's favor. Should also note that I saw that they're no longer offering their basic ad-free plan. That used to be $9.99. If you had it previously, you'll get to continue to have it, but they'll accept no new customers for that. So now you either have to pay $6.99 and watch ads, otherwise you pay $15 or $15.49 or $19.99 for the standard or premium plan. And then, of course, extra for all the other people. But Netflix, another company that's already seen an impressive run up 60% year to date, up 7% this week heading into this report. We're seeing a little bit of modest weakness today. It's off about 0.5%. But, with how far it's run, I think these numbers are really going to have to impress. But so far, the rallies for both companies have really just been charging ahead.
I always love to see how many subs are added. The 52-week high is notable. And I'm also interested to hear how they may comment or may not comment on the strikes that we've been seeing from the actors and the writers, because these streamers reportedly will feel something from this in 2024. Because a lot of things are just not being made at this time.
And Jay Woods was on earlier today on Trading 360, and he said expect about 11% volatility in one way or the other with Netflix. So it could be a wild ride.
All right, Caroline Woods, thank you. Big names today. Tesla, Netflix. All right, we got you covered here on the TD Ameritrade Network. Now let's get a look at the bigger picture. James Locke's with us, co-founder, Pool Locke Associates. Associates. Thanks for being here, James. So we've had a nice market rally. I mean, what an incredible run for the Dow, which is always fun. I was mentioning that you know, we saw the New York Composite Index, which actually comprises all the names here at the New York Stock Exchange. So it's not just a tech-based sort of index. In addition to ADRs, it even has an international touch. So it shows that the market rally, at least with a 52-week high there, that something's happening in a broad-based fashion.
Yeah, I mean, everything looks good, right? It really does, and it's hard to argue with that. You know, it's good for everyone along the way. You know, like I said, it's not just tech stocks. They stand out because of their big numbers and those volatility things that you were just talking about. They can swing all over the place. But, you know, there's a lot of things. But basically risk on investments right now, you know, people are not afraid. They're thinking like, hey, this rally is going to keep going. And you even mentioned that even Bitcoin is up, and the Bitcoin miner I talked about, Riot Platforms, is up 400+% in a year. These crazy numbers. AI stuff is still huge. That's a big factor. And even Apple was talking about adding in AI and things like that. But we see Coinbase is up this year. It's still obviously down from where it started. But it's moving in the right direction. Rivian, Carvana, all these big names, which aren't necessarily tech only, are doing. So we see, high option trading as well, tied to many of these companies. So there's a lot of optimism in the market. Now the question is it looking like late December 2021, and we're going to see that fall off hit? And we'll see. A lot of that has to do with the economy. Good news is companies are coming out with good earnings, but right around the corner, the Federal Reserve is ready to raise interest rates on it. So what is that going to do to everything? Because lending is getting more expensive. Mortgages, things like that, and a lot of these things are the big factors that drive the underlying market. So we don't want to see interest rates cause too much of a slowdown in what's going on right now.
But it sounds like you're apprehensive, like there's this run-up that has happened, and then you expect a sell-off. How do you prepare, assuming that's right? What kind of strategy do you have here?
Right. Well, you're right. It could unravel, right? And I guess we've been around long enough to see that it has unraveled right in front of our eyes sometimes. And that's where you see the contrarian saying, hey, there's a perfect storm for a crash to occur. I'm inherently a bull. I feel like most people are, like we want to believe that, things can be better in the future. But if it's all going to get tied to these interest rates, if interest rates keep moving too quickly up as they have in the past, like I said, I'm super glad they stopped and took a pause last time. Sure, we're going to get a little higher rate, but what we don't want to walk into is stagflation, really, is the ultimate thing. So you kind of asked, how do you protect against it? Well, it's about being balanced. It's about focusing a little bit on hey, these investments, are they paying me anything? Am I getting enough dividends to go along with it? There's nothing wrong with doing some growth focus and focusing on the Teslas and the Netflix of the world, but it can't be your only position, right? You got to make sure that along the way, if you're getting a good dividend stream, well, now you can handle that volatility a little bit better. You definitely want to make sure you're constantly diversified. And
let me ask you. Yeah, let me jump in. I know you like a few names here, and I don't want to miss out. AT&T is the name that you like. AT&T has hit the lowest levels in 30 years. AT&T was a name that the generation before ours loved it. It was a dividend payer. That and Verizon. There are a lot that there were people saying today, widows and orphans have AT&T and Verizon, only because these telecom names were so steady. And now AT&T at a 30-year low, basically. Why do you like it? How high do you think it could go, and when?
Yeah, so it looks so bad, which is very appealing to me. It's down 15% in the last 2 weeks. Now, I wish we had talked yesterday, right? Because today obviously it took a pretty big jump. It's up $1 or something like that today. But they're getting hit with a lot of like environmental problems right now. Now, I don't know that AT&T is going to go, to 100 or anything like that. But it easily could double from down here, without even being a problem. And it has a huge dividend, right? So, when things look the worst, that's usually the time to step in. I don't think this lead insulated telecom cable, which is hitting the whole industry, is as big a deal as it's being made out to be. And I think we're going to find that out, right? Because it's not going to turn into a legal problem and things like that. And all of a sudden people are going to say, well, hey, AT&T is still, paying out a good rate of return. It's at a big discount.
Yeah. Do you want to give me a few seconds on Pfizer?
Yeah, I mean, Pfizer, they constantly are doing, well on a year-over-year basis every time. They have promising drugs coming out. Like I said, their weight loss drug is effective. They've done a bunch of recent acquisitions. They just look like a long-term, kind of can turn around that chart that we're looking at right there in the long term, just from their future drug acquisitions. So same thing again, when it looks really bad, that's when I really like to, start walking in and buying it on the way up.
Yeah. All right. James Locke, great to see you. Pool Lock Associates. Thank you.
Thanks so much.
Thanks, James. Later this hour, we'll spotlight another kind of electric vehicle, buses. CEO of Green Power drops by to discuss their latest earnings. We'll take a look at the state of Hollywood, how the actors' strike impacts some of these streaming stocks. We were talking about that earlier, names like Netflix, Disney, and more. And our panel prepares for IBM. Those earnings are due out as well. Find out all about that. And investing strategies up next from Sound Planning Group.
Let's walk through charts, one of the most commonly used features on thinkorswim. Start by going to the Charts tab and entering a ticker symbol. Select Time Frame to adjust the time intervals or to favorite a time frame. Select Style to change the appearance of the chart. You can add drawings by selecting Drawings, Drawing Tools, and then Type of Drawing. For symbol comparisons, select Studies. This also gives you access to hundreds of pre-built studies, including a number of classic patterns. The grid icon lets you view multiple charts at once. You can even initiate a trade from the Charts tab. Just right-click anywhere on the chart and select either buy or sell. For more demos on how to thinkorswim, head to the Education Center on tdameritrade.com.
When traders tell us how to make thinkorswim even better, we listen. Because platforms this innovative aren't just made for traders, they're made by them. thinkorswim Trading from TD Ameritrade.
It's a 13-hour flight. That's not a weekend trip.
15 minutes.
Oh, wow, I gotta take off.
Now, you downloaded the TD Ameritrade mobile app so you can quickly check the markets?
Yeah, actually, I'm taking one last look at my dashboard before we board.
Excellent. And you have thinkorswim mobile?
So I can finish analyzing the risk on this position.
You two are all set. Have a great flight.
Hey, thanks.
We'll see ya. They're getting so smart.
Choose the app that fits your investing style.
Welcome back to the Watch List. I'm Nicole Petalides, live on the floor of the New York Stock Exchange. I want to take a look at some more movers for you right now. Apple shares all-time high again. In fact, spiking to this level here. The move comes after the company announced plans to create an AI challenger to ChatGPT. Bloomberg is reporting the internal project is named Ajax and will create an AI framework for large language models that could compete with ChatGPT. Apple's upcoming earnings report is due out on August 3rd. Carvana popping today after announcing meaningful improvement of its liquidity following a new debt deal. The company is issuing 350 million new shares and will delay some of its interest payments over the next 2 years. The company also rushed out its earnings today, which had been scheduled for next month. Carvana sold 76,000 cars last quarter, a drop of 35% from last year. Speaking of earnings, Goldman Sachs, came out with the latest report. The company is higher. Shares are higher, I should say. The big bank signaled better times ahead. CEO David Solomon said the environment feels better. That's his quote. The company, Goldman, had mixed results on the top and bottom line and reported a lower profit on its second quarter. Shares of Goldman Sachs are flat on the year. Check out Meta Platforms, reportedly scaling back its ramp-up in augmented reality glasses. Report from The Information says stalls in development and technology have led to several delays as the company planned to compete with Apple and Microsoft. Shares of Meta did touch a new 52-week high today, though. And here's a look at Bitcoin. 30,000. There it is, 30,000, up 0.75%. Let's continue our market talk and some investing strategy. David Strzeski's with us, CEO of Sound Planning Group. Thank you for being with us. What do you think about the rally we're seeing? I'm saying new high here, and new 52-week highs, but still new highs and somewhat broad-based. What are your thoughts on the rally we've seen?
Well, hey, great to be with you, Nicole, as always. Hey, I love a rally. In fact, my vote is that it goes up forever. But what goes up ultimately comes down, and we find ourselves in the midst of a cycle right now. But to be clear, I don't believe that this is a business as usual market rally like we're kind of used to. There's a record amount of cash that's still floating through our system right now. And I think it's important to understand that, the consumers, those who have some cash right now, they're out buying houses. They're out doing various things here today. But this is not a time to become complacent. I think this is actually probably best described as a pivot rally. What we know of a pivot rally is every single time that the Fed, is perceived to be stop hiking, that we get these, awesome and wonderful rallies. Now, this is the exact opposite of what Jerome Powell wants, though, because it's inflationary to see everything hit record highs, and we're continuing to talk about that. But this is the condition and the state of the market that we're in right now. One of the things that was kind of interesting is I was looking at some different commentators out there, and they were talking about how this rally might be a little bit different, but they were talking about, that we were retracing lows after a recession. And the one part I don't agree with is that we didn't hit a recession last year. And so if we didn't hit a recession last year, the retracement argument isn't actually the best one. I think, again, that it's the pivot rally that we're seeing here today. So we haven't hit capitulation. We're kind of at the last leg of a market cycle, in my opinion, and who knows when it ends, but we're going to be taking advantage, certainly, while the opportunities are here.
Tell me about the Fed. So we have the Fed meeting next week. Your thoughts there?
Okay, so, as far as the Fed goes, Jerome Powell is actually pretty dovish. Okay, so his last hike was considered a hawkish hike, a dovish hike, and then he had a dovish pause. And then now we're kind of in this in-between place. I don't know, is he one or is he the other? So if we get one more hike, it seems like it's priced in and that they should do it if it's priced in to do. But the Fed is going to have some big problems on their hands, in my opinion. And the reason for that is that we've just flipped the capital market here, and credit is getting a lot more expensive. Your piece here on Carvana and how they had to, remetabolize their debt, I think that this is probably one of the first stories that we're going to hear, as there's going to be more stories coming out of organizations that need more capital, but they have to borrow at a much more expensive rate. The other thing that to note here right now is that if you follow the United States dollar, we've actually slipped quite a bit here within the last, month. And if we're looking at that, just understand something. Commodities are priced in US dollars. And so if we're buying commodities in US dollars, we can afford more because we make those US dollars. Well, if the dollar has gone down and we can't afford as much, that means our money's worth less. That's actually an inflationary sign. And so depending on what the dollar does next from here, I think it's actually really going to determine what we're going to be seeing for the inflation print as time goes along. And so I think Powell recognizes that and knows that, although that's not a commonly understood deal, because this higher dollar has actually been doing Jerome Powell's job.
So you like healthcare and you like metals and miners. Tell me a little bit about the opportunities you see there, and even some foreign markets you said you like.
Sure. Well, let me just stay on this.
On each one, you know?
Yeah, sure. So, you know, what we're seeing right now is just like basically PE expansion. So earnings have to catch up. And so I'm a little bit concerned about getting overheated on those 7 to 10 stocks, you know, that have just been rallying so hard here. As we look at healthcare, you know, I think that this is important to understand. A lot of people would have gotten procedures during COVID, but were not allowed. And so as we look at and understand the healthcare system right now, they've got a lot of backlog stuff that's going on in there. And so I think that that's a very bullish place to be. Obviously, they finished strong here recently when we looked at numbers. And you know, which leads me to, you know, so where are we at here today? I think as far as the cost of things being expensive, one of the cheapest plays today is actually metal miners. And what's interesting is that whether inflation goes up or the dollar weakens, they actually own commodities that can be really valuable in that time frame. And so I think metal miners have never been, frankly, you know, better in comparison to what the S&P 500's valuation looks like. And then I guess the last in the international statement would be this. You know, the world is changing right now. We're looking at more friend-shoring ideas with different industries, and so we're going away from China and we're looking at India. And we all know that India has been a back office, you know, for many companies, Dell and others here over the years. But now they're starting to get into manufacturing. And as far as India goes, they have 2.5 million people every single year that are graduating with STEM degrees. And so these are the degrees of the future that are really going to be able to, you know, build and establish and take us into some of this next place. So I think India is on the rise. I think this is a trend that is just beginning. And then ultimately, you know, these things can carry for, you know, decades even. So I think they're on the rise right now. I think the United States is doing fine. The labor market's really strong. But we have some challenges here in our macro world and backdrop that just leave me a little bit concerned. So I'm cautiously optimistic as we're going forward here into the future.
David Trzaskowski, great to see you. Thank you always. Appreciate your strategy. Thanks, Sound Planning Group.
Appreciate it. Thank you, Nicole.
Coming up next, time to plug in for some electric bus discussion. Green Power CEO is standing by to provide the latest on their Beast buses. The watch list will be right back.
Whether you're an experienced investor or just getting started, TD Ameritrade offers a webcast that's right for you. Are you an active trader? Our Active Trading webcast series is designed to help you develop a deeper understanding of technical analysis, options, futures, and more. Best of all, you can ask questions by chatting directly with an education coach. It's interactive learning at its finest. Tune in live or watch on demand. Head over to tdameritrade.com/webcasts and start learning today.
I'm Nicole Petalides coming to you live from the New York Stock Exchange every single market day from the opening to closing bells. Tune in to the TD Ameritrade Network.
When traders tell us how to make Thinkorswim even better, we listen. Like Jack. He wanted a streamlined version he could access anywhere, no download necessary. And Kim, she wanted to execute a preset trade strategy in seconds. So we gave them thinkorswim Web. Because platforms this innovative aren't just made for traders, they're made by them. thinkorswim by TD Ameritrade.
Trading has changed forever as a new generation of investors make their impact on markets.
It's more important than ever to navigate through the frenzy of meme stocks, IPOs, and the next wave of tech.
And that's where we come in, discussing strategies and example trades on trending names.
Take control of your financial future. Next Gen Investing, weekdays at 1 p.m. Eastern, only on the TD Ameritrade Network.
Welcome back to the watch list. I'm Nicole Petalides. Time to take a look at electric vehicles, but in a different way, because electric vehicles come in all shapes and sizes. We think of Tesla and Rivian, and they build out some trucks. The team at Green Power is making buses. Green Power Chairman and CEO joining me right now, Fraser Atkinson. Thank you. Welcome to the watch list. Thanks for being with us. So explain what makes this company completely different from some of the others.
Well, our vehicles, we have a BEAST, being the Battery Electric Automated School Transportation. That's what the acronym stands for. We have a 40-foot BEAST that is has the highest capacity in terms of available seating, and we also have a 25-foot Nano BEAST that was awarded the most innovative bus by STN this past year. And both of those vehicles are built with an aluminum framed body, so it's both lightweight and super strong. And we've also designed our vehicles so that we take into consideration crash zones and battery placement in terms of safety for the kids that are on the vehicles. So there's a number of unique aspects of the products, both of those products that we brought to market. And that's being recognized by a number of the customers that are signing up to buy them.
So would this be local towns, short rides? I mean, where students are going somewhere more local so that these buses have to charge up, right? I mean, in general, when I think of electric vehicles, I think of short distance.
Well, we just completed a pilot project in the state of West Virginia, and they had 3 of our BEAST, or the larger school buses, and 1 of the Nano BEAST, and it operated in alternating school districts on 5 rounds. So we covered, we covered the terrain, we covered core areas in terms of both urban and city environments. And interestingly enough, we found that if for a number of the routes that the school districts were operating on, if they had the appropriate charging structure set up, they could do the complete morning run, charge during the day while the vehicles were back at the depots, go do the afternoon runs, and be available for student events or field trips later on in the day or over the weekend. So, with the right combination of charging infrastructure and our vehicles, they can accomplish an awful lot, or very similar to what they can do with an ICE vehicle. And that's quite different than, certainly anything in the automotive space that doesn't necessarily have to operate for extended periods of time and for different periods of time in a given day.
When you came out with the quarterly report, revenues wowed everybody, right? I mean, you had them topping estimates. Very impressive.
We're delighted with the results, in that the latest quarter continued a trend where it was a record quarter. The Q3, Q2 were also records, and the latest quarter we're just over $15 million of revenue for the quarter, and we delivered over 120 vehicles related to that revenue. So, we're showing the right trend, and we've also, I think more importantly, the feedback from the market, because we had a very strong days on Monday and Tuesday on the market, is that people are looking at our business model and saying, and compared to many of the other companies in the EV sector that are medium or heavy duty OEMs for EVs, is they're not putting up the same kind of profitability or gross profit on vehicle sales. And we have a very lean and mean structure and cost structure that people can see visibility to where, we have a business that can be profitable as we continue to grow and increase our delivery of vehicles.
I wanted to hear the timing from when the order comes in to when the school bus is actually on the road with the children inside. For example, I saw there was some interest from a California school district. I mean, we've already just talked about that $7 million deal from Nevada. I mean, what kind of untapped markets do you have, and how quickly can you serve these markets?
Well, probably, I'll get to your question on California. Probably the biggest untapped market is New York. And I say that in that the governor of New York last year issued a mandate that all new electric school buses by 2025 have to be all battery electric school buses, starting with new purchases in 2027, which is really right around the corner. And right now, the state of New York has a fairly nominal number of electric school buses delivery per year, and they have 50,000 school buses. So that's just a massive transition from where we are today by 2035 in terms of turning an entire fleet all electric. We applaud the mandate, needless to say, but it's going to be a daunting task for all of the participants, all 5 or 6 of us that have electric school buses that can be sold into New York. Coming back to your question on California, it's the biggest challenge we have is not so much the sales cycle, but within the school bus space, it is different than really all of the other sectors we deal with. There's more decision makers, there's more people that are involved in looking at the vehicle, assessing the vehicle, getting the financials arranged, and most importantly, being able to get infrastructure in place. And it's one thing to deploy 2 or 3 vehicles. It's quite another when somebody is looking at doing 50 to 100 and they just don't have the electrical supply at the different schools in order to, or the depots, in order to properly support that level of fleet. So that's we're kind of shifting our focus to spend a lot more time. Sorry, go ahead.
Yeah, no, go ahead. You can finish the thought.
So we're spending a lot of time on that right from the start, or even before we get started talking about our vehicle in terms of how, an electrification strategy can be implemented, in chunks or in stages to get them to their goal, in a fashion that can be accommodated with building out a charging structure without them having to go back to the drawing board and recreate all of that from scratch, which is incredibly expensive.
Yeah. Well, some of those buses were beautiful. They didn't look like a typical school bus. That must have been for some weekend travel, maybe to the casino or something. Anyhow, we'll have you back. We'll get some updates. Looking forward to it, to chatting again. Fraser Atkinson, congratulations to you and the team. A record quarter, as you noted, Chairman and CEO of Green Power. Thank you. Still ahead in the second half of our show, we've got our eyes on a couple of stocks ahead of earnings. Netflix, IBM. We'll get you prepped for those reports, and as we head to break, take a look at winners and losers in the S&P 500.
Whether you're an experienced investor or just getting started, TD Ameritrade offers a webcast that's right for you. Are you a long-term investor? Our investing webcast series breaks down different investing styles, including growth, value, income, and more. Best of all, you can ask questions by chatting directly with an education coach. It's interactive learning at its finest. Tune in live or watch on demand. Head over to tdameritrade.com/webcasts and start learning today.
Thinkorswim by TD Ameritrade is more than a trading platform. It's an entire trading experience. With innovation that lets you customize interfaces, charts, and orders to your style of trading. Personalized education to expand your perspective, and a dedicated trade desk of expert-level support that will push you to be even better and just might change how you trade forever. Because once you experience Thinkorswim by TD Ameritrade, there's no going back.
Before diving into the markets, prepare for the trading day with the Market Minute newsletter. Videos, market insight, and more delivered right to your inbox. Go to tdameritradenetwork.com, click on the pop-up to subscribe now.
TD Ameritrade Network has arrived on the floor of the New York Stock Exchange new location with access to the biggest newsmakers in Wall Street, bringing you in-depth market coverage and real-time trade ideas. Do not miss our exclusive interviews with CEOs, bell ringers, traders, and stock pickers, keeping you informed as you navigate your investments. Don't miss Trading 360 at 11 a.m. Eastern and the watch list at 2 p.m. Eastern, live from the New York Stock Exchange, only on the TD Ameritrade Network.
Welcome back to the watch list. I'm Nicole Petalides, coming to you live from the New York Stock Exchange. 90 minutes left in the trading day. As we look at the markets, really hovering around 52-week highs. When you look at the NASDAQ and the S&P, you've also had the NASDAQ 100 rebalance. That's been some news as well. But it's worth noting that the Dow is up for the 8th day in a row. Its longest winning streak in nearly 4 years. The S&P is up 0.25%. The Dow's up almost 0.5%, while the NASDAQ pulls back a bit. Let's continue this conversation, a market update. Ben Lichtenstein, senior futures contributor, to talk about the final 90 minutes of trading. What are you watching?
Wow, 8 days in a row, Nicole. That's quite the run, to say the least. We've been keeping an eye on the move up throughout the month of July, which has really been a continuation of the bid we saw last month, and really just really the pattern we've seen all year, one could argue, off the fall lows of last year. The SPX up to 45.78 today. We've got the NASDAQ to just shy of 16,000. It topped out at 15,932. The Dow to 35,234, and the Russell traded all the way up to 1990. You mentioned the NASDAQ, the only one of the four majors that's actually negative here. You're looking at the SPX, the rally we've seen this week. I mentioned the high. This is a new high for the year. The NASDAQ also posting an intraday high. So did the S&Ps and the Dow as well today. So taking a look at that, you can see the strong run up here, holding above the 50-day moving average, well above the 200. But, you know, the focus shifting from eco data to earnings, the big banks now to big technical. I think Tesla and Netflix are going to be front and center this afternoon, and a little bit concerned to see the tech-heavy NASDAQ coming off into those reports. So lots for investors to keep an eye on here today on the close.
Yeah, I mean, look, the whole group has had an incredible run. And that's one of the reasons why they have to do all this reweighting, because they're just making up too much of the indices. Let's check out what's going on with the dollar. I saw the dollar right at that 100 level, and UK inflation gets a little bit of a break.
Yeah, after an incredible run of its own, right? Talking about the NASDAQ to the upside, I've got the dollar showing some of the weakness we've seen and the trend to the downside.
All right. Wait, give me a second. Put it back to CNBC.
Equates to weakness in the U.S. dollar, recently up to 113. It's coming off here today as well, but I think most of this is due to the British pound, and, well, this is after that soft months for UK inflation, below 8% for the first time in more than a year now. The BOE looks like they're going to target something in the range of just below 6% in terms of their peak rate. But when you have the British pound lower to the extent that we've seen, we just looked at it on the intraday basis. Take a look here at the run-up that we've seen on the daily, because now lower on the day by 4 days in a row. We've come off 131, but you can see it just slowly starting to reverse the trend, if so, in terms of what we've seen. This is the first run we've seen 4 days lower in a while here, and we'll see if this is trend reversal or if we're just going to.
All right. We've got about an hour and 15 minutes before the closing bell, before we get Tesla earnings and Netflix earnings. Tesla off the highs here, sold off pretty heavily. Again, we have Netflix earnings, Tesla earnings at the bell. Tesla hit the lows. $392. Let's put up NVIDIA. NVIDIA cooling off a little bit. Meta made a nice move earlier today, but now it's back at it's back even. Meta, there's a news that came out this morning, I think, that they've already lost half of their Threads users. So I think they reached 100 million in about 5 days or something like that. So half of those users are now gone. Let's take a look at SPX. We are rebounding here. Let's go ahead and check CNBC real quick.
Working on its own large language model, so sort of like a ChatGPT that insiders inside the company, employees can use and test out. And we know that Apple is sort of comfortable being a second mover, so it shouldn't be all that surprising. But what may be getting investors excited, and you saw the stock pop on this news, is the idea that Apple would be able to monetize general AI. It's the same reason we saw Microsoft shoot up yesterday when we heard the announcement that it was going to be charging $30 a user to use some of these generative AI tools. We're at this phase of the bubble, guys. We're still, you know, it still has the ability to mention generative AI to create a pop, but investors want to hear about monetization.
Right. When you have,
you think about Apple's
when you have
user install
almost
base
2
of
billion,
2 billion devices,
iPhone
if
users,
you could simply charge
right?
for some generative AI tools,
iPad
on top
users,
of that, the way
iMac,
that they charge for things like cloud
you have a massive
services, that bring their services
user base.
revenue up so much. That
you know,
is
you
exciting.
can easily charge for
exciting, but I guess
anything, any product, really. So this is going to be a huge move for Apple here.
General doubts over how much Apple is actually focusing on generative AI, but when you take a step back, you see that they are incorporating it into a lot of their different products on the devices, whether that be autocorrect or photos. So it shouldn't be surprising. Remember as well that Apple has a secret self-driving car project that would lean very heavily on artificial intelligence.
Indeed. Deirdre, thanks. Deirdre Bosa, we appreciate it. Over to Dom Chu now for a market flash. Hi, Dom.
All right, so Kelly Tyler Carvana is soaring today on a slew of different headlines. We're going to start with the deal to reduce the company's debt by more than $1.2 billion in a restructuring. So the used car retailers reported around $6.5 billion worth of long-term debt at the end of the second quarter. The company is also selling up to $1 billion worth of stock in a restructuring and capital raising effort. And all of that comes as Carvana reports a much lighter than expected loss per share figure, along with revenue that topped analyst estimates. Now, Carvana stock has
is
now
about
gained over
28%
so far this year,
30%
but it still remains a whopping
short.
86%
So
below where it was during its record highs during the COVID pandemic.
A massive squeeze
So keep an eye
can
on
happen
those Carvana
here.
shares. I'll send
If they decide to take this up,
short interest
it's gonna go up. We might see another GameStop like move, okay, in their stock here. So can it go? Yes, it can. If they squeeze this, 100 is possible. 100 is possible. Let's take a look at Tesla again. Tesla's selling off here a little bit. We got earnings later today. Well, not just a little bit, but it's heavy. It's heavily selling off here. I might just cut my position here. I'm down about $75 here on this position. I might just cut it here. I don't know. Because a move like this implies someone knows something. Someone knows what's happening. Someone knows the news. You know? So does Tesla, rip or dip? But I don't know. I might just cut my position here. I don't know. Down about $75. Let's look at Netflix, which is the next big one that we're looking at. In about an hour or so, we're gonna get those results. Netflix had a dip here on news that it already It already has 1.7 million subscribers or users that signed up. And that they're also cutting the base tier model that they have. If you already had it, you can continue to have it, but as a new user, you cannot have that anymore. But now Netflix is bouncing back, so looks good here. CNBC's back, so let's see what they talk about. Oh, I love Carter.
Moving average has not been on the other side of the 200-day moving average over the past month. Got that? Okay. Our support technician today is Carter Worth, founder and CEO of Worth Charting. I set it up for you, Carter. Take it away.
You sure did, Tyler. So if you think about the circumstance, before we look at the charts, of a golden cross, definitionally it's something that's been in a downtrend, and where current price over the past several weeks is so aggressive that it's allowing for a short-term moving average, a 50-day, to move above a longer-term moving average. But let's look at the charts together and try to figure it out. What you have here is a comparative chart, and what it is 3 stocks: LabCorp, which has nothing to do with BlackRock, which has nothing to do with Best Buy, a retailer, a financial, and a medical company. And yet you can see they're quite correlated. What's leading the way there on the top is the S&P. So let's drill down here a bit and look at the year-to-date chart. And you will see, if you look at this next iteration, what we're talking about. So these are laggards, definitionally, yes, that have not kept up with the market. And you can see the spread is quite wide. But that is the opportunity, which is to say playing for stocks that have not kept up with the market. And so we'll look at them individually, and you'll see, I think, what is an important circumstance in each case. So the first one here, this is LH. And the way I would draw the lines is as follows. We have a well-defined downtrend line, and we have something of a head and shoulders bottom. So that warrants a nice arrow up and to the right. And we're going to look at each of these in turn, and they have the same exact setup. But you see here LH, right, making the turn. We might look at the other two just to make a point. Take a look here at BlackRock, and I'll clear, but you almost don't have to clear it. Watch. Draw the lines again. Here's the head and shoulders bottom, and that warrants the up arrow. And then finally, let's do a third, and then we can discuss it. If we were to look at, of course, the last stock, what is the circumstance? It's the exact same thing. A well-defined downtrend. Stock strength, recent strength, is allowing a move above that downtrend, and of course, the head and shoulders bottom, which again warrants the arrow. So my thinking here is that these are stocks that have an opportunity because what? They've lagged, but on a short-term basis, they are handily outperforming the markets. That's a perfect 1-2 setup. A precondition of underperformance and now nascent, very developmental action of late that is so good that it's outperformance here and now.
So as I look at what you just pointed out there very, very clearly, I see those double bottoms, or the head and shoulders bottoms, and then I see a rise back. But it almost suggests that that upward trend presages another downtrend.
Well, if the sequence was intact, the downtrend sequence, that would be the case. Meaning, if we hadn't made those triple bottoms, right, which is to say we were coming from a new low and then rallying, yes. But the sequence is different now. We haven't made new lows for typically 6 months, and that's what a bottoming formation is. So this strength, this current leg that you're referring to, is confirmation that those lows are quite good.
Those lows are lower than it's likely to go on any pullback.
That's right. That's exactly as you said.
Anyways. Tesla moving up the lows here a little bit. Tesla's North American charging standard to be adopted by Nissan. Nice. Apple popping again. CMG just popped. Elon Musk has gained $119 billion in 2023, more than Warren Buffett is worth. That is crazy. That is crazy. That's insane. It's crazy. While you and I are trying to make $100,000 a year, another guy's making $119 billion in just 6 months already. Insane. That's insane. We are 1 hour away from the closing bell, which means we are 1 hour away from Tesla's earnings and Netflix. Let's check CNBC.
Third of all Broadway shows now start in the 7 o'clock hour, according to Playbill, a rarity before the pandemic. And Uber says trips in the 4 p.m. hour are up nearly 10% since 2019.
What?
I don't know. I guess I go out earlier and dine earlier now than I used to. Maybe it's a function of age.
No,
maybe
I do too.
Maybe it's well, yeah, you got kids. They insist on eating early.
But I wonder, why did it used to be so late? Who are these heroes of previous generations who were just lighting it up at 9 p.m.? They had bigger families than we do.
I got to go to bed earlier. Thanks for watching Power Lunch, everybody.
I'm going to dinner. Closing bell starts right now.
And welcome to a big closing bell. Thanks, Kelly. I'm Scott Wapner at Post 9 here at the New York Stock Exchange. This make or break hour begins with the countdown to two of the most anticipated earnings reports of this early season. Netflix and Tesla, they both hit in overtime. And we're going to get you set before the numbers hit with Alex Kantrowitz and Dan Ives. First, your scorecard with 60 minutes to go now in regulation. More gains for stocks today. There it is, green across the board. The S&P 500 sitting just about 5% away from new all-time highs. The Dow working on its 8th consecutive day of gains, getting help today from Verizon and Goldman, Salesforce, and Cisco. Well, it's been up and down for the NASDAQ ahead of those earnings we're waiting for. Apple, it is mostly higher on some AI-related headlines, not quite as strong as it was when those hit, but nonetheless, it is green. It takes us to our talk of the tape. All that is riding on these critical results. We'll hit Tesla in a bit. First, though, big technologies. Alex Kantrowitz is watching Netflix closely.
Is it's making the right moves as a business to exist and thrive in this economy.
Lost 1 million subs in the year-ago quarter, right? You had 2 straight quarters of sub losses. Why have they been able to reverse that?
Well, password sharing, the crackdown on password sharing has been crucial for them. You know, they had 4 of their highest single-day sign-up, according to some third-party data, right after this happened. When you do that, it just shows that your product is working. People want Netflix. They got used to it over the years, and they always had this lever. They always had this ability to say, all right, enough with the free ride. They said it. They're growing again. That's been huge for them.
Speaking of free rides, the ad tier, right? They just say they scrapped their cheapest one. It's $10 a month. How is this contributing, do you think?
Yeah, right now it's doing okay. 20% of new signups are coming in via the ad tier, right? So that means they are getting some growth from it. We're going to start to see them monetize that tier, by the way. I have hearing Madison Avenue talking again about growing advertising dollars. And there was a long time where the economy was uncertain. They weren't spending. Now they're starting to spend again. That's another incremental revenue source for Netflix.
I'm sure you're thinking about the strikes that are ongoing out in Hollywood. This company has had to think about it less than others in the media space. It just hasn't been as impacted. Now, who knows what happens if it really drags on for many, many, many months. But nonetheless, they've been able to avoid the biggest impact that others have felt.
Oh, yeah. They're in much better position than their competitors. And that's for 2 reasons. One, they have a nice stock of foreign shows and movies. Korean dramas on Netflix are really hitting. I'm in the middle of one right now. Crash Landing Into, super fun. And then there's a lot of reality television that they use. Now, people have been slagging Netflix, saying, oh, it's junk, it's filled with crap. Actually, Americans and people worldwide love watching these shows. Lots of great dating shows on Netflix. They can thrive on those while the rest of their competitors try to figure out what to put in their sites and on TV.
So we're looking at media stocks right there on the right-hand side of our screen, right? And you see the one at the top is Netflix, and it's up 62% year to date. It's outpaced everything, and it's done incredibly well relative to some of its big tech brethren as well. Maybe that's one of the biggest obstacles going into the print. The stock's already up a lot. How do you think about that?
Yeah, it's definitely up a lot, but it's still down from the highs, where it was around $700. So when Netflix had its big drop, this was really a question of, like, can it settle into the right valuation? Can it settle into the right place for a company like it is, which is not, it's really not a technology company. It's more of a media company, and it's been valued, and it still really is being valued as a tech company, but just it can't really live to sustain those highs. It's in a much better spot right now. And, you know, it's down from the all-time highs. It's grown this year. Maybe that's the right place for it.
We've been talking about these mega cap stocks, and this isn't necessarily a mega cap. But when we talk about those, we always cite the execution of the Tim Cooks and the other CEOs who are front and center. Do we talk about the execution of the Netflix management team enough and what they've been able to do, making the transition the way they have?
I think that we do talk about it enough. Now, we don't talk about it too much because the reason why we're not spending as much time on it is it's just a different business. It's a completely different world to build an Apple than it is to build a Netflix. You know, Apple has a mini Netflix inside Apple. It's still building the iPhone. So I give Netflix management a lot of credit. They've come out of a really tough time. They're growing subscribers. They've built this ad product. They're doing everything they need to do. They're insulated in some ways against the strike. But they're just not on the same plane as some of the great tech leaders that we have today.
No, but they've had to figure out some complicated issues. When you're losing subs, like we said, when you're losing 1 million subs a year ago and you have 2 consecutive quarters of declining subs, you've got to deal with the password issue, which they were pretty forceful in. They're like, we're doing it, like it or not. It's worked. The ad tier, which they initially shunned, they decided to do. Don't they deserve any credit for that?
Oh, definitely. I'm not taking away from them as a business. They've executed the playbook perfectly in terms of what they needed to do, where they were, where they needed to get to. I just think that this is kind of it for Netflix. It's a great company. It shows great, has great shows and movies. People love it, but it has a ceiling.
Do you feel like, I mean, I've seen some, I won't necessarily call them bears, but Michael Nathanson, for example, who has not exactly been the biggest bull, declared of this one, this is the one to own in the space. And it's not lost on me either if you look at the comparison between, say, Netflix and a stock price trajectory and versus Disney, it's pretty stark.
Yeah, so
tells you part of the story too.
Absolutely. And I was just on the phone with a former Hulu executive yesterday and said, break down what's going on in streaming right now. His perspective was very simple. All the other companies have focused on profitability. They had to spend, and now they're really pulling back to get profitable. And Netflix has been in that place where it has free cash flow, and in some ways, it's going to benefit based off of the capitulation of some of its competitors. So it does seem like it's going to consolidate a lot of ground in this space. And you know, maybe we change financial conditions, and the others have the ability to spend again. But until they do, Netflix does seem like the lead horse here for sure.
Netflix investors are, usually confident going in. Jason Snipe is one. He joins us now, Odyssey Capital Advisors. It's good to see you. Are you optimistic, and how does the stock's gain already leading up to this day factor into your thinking?
Yeah, so I think Alex made a couple of really great points about just where the stock has been. And obviously, it's up 62% year to date. But to your point, that we're looking at ads this quarter, 2 million subs, which I think is really solid. And I think, as we talk about the management team and what the market has rewarded Netflix for this year is crack down on the existing base, right? So password sharing, expect to add $9 billion in revenue by 2025. The ad-supported tier expected to add $770 million in revenue by the end of this year. So the market has rewarded these 2 line items, that obviously Netflix is focused on as being accretive to the balance sheet. And I think that's why the stock has moved so much this year.
Do you worry at all about a sell on the news that the stock is run, even though the story's great, and people just get a little bit skittish about, expanding valuations and the like?
Definitely. I mean, one of the things as I'm kind of looking at the stock, as we've already mentioned, it's up a lot already this year. I mean, the options are implying a move of 8.5%, either way, right? So I think that obviously can be concerning going forward. But I do think there's story. There's still some legs to this story, and I think they're in the early innings of this ad-supported tier and password sharing. There's a lot more market share to gain there, and I think that's why we could still see some movement going forward.
We've been, Alex, we've been citing all of the positives that have been around this story, the reason why the stock has had its 60+% gain year to date. What are the risks? What are we not thinking enough about that we maybe should?
I mean, the risks are that the economy turns. When the economy turns, maybe we get back to inflation and the Fed has to raise even more, and there's more scrutiny on all these businesses. We know they're not immune to shocks, right? The fact that they went down, Netflix, for instance, went down from 700 and has only inched its way back up to the mid-400s is an example of that. It looks like we might be out of the woods, but we're not clearly out yet. And there could be some surprises on the way for every tech company if that happens.
How about that, Jason? We look at these gains and we think that everything is great. Are we ignoring some of the more broad risks that are just out and round that could ultimately come back and have an impact on a company like this?
There's no doubt about it. I mean, we see it everywhere, right? Obviously, our main focus has been on the consumer, and the consumer has been hanging in there. And then, of course, the headwind potentially with what's going on with the strikes in Hollywood. Now, you know, obviously it's been well written about what Netflix has done internationally in the studios that they've built through the pandemic. You know, shows like Lupin, Squid Games obviously have done very well, and there's been a lot of demand there. So not that they're completely immune to what's going on from a consumer perspective, and also potentially what the strike, what the issues might lay down further from there. But I do think that they're still well positioned and better positioned than some of their other players, like we've talked about Disney and some of the others that are out there. So that's why I continue to like the stock here.
Yeah. What about big tech more broadly? How are you thinking in general as we say this is the curtain raiser on what are, you know, the most closely followed reports of the season?
Yeah, so I think with big tech, we've seen actual economic activity around AI really at the very foundational layer. That means people are paying OpenAI for ChatGPT and other API access, and they're paying NVIDIA for those GPUs. What is built on top of it? Because remember, a lot of this rally has been driven by artificial intelligence belief, really. It's been a belief that these companies are going to turn these innovations into something bigger.
Hype and hope.
Hype and hope, exactly. And so what I want to hear from Amazon, for instance. What is AWS doing to enable its customers to build with AI? I want to hear from Meta how this AI, generative AI in particular, has helped its advertising business. All across the board, there's going to be big questions for these companies in terms of whether they've turned that hype and hope into dollars. And that's what it's really they're going to be riding on for this quarter.
You see a lot of the stocks that we're just flashing through as you were speaking are down today, except for Apple. Speaking of AI and hype and hope, maybe that's been the lone holdout of the most marquee of names in this market in terms of what their plans may be as it relates to AI. Got nothing at WWDC when we were out there. There's a headline out there today on what they might be working on. The stock spiked off of it. It's still in positive territory. How are you thinking about that one?
Yeah, I mean, it was kind of bananas to me that the stock would spike over 2% on this Bloomberg report. Now, I think the Bloomberg report is right. Every company, it's table stakes. They're all working on ways to implement generative AI. But in the first paragraph of that report, they say they have no idea how they're going to bring it to consumers, and the market sends it up 2%. Now, of course, it's moderated a bit, but it is still positive as everyone is negative. So it just indicates to me there is an over-exuberance around AI with investors right now. Can Apple implement something? Sure. Do they have a really good track record of doing anything like chatbots or consumer applications? No. Are they going to license this to other companies? That would really be bizarre for Apple. So it really just, it's puzzling to me why investors, you know, there's almost this FOMO factor. Yeah. You hear AI, throw the money. Why are we doing that?
What's the answer to that, Jason? You're one of those who are continuing to throw the money at these names. Do you see an over-exuberance around AI? And if there is around AI, how can there not be around the AI stocks?
Of course. I mean, at the early stages of any of these, like, you know, very unique technologies, I think stocks really move, and clearly that we've seen that in the first half of this year. You know, for me, as it relates to Apple, you know, I just look at their enormous consumer base, right? So they have a lot of data. You know, AI, generative AI is going to be productive in some shape or fashion. I think a lot of companies and firms are trying to figure out ultimately how that's going to play out. We'll see. I mean, if we thought that Apple was going to take a back seat and watch all the other Magnificent Seven companies participate and not get involved, I mean, you know, I think you're missing the boat. But ultimately, they'll do some beta testing internally and see how it plays out. And then I'm sure they'll bring something to market in 2024, and we'll see how that works out.
The other stock yesterday, Alex, that popped was Microsoft, some 5%. To a new high, and you generally don't see a stock like Microsoft move 5%. It makes me think about what role Alphabet plays in your mind on where we're going from here. If they've ceded too much ground to a Microsoft, and what you expect when they report and what they have to say, if they really have something big to prove.
Yeah, I think investors were wrong on the Microsoft deal yesterday. I mean, it's about Office, AI in Office. I'm right now in a test group that's using Google Docs and Gmail that has a Help Me Write button in there. So the generative AI is available for free within Google. and Google is keeping pace. So for anyone who's given up on Google and said Microsoft has won this, that just strikes me as a totally incomplete picture of what's going on in the market.
So do you think that Alphabet was unfairly punished, at least from a stock standpoint? Now, it's caught up in some respects. I mean, the stock has done well, as everything in that area has. But the early narrative was that they got caught sitting down when Microsoft and others were running.
Yeah, I mean, investors were right to be skeptical of what Alphabet was doing. I mean, they sat back. They had this technology internally. They sat back as OpenAI and Microsoft brought it to market, and not only did that, but created unbelievable hype and shine around their brands. Now it's time to catch up. I just don't think it's hopeless for Alphabet. These tools inside Docs and inside Gmail, they're good, and they're just going to get better, and this is a multi-year battle. I mean, 2023 doesn't just end, and all of a sudden, Microsoft wins. Like, they have big engineering teams that are working on this stuff. It's already live in consumer products in beta, and it's just going to continue to roll out and get bigger. So it's not over for Alphabet by any means.
It's the perfect place, Jason, for you to have the last word because you own so many of the stocks in this group.
Yeah, no, absolutely. And I think for me, as it relates to generative AI, as I mentioned earlier, I think obviously these new technologies will definitely be productive new assets to a lot of these companies. And I think we just have to, we're very much in the early stages, and we just have to kind of really watch the technologies evolve and see how companies are able to put them to use. And I think all of us are obviously evaluating that at this time. And of course, there's been some overexuberance early on, but I think we'll start to see the real players emerge as we move forward.
All right, guys, I appreciate it. Jason, thank you. I'll see you soon. Alex, I know we'll see you soon as well. Let's get to our Twitter question of the day. Will we see record highs for stocks this quarter? Told you at the very top of our program, we set some new 52-week highs today for the three majors. Dow right now is up 157. You vote yes or no, please, on Twitter at Closing Bell. We'll tell you the results a little later on in the hour. Let's get a check meantime on some top stocks to watch as we head towards the close. Christina Partsinevelos is standing by with that. Christina.
Well, Joby Aviation is falling today as JP Morgan downgrades the air taxi company to underweight. Analysts are concerned that the path to commercial operations could be slower than investors were expecting. And that's why you're seeing shares down, what, 16%, almost 17%. The stock, though, has more than doubled just in the past 3 months amid excitement over the FAA's permission to test Joby's prototype. Point of sales provider Toast is removing its 99-cent online order processing fee just days after it was first introduced nationwide. There's been widespread backlash from restaurants that forced Toast's CEO today to admit they made the wrong decision. Market didn't like that reaction, though. Shares are down over 15% right now, Scott.
Yeah, paging Josh Brown. Paging Josh Brown.
I know. A lot of our viewers noticed how bullish he was on Toast yesterday.
Yeah, they seem to notice everything. Christina, thank you. We'll
That's
see you a
good.
little bit later.
Thank
Yes,
you.
it is. Yes, it is. Christina Partsinevelos. We're just getting started. Up next, Tesla's moment of truth. The company gearing up to report earnings after the bell. Shares have surged more than 60%.
This is a nice bounce. Let me see. I should be positive here on this. Still down 10%. $10. Down 5. $40 minutes. In just 40 minutes. Meanwhile, Netflix right back up. Rip. SPX right back up. Look at that. I'm telling you, man, this is the market that we are in. Okay? When you see a dip, you buy it. You see a dip, you buy. That's the market we are in right now.
pay for my time.
Dan Ives is on CNBC. We got to see that.
To ultimately do, to go after volumes, cut costs, cut prices. But I think the price cuts, 95% of it is in the rearview mirror. So I think now you're starting to see ultimately stabilization there. I think battery cost, ultimately that's coming down. It gives them a tailwind, scale and scope. And ultimately I think as we go into this year, this is now going to be that trough moment. I think it was a moment of truth. And ultimately I think he continues to play chess, others checkers.
Why do you think the price cuts are done?
Just from a demand perspective, what we're seeing specifically in China, where there's really been a price war going on, we're now starting to see demand continue to uptick. And I think that's important. This is going to be a record China quarter. That'll be a big focus in the call in terms of how Musk talks about from a demand perspective. And also margins in China are incrementally higher than in the U.S.
You don't think we're going to get a potential price war here in the U.S.? I mean, you look at what Ford did with the F-150 Lightning, you drop it by $10,000. No surprise that they do that after Musk has repeatedly done it. You know, they're coming out, Tesla is, with the Cybertruck. I mean, how do we think about all of that in the context of a potential price war here?
Yeah, I think for Tesla, I mean, they're in a massive position of strength because of those margins that are just so far above the industry.
Sure, well, Musk wants to remain in that position of strength. That's my point.
And to your point, I think Farley and Ford, they heard the footsteps of Musk. They hear the footsteps of Rivian. I do think that was a smart move for them. But ultimately, if you look at Tesla, you know, they really continue to be more and more a position of strength because they could do this. And I think I don't really see a price war in the U.S. because today, from a demand perspective, we are still in the first inning of this EV green tidal wave playing out.
They already reported, you know, amazing deliveries in the quarter, right? Up 80-something%. We're going to get anything that you're paying attention to, especially closely on the delivery angle today?
Yeah, I think they'll probably tip the hand a little about potentially delivery second half of the year. What I believe is going to be toward that 2 million vehicles overall for the year. Streets call it 1.8 million. That's important because now we start to get over that 2 million mark into next year. With Cybertruck coming in terms of that drum roll, also expect an update for them to reiterate productions on par. Look, I mean, the bears will focus, of course, there'll be certain things to focus on, margins and some others. But I believe if they call it trough, line in the sand, this is a stock that ultimately heads back toward 350.
I mean, you point out the bears are going to point to negatives. I mean, the stock's up a lot. Gross margins are coming in. So why do you necessarily have to be a bear on the stock to point out some of the concerns that exist on those really, I think, key metrics?
Sure.
Why can't you just be a realist on sort of where things are relative to where they were, both in terms of price and in terms of margin?
No, and it's a great point. I think clearly you've seen gross margins come down significantly. I think that was the right move. I think it's really looking forward, because I think the major change in the story is that AWS moment in terms of the supercharger, Ford, GM, 313 area code now using Tesla. And I think the next steps, it's battery, and the big drum roll, what I view as sort of the Super Bowl for them, it's AI. Because I could argue from an AI perspective, that's not even priced in here, which is why I think they're really, right now, I think ultimately just starting to sort of turn the corner on that strategy.
What about Cybertruck? What are your expectations there?
I think that's, if you look at it coming out of the gate, I think you'll start to see deliveries early next year. You'll see ultimately 200 to 300K units as it sort of gets to some sort of scale. And then you look what's happened with F-150. I mean, this is something for Tesla that's just going to add to the overall growth, as well as what they're going for in the consumer. And it's going to give them more scale in Austin, which ultimately is just going to be a big part of their success, especially on the battery side.
You haven't mentioned the name Twitter once during this conversation yet. Is that overhang over in your mind? You cited it before as a near-term risk. He reveals the other day, Elon Musk does, about the financial issues that Twitter is still having. You don't think there's any potential overhang that still exists between his multiple jobs, if you want to put it that way?
Look, I ultimately think that the interview heard around the world, the Faber interview, I think that's where investors really better understood Musk's strategy, even when he talked about Twitter. I think the biggest risk, does he sell more stock? I mean, of course, there's always potential, but I do think most of that, Scott, is in the rear view.
Why is it most in the rear view?
Some say to some extent on the advertising side. Clearly, Linda has a lot more work to do in terms of the platform, but I continue to view Threads as barks worse than the bite. I don't really view that competitively, that's what I'll call a Twitter killer.
So let me ask you about Apple before I let you go, obviously, because you're one of the most notable analysts around that stock. You have the announcement, or at least a report, no announcement, a report today sends the stock up 2%. What are their AI aspirations? Do you as an analyst feel like you have any grip on what they're really working on and what ultimately it might mean in terms of added earnings per share?
Yeah, I mean, our sense, I mean, from covering out for many years, is that this is all going to be the build out. It's a matter of when, not if, that Cook and Cupertino come out with the AI App Store. And I believe that adds $30 to $40 per share to the overall Apple story. They'll continue to stay close to the vest in typical Cupertino fashion, but it's an install base, a golden install base where AI is just going to be the other piece. And in my opinion, that's why it's part of a $4 trillion 2025 thesis for Cook and Cupertino.
All right, we'll talk to you soon. Dan Ives, thank you.
Thank you.
All right. Up next,
All right, back to the charts. $30 minutes. 30 minutes until judgment. 30 minutes until judgment. Tesla, nice rebound here. Netflix is now at high of day. Someone must know. Someone must know what's happening. We have got Tesla earnings, Netflix at the closing bell in 29 minutes. 29 minutes. I am in this Tesla move for next week, 3:30. Can we get there? I am currently down. I am currently down $10 on this trade. Early MOC imbalance, 627 million. Buy side. Carvana, man, big pop again. Again, if this can break 59, if this can break 59, we can get, it can get to 70, 77.
Is just that there are so many other things to get done. You have the defense authorization bill in the Senate, you have the FAA authorization bill in the House, and then you got to try and figure out how to fund the government. So even though there is growing momentum for this, there are still some lawmakers who have concerns about it, and there's just so many other things to get done that it is hard for congressional leaders to really give this the priority.
Emily, appreciate it very much. It's Emily Wilkins down in Washington, D.C. for us. We'll continue to follow that story. The Dow heading up for its 8th day in a row. The longest winning streak since September of 2019. Our next guest says the market rally just beginning. If the Fed pulls off a soft landing, that is. Joining me now, Alicia Levine, BNY Mellon Wealth's head of investment strategy and equity advisory solutions. It's a big title.
Big title.
What are your big thoughts on the market? As you know, some on the street are now taking up their targets.
Right. So we've taken up our targets also primarily because the recession is nowhere in sight. And while we do have a 40% chance of recession over the next 12 months, That's getting almost close enough to the average year of 20% if you add 2 years in a row. So the data so far are telling us in the next 3 to 6 months the recession's not happening. And if that's the case, earnings will go higher than expected, and then the multiples will move higher and the targets go higher as well. So far, you know, credit to the Fed, because they pushed on this, and there was a lot of skepticism that they could actually pull it off. I'm not 100% certain, but I'm more certain than I was.
No, because people say it's too soon to sound the all clear.
I think it probably is too soon to some extent, but if you look at what look, if there's no recession, you're then forced to say it's different this time. So if you say it's different this time, you have to say, well, what's different? I think the antecedents are different, meaning there were no imbalances in the economy. You didn't have credit stress going into this. You have a mortgage market that is essentially a 30-year fixed at under 3%. So the normal transition of a higher Fed interest rate is not damaging the housing market to the same extent. There are pockets. So I would call out regional banks as an area of potential concern. Clearly the real estate issue, $1.5 trillion coming due by the end of 2025. Those are areas of concern. And then not least is yield. So if yields stay below 4%, we're in a happier place. And you saw last week when yields got above 4%, the market didn't like it.
Yeah, well, we came down pretty quickly off that. I mean, your overall point is that things were different at the beginning, so they may in fact be different at the end.
They could be. And I think we have to open our minds to that this is not automatic. So the normal way that you get credit contraction and the normal way you filter tighter Fed policy, just very different. And let's talk about fiscal policy. Fiscal policy also apparently works with long and variable lags. And the Biden administration has passed $2 trillion worth of spending that is now going to be poured into the economy, mostly in the industrial sector. So if that's where earnings are coming from, you've stabilized earnings as well. It's just a different cycle than it was in 2006 and 2007, which I think most people were concerned about.
New highs this year? What do you think? It's the poll we asked our viewers today.
I'll say this. I think it's entirely reasonable with no recession to end the year with a 24-month retracement to the old high of 4,800. That seems reasonable based on history if there's no recession.
What about where valuations are right now? What some would say are just too rich to the historical average of the S&P relative to where we are and where earnings are now, and that expectations for 24 are just still too inflated.
Okay, so let's take out those top 7, which are trading at 40 times forward 12 months.
I knew you were going to go here,
you
right?
Knew it. Then you're
well, that's because that's the comeback that people have for you. You take those out.
Look what's working. Financials, healthcare, you know, and even energy's gotten a bid. So the areas that were left for dead are actually starting to work. Small cap are starting to work as well, which is telling you that if we have some sort of a cyclical recovery, then the earnings have to go higher. It means your multiple's not going to be as high as well.
Transports have been working. I mean, other areas beyond tech are starting to look pretty decent.
Right. It feels concerned. Like, look, we're paid to worry. Right. That's what we do. We worry. You have to worry about the left tail risk. I just think that the downside is not as dire as when we came into the year, and so therefore you have to start looking to what can go right, and this is what can go right.
Well, you know, a raging, or at least a, you know. watching. Hey, Pippa.
Hey, Scott. Elevance Health higher today after beating quarterly estimates and raising its full-year guidance. The report follows a beat from United Health last week, and the optimism is easing concerns over a slowdown in medical procedures, which United Health triggered with a warning last month. Meantime, shares of AT&T rebounding after yesterday trading at a 3-decade low following the Wall Street Journal's investigation on lead cables. The company saying lead-clad cables represent less than 10% of its copper footprint of roughly 2 million sheath miles, while also saying it strongly disagrees with the journal's conclusions. The stock higher for the first time in 11 sessions, with Verizon
15 minutes. $15 minutes till the close. Netflix dropping. Netflix dropping here. Look at that. Tesla hitting the lows again. Yikes. Look at that dump on Netflix. Got that dump. Get a wider. Almost time, guys. Almost time. 10 minutes.
As well. It's not the only major report we're watching. Julia Borston on Netflix numbers out as well. Mike Santoli, begin with you. Front and center, Netflix, Tesla, your thoughts?
Yeah, obviously the market is kind of out on a perch when we're getting these numbers, and it's the kind of stocks that have been mostly the recipients of the enthusiasm. So interesting test on how they're going to be received. Very different, though, in a sense. Netflix perceived to be a very clean fundamental story. They have all those levers that they're pulling. The buy side really loves the story. The sell side only now migrating. So kind of interesting. Whereas Tesla, it's about how much the margins maybe go down, and does it matter, frankly, because that stock sort of moves on its own fumes.
Their importance right now, especially, is what?
It's significant, I would say, to that class of stocks. I'll be honest, I'm also looking at things like banks all of a sudden getting overbought even after they've had this nice rebound. So there's a lot of things that have been working together to keep this market kind of calm and in this uptrend and extending this rally. And so we'll see if any of them fall away right here as I watch the volatility index again perk higher as the S&P goes up. So people are starting to wonder if we're in for a culmination of this little rally, at least in the short term.
You made me look at Goldman Sachs, which is green, and most of these bank stocks, to your point, lately back on the back of earnings have been green.
It's been tough to get on the market's bad side, even with bad news, in the very short term. So I do think we'll see if that continues, if basically we're going to forgive a lot during this earnings season, and frankly, if it's really just people sort of emptying the tank of buying power because they haven't participated enough in the upside.
Phil LeBeau, one of the most heavily shorted names in this market for some period of time has been Carvana. Up 39% today. That's got to be, part of the story, covering a little bit there.
Sure. And Scott, this is what happens when you deleverage with a debt exchange. And let's be clear here. A lot of retail investors, and I know they're not all the shorts, but a lot of the shorts are retail investors. I don't think they've understood that the story with Carvana has been how much leverage it had. Well, they eliminated a lot of that today with a debt exchange, essentially getting rid of, or not rid of, but converting about $1 billion, exchanging some bonds for new notes, delays in some of the interest payments over the next 2 years, and the new notes will be secured by company assets. Oh, and by the way, they're going to be issuing $350 million worth of new shares. That will go towards the debt exchange. By the way, Ernie Garcia and his father will be required to purchase about $126 million of that offering. But again, Scott, this speaks to the question of know what you're investing in. So many people would say to me, Carvana, that's really a play on the consumer and used car sales. No, it was a story of a company that has been dealing with massive leverage.
Yeah. Let's get a thought from Mike Santoli. Phil, hang on just one sec. What do you think here?
Yeah, I mean, obviously a very impaired balance sheet that's now being fixed. And it's a lot of stocks that were sort of once left for dead, and there was a significant chance of equity going to zero. Now that's off the table, but there's your 2-year chart. So you see what a complete kind of boom time story that was at the opening day. We're going to revolutionize this world. And it was never, to Phil's point, about really the ebb and flow of the secondary car market. It was all about how they got too aggressive on the balance sheet. That's being fixed. But again, let's forget about where it traded back in 2021. For now, it's more just a survival story.
All right, Phil, set the table for us on Tesla, the biggie that you're looking for in OT today.
Gross auto margins, excluding zero-emission vehicle credits, 16.9% is what the street is expecting. Now, I've talked to Dan Ives about this and with other analysts. The feeling is if it comes in around there, we may not see much of a reaction with Tesla shares. If it comes in well below there, let's say in the 15% range, yeah, maybe you're going to start to see some sell-off with Tesla shares.
You know what, Mike? You could come up with a bunch of, or you could try to come up with a bunch of question marks, and the bulls come right back at you. You say, well, gross margins, maybe drop to the most in 6 years, and they'll say, yeah, but look at the demand that they're spurring by cutting prices the aggressive way they have. Choosing growth over profitability is Musk's winning strategy here.
Yeah, exactly. It's the kryptonite that helps them to fly somehow. Earnings estimates for 23 and 24 are down more than 30% since the start of this year for Tesla. The stock, of course, is up, 130%? So it shows you that it's moving on something else, which is the long game of, guess what? There aren't real easy alternatives in the EV space from the rest of the manufacturers, and it seems like they, for a while, are going to be permitted to try to play that market share game in the long term. It is fascinating to hear what they might say about competition from things like the price cuts on the F-150, because that's where they're not the incumbent. Electric pickup trucks, they're just getting into it. So it's kind of fascinating. I think it's a complete eye of the beholder stock, and we'll see what the setup means for the reaction.
All right, and Phil's going to deliver it to us in overtime. Phil LeBeau, thank you very much. Now to Julia Boorstin, who's waiting on Netflix in overtime, and they're looking to show us all that they figured this out. Julia, right?
Well, there are really three key issues that I see as being in focus in Netflix's earnings. First is the strike. Analysts saying that Netflix is actually better positioned than the rest of the entertainment industry when it comes to the strike because of its international exposure as well as its backlog of projects. Second, there's Netflix's password sharing crackdown, and third, the success of its relatively new ad-supported business. We'll have to see how these factors impact its subscriber numbers, which are projected to grow by about 2 million in the quarter. Now, just today, Netflix announced it is no longer offering a basic plan for new or rejoining members in the U.S. and the U.K. as it pushes its standard tier with ads, which it says generates higher revenue. Now, overall revenue is expected to grow 4%, while earnings per share are projected to decline by 11%. Netflix shares are up about 62% year to date, and analysts are still bullish. Half have a buy rating, 43% have a hold rating on this stock. Scott?
All right, Julia, we'll look for an OT. Quick word from you.
Well,
Michael?
I think the way you might look at it is, given how well the stock has performed in the last year or so, or last 8 months, there's 43% of analysts yet to be persuaded that it's a buy here. So, there's another way to flip that. I think it's being perceived as a net positive that they're getting rid of that ad-free basic tier, that they feel like they have the ability to do that. I think it is a lot about how much they say the password crackdown has legs to it, as opposed to it just being maybe a one-time rush of new members.
All right, so you're going to get 8 in a row for the Dow.
Yeah.
You got new 52-week highs for all 3. 35K above that on the Dow.
Yeah, a lot of the hurdles are being cleared, at least in terms of round numbers. The S&P 500, again, we're getting into a Friday monthly expiration. The futures trading above 4,600. A lot of this stuff is getting toward where you might say, maybe enough.
All right.
Now, but the trend is so strong, the pullbacks
Here we go.
Very modest, that it's hard to get too disturbed. There's been this outbreak of calm among investors that it seems like it wants to last a little longer. I mentioned the volatility index. I don't get too caught up in the day-to-day of it, but it's got this floor around 13. It's up today when the S&P is also gaining. It just shows you people are at least tensing up for the fact that once we get the meat of earnings season and the big
Netflix very volatile here.
we might have to brace for just a little bit more two-way action.
At some point, you're going to have to go from hurdle to maybe a high jump and then to a pole vault as expectations get ratcheted up as this market continues to go up.
Yeah, unless we just get a little more of a pure momentum move and have everything kicking in at once, and then you get much more extended. To me, the bigger risk is that sort of upward spiral of hot money kind of feeding on itself, and that's going to eventually make it unstable, but it really hasn't so far. I wouldn't get also caught up in the year-to-date return of the NASDAQ 100. It really is a round trip. It's still a few percent from its all-time high.
Yeah, triple digits for the Dow. It's going to be 8 in a row, as I just said. And now we gear up for those big earnings in overtime. Cannot wait for that. Nork and Morgan and John, and they're going to take the ball right now.
Wow.
Well, you got your scorecard.
Netflix down 5% in
overtime. I'm John Fort with Morgan
post-market
Brennan,
here.
And the Bulls running wild on Wall Street again as the Dow extends its winning streak into an 8th day.
And now investors are set for a massive hour of earnings. We will break down results from Netflix, Tesla, United Airlines, IBM, Las Vegas Sands as soon as they hit the wires.
Plus, Unity Software now allowing its developers to create game and app environments for Apple's Vision Pro headset. Coming up, the company's CEO tells us what that partnership means for gaming and for his bottom line. Let's get you ready for this busy afternoon of earnings. Joining us now is Adam Crisafulli, Vital Knowledge founder, and Victoria Green, G-Squared Private Wealth CIO and a CNBC contributor. Guys, welcome. Victoria, so
Thanks, John.
The KBE's done well. The KRE, I think, is up 9. But hold on, we've got United numbers out already. Let's see, Phil LeBeau has the numbers. Phil?
Hey, John, this is a beat on the top and the bottom line. And on the bottom line, it's the beat that people at United are going to be loving for a while. 503, that's what they earned for the second quarter versus an estimate of 404, almost $1 better than expected, with revenue coming in better expected at 14.17 billion. And as you look at the quarter, the numbers within the numbers, strong across the board. Revenue up 17% versus the second quarter of last year. Pre-tax margin of 15.3% on the high end of their guidance for the quarter. Passenger revenue per seat mile up 2.2%. Cost per seat mile was also up 2% for the quarter. The guidance is what's going to get a lot of attention here. They are issuing third quarter guidance for the first time, 385 to 435, well above where the street is right now. And for the revenue, they're expecting an increase of 10 to 13% compared to the third quarter of last year, with capacity up 16%.
So Netflix beat earnings.
And then the full year guidance, the company is now raising it. It was
Revenue
$8.52
billion versus 8.67 billion estimated. 2Q streaming paid net change.
You do not want to miss. We'll have him tomorrow.
Estimated number was plus 2.07 million. Massive beat. Massive beat. They came in at 5.89 million Now we're just waiting for Tesla. We are just waiting for Tesla. Netflix just flat in after hours here. Was down 5%. Now it's just flat. And we are waiting for Tesla. Here, let me put up the chart. Let's get TSLA. Tesla. Oh, Tesla moving. What did we get? Beat on revenue. Oh, gross margin for Tesla 18.2. Oh my God, that is bad. Ooh, that is bad. 18.2. That is bad. That is bad. Tesla still got $332 million worth of Bitcoin. All right, let's check CNBC.
Feeds the other. You push more people to take on more accounts. Maybe they start thinking about it from a more budget-conscious standpoint. Julia, thank you. Adam, I want to get your reactions to that, especially when you did see net new ads more, almost 3 times greater than the street had anticipated for Netflix.
Yeah, very impressive net ad numbers, obviously. We'll have to dig through some of the details as to why the top line fell a little bit short, but that stock had an enormous run into this
Tesla
release.
pushing up
the fact
here.
that it's flat to down small is a huge victory. So I think the core numbers are very healthy. Business looks very much on track. They talked about their 2 big initiatives, which is the end of password sharing and then the new advertising tier, both of which seem to be moving in the right direction. So I think, everything's working, everything's firing on all cylinders at that company. And the fact that, again, it's holding on to the bulk of its gains is impressive.
Okay, Tesla earnings are out as well. Phil LeBeau with the numbers. Phil?
John, we've got a beat on the top and the bottom line. Tesla earning 91 cents a share. That is 9 cents better than expected for the quarter. The estimate was for 82 cents a share. Revenue also coming in better than expected at $24.93 billion. The street was expecting $24.4 billion. Operating margin of 9.6%. But remember, what we're looking for are the gross auto margins, excluding zero-emission vehicle credits. We have not come across that yet. One interesting note, though, Tesla is not changing its guidance for full full year deliveries, still keeping it at 1.8 million. There had been some speculation that the strength of the first and the second quarter, along with the expectation of increased production in the second half of this year, might lead the company to increase its guidance. But at this point, they're sticking with deliveries of 1.8 million vehicles. Guys, back to you.
Phil, how usual or unusual is it to see Tesla change delivery guidance?
I did not expect it. I talked about it this morning on Squawk Box. If they're going to do it at any time, Morgan, likely they would do it after the third quarter. I just think that this time of year, I wouldn't expect them to do it.
Okay.
All right, Bill, thank you. Tesla right now higher by about 1%, but it's been bouncing around, as have many of these. Mike Santoli back with us. Netflix a little bit lower, Tesla a little bit higher. That's not what the options watchers were expecting.
No, I mean, the results are good, but pretty much within the zone of expectations. And it seems that both companies being relatively measured on guidance. Netflix raising guidance a bit, but not really promising that much in the way of future revenue and price increases. Now, free cash flow is going to be better for Netflix because they're not spending as much on content. It'll be an interesting test as to whether the market likes that idea of a lower run rate of new content or not. So seems steady as she goes for both of those in terms of the reaction. And by the way, also on UAL, given the magnitude of the beat that was just reported in EPS, the guidance for the full year raise is again relatively restrained because you have to filter that into the year-end numbers as well.
Absolutely. Taking that into account, Mike, thanks. And now we're not done. IBM earnings also out. Christina Partsinevelos has those numbers. Christina?
Well, we got a mixed report for IBM. Earnings per share came in at $2.18, which was a strong beat, 17 cents higher than the street. That was driven by higher gross margins. But revenue came in a touch light for the second quarter in a row at $15.48 billion. I just got off the phone with IBM CFO Jim Kavanaugh, who tells me the miss is entirely due to currency. That's an 80 basis point hit. There was some growth impacted by its slowing infrastructure business. They launched their first mainframe product last year. It's a highly cyclical category, fewer orders now. The company, though, did reaffirm its full-year revenue guidance and free cash flow of $10.5 billion. I asked Kavanaugh about the product mix right now in the second half of the year, given software is the clear winner. He agreed software would play an outsized role, but he did highlight growth specifically in their Red Hat subsidiary, which also includes hybrid cloud products. He also said IBM sees the same kind of software growth with their generative AI business, think Watson X, in the coming year, which should also help drive its consulting business. So right now you're seeing the reaction. EPS, strong beat, revenue, slight miss, reaffirmed full year.
Christina, thank you. Morgan, I was talking to IBM a little bit as well about the quarter and this infrastructure cycle with mainframe. This is what you tend to see. It's when it slows down. It slowed down a little bit more than the consensus on the street was expecting. But then also, you got to look at security. The line for security here was a little bit weaker on the top line than people were expecting. Look at the mix when we get into the call between services and software revenue in security. It seems like the consulting business, the services was a little light. When you look, certainly consulting came in at about 5-ish, a little bit lighter than the street was looking for. Also, automation, that line within software, a little bit light. That's around 15 to 20% of IBM's software portfolio. They just did an acquisition in that area, so it'll be interesting to see what they have to say about that. But again, that full year free cash flow guidance that Christina mentioned, maintaining at $10.5 billion. A lot of people were wondering about that. They're maintaining, so that's good.
Yeah, when I see Red Hat up 11%, I mean, is that basically in line, or does that represent further deceleration of growth there?
Oh, no, I mean, Red Hat is outperforming within software.
Got it.
And that is, I mean, Arvind's known for being, you know, kind of the chief shepherd of that deal. So the fact that software is what's stronger here is a feather in IBM's cap. You just want to see that expanding, perhaps. We'll see what they have to say on the call.
All right. Of course, shares of IBM trading just above the flat line right now.
Yeah.
We got another earnings mover out right now. Las Vegas Sands. Contessa Brewer has the numbers. Hi, Contessa.
Hi there, Morgan, and I can hear Sheldon Adelson right now. Yay, dividends! Las Vegas Sands is reinstituting quarterly dividends for the first time since the pandemic, 20 cents a share. Meanwhile, a beat on top and bottom lines, earnings of 46 cents a share adjusted, 43 cents was what was expected here. Revenues come in at $2.54 billion against consensus of $2.39 billion. What a difference a year makes. Last year, this quarter, they'd lost $1 billion. And in the all-important earnings gauge in the casino world, adjusted property EBITDA, both locations in Macau and Singapore bested expectations for a total of $973 million. That's 82% of 2019 levels. They're getting there. The call starts shortly, where we expect to hear more details about what Sands plans to do with all its cash. You can see, though, that the shares are down 2.5%. We saw a bit of a plummet there. I don't know whether they were hoping for sort of a blowout earnings report a la what we've seen in Las Vegas, or maybe that dividend is great, but not great enough. We'll hear more on the call to come.
Okay. And we know you're going to be monitoring that for us with those shares down 2.5% right now. Contessa Brewer, thank you. All right, we got to go back to our panel, and we have an all-star panel. We've got Adam Crisafulli, Victoria Green, and Mike Santoli, all still on tap. Victoria, I'll go to you. It's almost like cafeteria style. We just heard from so many companies across so many industries. What jumped out at you the most?
Some of it, I would say Tesla and Netflix are obviously the two everybody was most interested in today. Yeah. And I think for Tesla, we really want to hear what they're going to do if we're going to get that robo-taxi, if we're going to get that autonomous driving, because the stock is only worth $918 billion if it's a technology component that comes in. Investors are expecting them to come through with that. So I think we need to hear what they have to say about the Cybertruck, what happened with inventories. You know, obviously it was great that they beat on revenues even with the discounting. So that was a relief. But I think we really need to get some updates. You know, when are we getting Cybertrucks, and when are we getting autonomous, fully self-driving? Because the full self-drive, it's expected Tesla's going to get there first and get there soon. And I think investors are betting on that, and that's why the stock is worth so much right now. So I think a lot of that's going to be in the guidance. Netflix, I just like this stock. I know they missed a little bit on earnings, but I think what they're doing is so smart. They're driving people to the ad-based sphere, which is priced 15% below the paid sharing. So they're driving brand new subscribers that maybe have been leeching on to actually having their own profile, and eventually they may move through. I want to see what their average revenue per user ended up being, and I do think they're well positioned with their content pipeline to really benefit. Even if the Hollywood writers and actors strike drags on, they're probably best positioned in the media stocks to weather that, and they should get a lift from the dollar because about 50% of their revenues are international, providing them these growth markets. So both of those, again, we're going to have to hear some commentary.
All right, Adam, I bet you weren't expecting me to ask you about United, but I'm gonna, because it's up more than 2.5%. And that actually qualifies it as one of the bigger movers, which, again, is not what the options market was expecting. Does that tell us anything about airlines and room still to run, or is this just a one-off?
No, I think there's been a lot of concern that travel, the one part of the consumer economy that's been on fire, was at risk of kind of rolling over. But we saw with Delta last week with their report, extremely strong conditions on the ground, and management almost described it as this secular boom that's still in, at most the mid-innings. There's still several more, there's still a lot more of the recovery to go as the industry rebounds from where it was before the pandemic. And Delta outlined a lot of really interesting charts just showing how much further capacity traffic has to go before it gets back to where it was before the pandemic. So travel leisure portion of the economy looks like it remains very robust based on what United said. And it's interesting that they're still performing very well, even with the big jump in capacity guidance, suggesting that pricing is coming off a little bit, which you saw in the last CPI. So airfares look like they will come down, but that isn't denting their overall revenue and earnings growth because demand is still so healthy.
All right, back to Tesla. Phil LeBeau's got more. Phil?
John, we said the magic number to focus on was 16.9%. That was the estimate on the street for automotive gross margins, excluding zero-emission vehicle credits, the estimate from Wall Street. Tesla reported automotive gross margins for the second quarter coming in at 18.2%. So better than expected. Now still down compared to where it was in the first quarter, which I think came in at 19.3%. So you're still seeing the impact of the price cuts and the margin compression there. But remember, the expectation is that this is the trough. Here and maybe into a little bit of the third quarter are the trough in margins, and then it is expected to accelerate, especially as they get the economies of scale and they're bringing down some of the costs on the battery manufacturing. So that's the expectation on Wall Street. Again, automotive gross margins, excluding zero-emission vehicle credits, coming in at 18.2% for the second quarter for Tesla, better than expected. Guys, back to you.
And as you're talking, the stock is moving higher. Phil LeBeau, Thank you. Shares of Tesla turning positive right now, up close to 1%. Mike Santoli, I want to bring you back in this conversation because Tesla is really the first mega cap tech stock, if you will, to report this earnings cycle. I mean, margins better than the street had expected here. Stock's up 140% year to date. I mean, does this set us up for strength in the other big growth names that have already seen sort of big moves in the stocks already, or is it sort of its own dark horse?
Well, it's always kind of operating based on its own forces, but I do think that the idea that the market has rushed to a place of building in some pretty good results in the stock prices, and therefore, the bar is relatively high to really impress the market. That's probably the same for a lot of these stocks. I do find it interesting with Tesla. First of all, John's talking about the options implied moves. Don't foreclose on the idea that through the conference calls, there's going to be some reason that these stocks like Netflix and Tesla do get a charge in one direction. There's going to be a ton of talk about AI. I trust on the Tesla call. See if the street is receptive to that. But what I did find interesting is as they, in their shareholder letter, talk about operations, Tesla says, we are focusing on cost reduction, new product development that will enable future growth investments in R&D, et cetera. Cost reduction listed first. So clearly they're trying to pay attention and be responsive to the idea that they are being watched for the margin performance.